we are going to see about banking in India. Okay. Now, what is the specialty of banking? Banking is the lifeline of the country. Okay. Banking is the lifeline of the country, and banking is said to be the backbone of any economy. Okay, so the collapse of a banking system is a collapse of the economy. So the government is always very cautious with regard to the banking system. Now in India, banking is regulated by Reserve Bank of India, RBI. Okay, so this is the background of banking. Let us quickly go into the banking structure in India. Now, let's go to the structure of banking in India. Okay. There is something called the RBI. Yes. RBI is the regulator or the monetary authority. Under RBI, okay, the banks function. First, you have what is called the commercial bank. Okay. Then, you also have the regional rural banks working under RBI. Then, you have the so-called cooperative bank working under RBI. Then you have other types of banks like small banks, payment banks, etc. Then there are also other categories like development banks, All India Financial Institution, then you also have NBFC. All these are different categories of bankings and banking structure in India. Okay, we'll see each of these types one by one. First, let us take the first category. It is a commercial bank. Okay, the first category is called the commercial bank. Okay, under commercial bank, there are two types of banks. Okay, the first is under commercial bank, you have the first category, and the first category is called public sector bank. Then you also have the private sector bank. Okay, then so first category is commercial bank, under commercial bank, public sector and private sector. Now, under public sector, you have further two more categories. SBI, State Bank of India, and other PSU banks. Got it? Now, private sector banks, further two categories. Indian old or new generation, then foreign banks. Okay, this is with regard to commercial banks. Now, let's recall types of banks. So, commercial bank, rural bank, regional rural bank, cooperative bank, payment bank, development bank, etc. The commercial banks are the most widespread institutions. They provide a number of products. Two of the main functions, what are they? Accepting deposit and granting advances. These two are the very crucial activities done, even though there are other functions carried out by the banks. Who is a regulatory body? RBI. So all the banking banks in the banking industry is regulated by RBI. So RBI is a central bank, and RBI is responsible for development and supervision of constituents of the Indian financial system, as well as determining in conjunction with the central government monetary and credit policies. Important functions are issuance of currency. They issue the currency of the country, regulating the currency issue, and acting as a banker to central and state government, banker of bankers, and acting as banker to commercial and other types of banks, including term lending institution. Now, RBI is also given the responsibility of regulating activities of commercial and other banks. You cannot commence the business unless you get the license from RBI. Any commercial for that bank for that matter should get a license from RBI to operate. Not only that, payment bank, small finance bank, every kind of bank get a license from RBI to operate. RBI also has a power to inspect any bank. So any branch of the bank can be inspected by the staff of the bank and also by the staff of RBI. So what are the types of bank? Commercial, cooperative, development banks, regional rural bank, payment bank, small finance bank. And commercial banks are the most widespread. They provide a number of products and services. What are the function? Accepting and granting advances. Now, what is a regulatory framework? Okay, what are the acts which are so what are the acts acting upon the banks in the country? Banking Regulation Act, this is a primary act, and State Bank of India Act, only applicable for SBI, and State Bank of India Subsidiary Act. Okay, subsidiaries have been merged with State Bank of India Act, but still, nevertheless, we are studying about the same. Companies Act 2013, it is secondary, meaning for all the banks, Banking Regulation Act is primary, Companies Act is secondary. Now, in 1970 and 1980, most of the banks in the country were nationalized. So, at that time, Banking Companies Acquisition and Transfer of Undertaking Act was enacted. And secondly, in 1980, Banking Companies Acquisition and Transfer of Undertaking Act 1980 was enacted. So, what happened? In these 2 years, nationalization of banks happened. RRB Act 1976, Information Technology Act 2000, Prevention of Money Laundering Act, PMLA Act. Then SURFACE Act, CIRCA Act, Payment and Settlement System 2007. What are the 3 categories of banks based upon computerization? Non-computerized bank, partially computerized, fully computerized. Most of the nationalized banks like SBI, PNB, Indian Bank, they are all fully computerized. Some of the banks are partially computerized and some are non-computerized. But most of them would fall into the 3rd category. Now we have something called banking product portfolio. What are the products under the umbrella of banking? The commercial banks serve as the kingpin, main person of the financial system of the country. They render many valuable services. What are they? We are going to see it. First, acceptance of deposits. Okay, there are different types of deposits. First is fixed deposit, also called as the FD. Then you have the recurring deposit, also called as the RD. Then you have cash certificate. Then, so these are the 3 important categories in the first one, that is time deposit. Okay, time deposit, time means there is a specified period. Okay, what is this? They are repayable after a certain period of time, therefore they are called time deposit. They are not withdrawn by check, draft or other means, meaning if you want to withdraw fixed deposit, you don't give a check or draft or other means, they are not withdrawable. FD, it is very common way of savings, fixed deposit. Okay, so normally they are withdrawn after a period of say 3 years, 5 years or 10 years. It could be for a medium term or a long term. Now, what happens? The rate fluctuates. Depending upon the time period, the rate of interest also fluctuates. The bank allows higher rate depending upon the amount and period of time. Now, earlier, most of the time, the rates were decided by RBI. Now, currently, they are permitted to offer interest as determined by each bank. You don't find much of a difference, but there are slight marginal differences between the banks. But by and large, mostly they stick to a common interest only. There might be slight variations. Now, can you give a deposit for short period? Yes. These days, a bank accepts deposit even for 15 days or 1 month. When you are in urgent need, the bank is allowing premature closure. So what does it mean? Let us say the due date for your FD is 15th April, but you need funds by 1st April. Can you close your FD? Yes, and that is called premature closure. If you are closing premature manner, you are losing some percentage of interest. Okay, so if you are closing premature manner, you are losing some interest. What is this? You are paying interest at a reduced rate. Depositors can also avail loans against FD. Okay, so against FD, you need not close the FD, but you can get the loans. After that, you can repay the loans. FD receipt cannot be transferred to other persons. Then you have RD. RD is very good. It is called recurring deposit. It is very suitable for lower income person. What do you say? It is a mode of savings. The customer is opening an account, depositing certain sum of money every month. Then after 1 or 3 or 5 years, accumulated amount is transferred along with the interest. It is very helpful to whom? Middle and poor sections, because it is inculcating the habit of savings. The interest is paid on a cumulative basis. It is very useful for regular savers of money, because you are making a commitment each month and you are not defaulting in the savings. Cash certificate, it is used to public for a longer period of time. It is attracting people because the maturity value is in multiple. It's very attracting and very good investment also. It's very useful for meeting future financial requirements, emergencies like marriage, education, etc. Now what is that they are issued? They are usually issued at discount. They're usually issued at discount, and it means cash certificate 1 lakh is payable after 10 years can now be purchased for 20,000. So there is a value for which it is being issued now, and that is normally at a discount. Then it is redeemed at the face value. Now we are going to see the next topic, that is demand deposit. Okay, what is demand deposit? They are the deposit which may be withdrawn by the depositor at any time without previous notice. How do you withdraw? You can withdraw by check or draft. What are the types of demand deposit? First is savings deposit. Next is current account deposit. Okay, what is savings deposit typically? This is for the salary holders. Okay, so for salary holders, they open their SB account with any bank. Yes. So what is the intention of savings account? Just to promote savings among the people. Do they provide, do they give something very high tax interest rate? No. So it is mainly to promote savings habit among the people. Therefore, it is not having any intention to give very high interest. There is a nominal interest. Okay. So what is this? The first point is, it is to promote thrift among people, meaning savings habit among the people. Who can have it? Individual and non-profit or institutions. And the rate is lower than time deposit. Remember, it is not with an intention to give high interest. Savings holder get the advantage of liquidity, meaning it is the funds are always available. It is a liquid, it is very much liquid in nature. And small income in the form of interest. You don't get high income as an interest. What are the restrictions? There is restriction on withdrawals, some restrictions. Now, corporate bodies and business firms are not allowed to open SB accounts. They have to go for current account or cash CC, cash credit account, etc. They cannot go for SB account. Now, the interest, who is determining? RBI. Interest rate for SB account is determined by RBI. So typically savings deposit for salaried class people, it is to promote savings intention among the people. They get the advantage of liquidity. They get a small income in the form of interest. The interest rate is determined by RBI. Next, we have current account deposits. These are maintained by people who need to have liquid balance. It offers high liquidity. No interest is paid on current deposit, and there are no restrictions on withdrawal. These accounts are generally in the case of business firm, institution, and cooperative bodies. Banks are designing and offering various investment schemes for depositing of money. It is varying from bank to bank. So this is typically for business people. The banks are currently working with different schemes. The deposit account offers better rate and sometimes withdrawal facility also. They are mostly offered by foreign banks. In USA, these accounts are known as checking accounts. Next, you come to advancing loans. So the banks provide loans and advances in various forms. It's one of the most important income for the bank. The first is OD facility, that is overdraft facility. It is for business people, current accounts only. It is an arrangement with the bankers whereby customer is allowed to draw money over and above the balance. So you are overdrawing. That is called the overdraft. So what is it? You are overdrawing, and his account is generally pre-arranged with the bank. It's a short-term facility and the bank will charge interest. Okay, so it comes along with the charges. It is not given freely. It is generally for business firms and companies, not for individual salaried class people. It is not for salaried class people, it is for the business firms and companies. Next is called CC account. CC is called cash credit. It's a form of working capital. To whom it is given? To the business firms. The customer opens an account and it is credited with that account. He can operate that account within the limit. So there is a limit with regard to cash credit, CC account. And there is a security. It is made against security of goods or personal security. So floating charges created on those goods. So the period of may be extended further. What is the advantage? Bank charges only on the amount utilized, not on the amount sanctioned or credited to the account. Let us say that the amount sanctioned is 10 crore. You utilize only 8 crore. On this 8 crore only, bank levies a charge, not on the amount sanctioned. So what is it? Bank charges only on the amount utilized, not on the amount sanctioned. But this is highly discouraged because there is an uncertainty involved. This is slowly phased out from the banks and it is replaced by the loan accounts. This is not used in developed countries. Next is another one popular form. It is called discounting of bills. So there are bills receivable is there. So bills receivable, they usually have a term period, yes, after which it gets matured. Now let us say there is a 3-month period. So let us say, for instance, there is a 3-month period for bills receivable. It gets matured after 3 months. So the other party cannot wait for 3 months. Immediately they want the money. So what can they do? They can go to the banker and discount this bills receivable. Okay. So for this discounting, the banker might levy some charges, that is called discounting charges. Now, discounting of bills may be another form of credit. It is the bank may purchase inland and foreign bills. So these bills could be either within the country or outside the country. If it is within the country, they are called inland bills. If they are outside the country, they are called foreign bills. Okay. Now, they are due from different payment by the drawer debtors at discounted values little lower than the face value. What does it mean? Let us say the value of the bill is 10,000. Okay, now it is maturing after 3 months. Now today if you want to discount it, the banker might give you only 9,900, meaning the difference of amount of 100 rupees is a discounting charges. So banker's discount is generally the interest on the full amount. Bank reserves the right of debiting the account in case the maturities are ultimately not paid. Okay, so what happens at the date of maturity after 3 months? If the bill gets dishonored, then what is it happening? The banker will take right action. So the bank reserves the right of debiting the account if it is not paid. Bill passes to the banker after endorsement. Because this is a negotiable instrument, the bill can be passed after endorsing. Okay, the discounting provides immediate finance to the sellers. So you need not wait for the period of 3 months. You can immediately discount it and get the amount immediately. The banks can discount only genuine commercial bills. This helps them to carry on the business. So only genuine bills are being discounted by the banker, that is those drawn against sale of goods on credit. Bank will not discount accommodation bill. What is accommodation bill? It is a kind of a bill which is to accommodate your friend or a person known to you. It is actually not a bill receivable, but in order to accommodate someone, you can use this type of bill. It is called accommodation bill. So a banker will not discount this accommodation bills. It's a little risky in nature. Next. Now, in this video, we are going to study about Reserve Bank of India, RBI. RBI, its functions and power. RBI stands for Reserve Bank of India. Now, the banks in India are highly regulated and they have to ensure compliances. There are two principal regulatory framework of banks in India. Two principal acts. The first act is Reserve Bank of India Act. Reserve Bank of India Act 1934. Shortly called the RBI Act. Now, the second act is called Banking Regulation Act 1949. So, the second act is called Banking Regulation Act 1949. Now, in this particular video, we are going to see about RBI Act in detail. First, why was RBI Act enacted? RBI Act 1934 was enacted with the main purpose of issuing the banknotes. Point number 2, to keep reserves. Why do you want reserves? For monetary stability of the country. And thirdly, to operate the currency and credit system. This is the main objective of RBI Act 1934. Now, is this RBI Act directly regulating all the banks? No. Directly, this act is not regulating all the banks because banks are regulated by Banking Regulation Act 1949. However, there are some sections of RBI Act which are applicable to the banks as well. Now, what does RBI Act deals with? Point number 1. It deals with incorporation. It deals with capital. It deals with management. It deals with the business of RBI. It deals with central banking functions. It deals with collection and furnishing of information. It also deals with regulation of non-banking financial institutions. Non-banking institutions. These non-banking institutions receive deposits, so regulating them is a must. Prohibition of acceptance of deposits by unincorporated bodies, regulation of transaction in derivatives, money market, monetary policy, etc. are the other functions of RBI. Now, RBI Act is amended from time to time. It's always amended from time to time to make it align with the banking system of the country. Next, we are going to see about Banking Regulation Act in a nutshell. Now, we are going to have an overview of Banking Regulation Act. So, for all the banks, Banking Regulation Act is also very important in nature. In fact, it is one of the primary acts for all the banks in India. So, Banking Regulation Act 1949. Now, Banking Regulation Act 1949, Banking Regulation Act 1949 applies to whole of India. Applies to whole of India, including Jammu and Kashmir. Including Jammu and Kashmir. Now, for all the banks in India, the primary act is Banking Regulation Act 1949. Not only that, along with Banking Regulation Act, along with Banking Regulation Act 1949, Companies Act is also equally applicable for these banks. Companies Act is also applicable. Now, what does this Banking Regulation Act regulates? The Banking Regulation Act regulates the entire activities of banking. Entire activities of banking is regulated. What does this mean? Licensing of banks is regulated. Restrictions on shareholding is regulated over here. Directors, voting rights, etc. Now, the Banking Regulation Act also further specifies the restriction on loans and advances, interest rates to be charged, maintenance of the SLR reserve, audit, inspection, submission of balance sheet and accounts. So, what does the Banking Regulation Act do? It tries to regulate the entire gamut of banking business. So, in a nutshell, we can tell that Banking Regulation Act is very much primary for all the banks in India. Now we come to the next topic about Constitution of Reserve Bank of India. Now, we are going to see more about Constitution of RBI and the management. So, we are literally looking into the genesis of RBI. Now, under the British rule, till the establishment of RBI, both the currency issue and credit control, both were under the government. Both were under the control of the governments, which is literally the British government. But after independence, it was strongly felt that the currency issue and the credit issue should be de-linked. So in most of the countries, currency issuance is de-linked from the government. And RBI Act was enacted in the year 1934. What is the preamble of RBI Act? Preamble means the most important objective. What is the preamble of RBI Act? The RBI Act preamble reads, to constitute a Reserve Bank of India, first, to regulate the issue of banknotes. To regulate the issue of banknotes. Point number 2. First process is to regulate the issue of banknotes. Secondly, keeping of reserves. Why does a country require reserves? To secure monetary stability. And thirdly, operating the credit system to the advantage of the country. Third objective is operating a credit system. To the advantage of the country. So preamble is to constitute the Reserve Bank of India to regulate the issue of banknotes, keep the reserves with securing a monetary stability, and generally to operate the currency, any credit system of the country to the advantage. So Reserve Bank of India was constituted with these primary objectives. Now let us look into the constitution of RBI. It is constituted for the purpose of taking over the management of currency from central government and also carrying on the business of banking in accordance with the provisions of RBI Act. Now, what are the other features of RBI? The other features of RBI, point number 1. RBI is a body corporate. RBI is considered to be a body corporate. Point number 2. RBI has perpetual succession. RBI has perpetual succession, meaning The RBI's activities would go on forever. Perpetual succession. Point number 3, common seal. Common seal is required for RBI, just like any other company. Point number 4, RBI can sue others. Point number 5, RBI can be sued. So what is it? RBI shall be a body corporate. It has perpetual succession, meaning perpetual succession means it would go on forever. Continuous existence is called perpetual existence. Perpetual succession or perpetual existence. It has a common seal and it can sue and it can be sued. Now point number 6. RBI is wholly owned by Government of India. It's completely owned by Government of India with effect from January 1st, 1949. Now, we are going to see about the business of RBI. Now, there is Section 8 of RBI Act. Section 8 of RBI Act talks about the same. Business of RBI is vested with Central Board of Directors. So, what is it called? Central Board. Now, what does the Central Board comprises of? Point number 1, it consists of the governor. Point number 2, it consists of 4 deputy governors. Then 16 directors. How does this 16 come? Just like a central board, there is also local boards. From local boards, 4. Then nominated directly by central government, 10. And 2 government officials. Appointed as per RBI Act. Now, this is the breakup of the central board. Now, we'll first see about governor. What about governor? Governor holds office for a period of 5 years. Next, deputy governor. Deputy governor also holds office for 5 years. Next, there is independent director. Independent director's tenure is for 4 years. And government officials. For government officials, it is at the pleasure of government. Now, what about all the board officials? Are they eligible for reappointment? Yes. What about independent directors? Can they be reappointed? The independent director's appointment is restricted to 2 terms of 4 years each, meaning 8 years. It may be continuous or it may be intermittent. Can the deputy governor or government officials Attend any meeting of the central board? Yes. Deputy governor and government officials nominated as directors also attend any meeting of the central board. Can they take part in deliberation? Yes. But what they cannot do, they cannot vote. Now, in the absence of governor, and if it is permitted by the governor, who may vote in the meetings? It is the deputy governor. It is a deputy governor. Now we already talked of local boards. We also know that there are 4 local boards. Where are these 4 local boards constituted? They are constituted in 4 areas, 4 parts of the country: north, east, west, south. So one is in Delhi, the other is in Mumbai, the other in Kolkata, the other in Chennai. Now, what does this local board consist of? The local boards consist of 5 members each. 5 members each. Who appoints them? Central government. The RBI has also conferred power to disqualify the directors and members of local boards. They could be removed, they could be vacated from their office. Now, with regard to central board, what are they talking of? Who will convening the meeting of central board? It's the governor. Governor only convenes the meeting of central board. How many times should you conduct the meeting? The meeting will be conducted at least 6 times in a year. Now, per quarter, at least 1 per quarter. For the day-to-day conduct of bank's business, central board, in terms of the power vested in it, can make regulations as it may consider necessary. Next, what is the board authorized to do? That's the next point. So what are the things the board is authorized to do? Point number 1, conduct the business of the central board or local board. So what is the first one? Conduct the business. Now, when conducting the business of the central or local board, you have to also follow the procedures at the meetings. Point number 2, the central board has some powers and functions. The delegation of powers and functions. Delegation of powers and functions. To the deputy governors, directors, officers, etc. Point number 3, formation of committees. Committees are further formed. And delegation of functions and powers to such committees. Next, management of staff. Management of staff and superannuation fund. Point number 5, use of common seal of the bank. Use of common seal of the bank. Point number 6, execution of contracts which are binding on RBA. Execution of contracts. Point number 7, maintenance of accounts and preparation of balance sheet of RBA. Point number 8, remuneration of the directors. Remuneration of the directors. Point number 9, relationship of the banks with RBA. Then returns submitted by scheduled banks to RBA, conduct and management of clearing houses, refund of currency notes, other matters, etc. Now let's come to the next point, objectives of RBA. What are the objectives of RBA? Point number 1. Why was RBA established? What is its objective? First objective is regulating. Regulating what? Regulating issue of banknotes. Regulating issue of banknotes. Point number 2. Keeping reserves. Reserves are very much important for every country. Why is reserve important? To secure stability, monetary stability to India. Point number 3. Operating the currency and credit system. Currency and credit system operation. To the advantage. Now, one more objective is added from 2016. What is that? Operate monetary policy. Operate monetary policy. For what? For maintaining the price stability while keeping the growth objective. These are all the objectives of RBA. Now, we are going to study about functions of RBA. We are going to study about functions of RBA. First function. The functions are given in the chapter 3 of RBA Act. We are going to see the first function. Function number 1. Issue and management of currency and distribution of coins. So function number 1 is with regard to currency management. Function number 2. Function number 2 is banker to government. Function number 3. Banker to the banks. Function number 4. Lender of last resort. Next function, loans and advances. Next function, emergency advances. Next function, controller of credit. Next function, managing the value of rupee. Managing value of rupee. And last function is collecting and furnishing of credit information. So all these are all functions of RBI. Let us see this one by one. Function number one. Function number one is issue and management of currency and distribution of coins. Now, currency in our country comprises of 1 rupee notes and coins. So these are all lower denominations. Now, there is also bank notes. Bank notes are also issued by RBI. Now, issuance of this bank note is the central banking function. This is the main purpose for which RBI is being established. Now, who has got the right to issue bank notes in India? Only RBI. So, RBI only has the sole right to issue bank notes in India. Nobody else can issue the same. Now, these bank notes are issued by a separate department of RBI. It is called issue department. The RBI has various departments. The one which is dealing with bank issue is called issue department. It is separate from banking department. So issue department is separate from banking department. So there is one more department which is called banking department. It is different from the issue department. Now banking department is responsible for banking business. Now we are going to see about issue department because we are dealing with currency. Now, does the central government has any involvement here? Yes. The design of the banknotes, the form of banknotes, the material of banknotes, all these are decided and approved by central government. Now, who recommends it? Central Board of RBI. Now, this banknote, every banknote shall be a legal tender. Legal tender, which means it is legally approved at any place in India. Now, this banknotes issued is a legal tender at any place in India. However, on recommendation of central board has to recommend. Central government will declare any series to be not a legal tender. Who has the power to withdraw this legal tender? That is central government. Central government shall declare this banknotes to be not a legal tender. We already know that in November 8, 2016, the government announced a demonetization. Now, which notes were demonetized? It is the 500 rupees notes and the 1000 rupees bank notes of Mahatma Gandhi series. Now, in that place, there were issue of new notes. So, which of the notes were newly issued? Issue of new 500 notes, new 2000 rupees bank notes in exchange for the demonetized bank notes. Now, section 24 of RBI Act. What does it say? RBI has the power to recommend central government various denomination of banknotes. What are the denomination of banknotes? It can be 2 rupees. It can be 5 rupees. It can be 10 rupees. It can be 20 rupees. It can be 50, 100, 500, 1000, 5000, 10,000, or other denominations not exceeding 10,000 rupees. So maximum denomination is 10,000 rupees. Now, the issue department is a department which issues the notes. The issue department should also keep its assets. Whenever the notes are issued, it should also keep the assets. They are the backing for the note issuance. Now, these assets are separate from the other assets of the banking department. Now, the issue department is having assets, keeping the assets. Now, the assets of the issue department against which the notes are issued, what are they? What are they? It consists of gold coin, gold bullion, foreign securities, rupee coin, and rupee securities. Now, we are going to see about another department of RBI. The other department of RBI is Department of Currency Management, shortly called DCM. Now, what is the responsibility of DCM? The main responsibility is administering the function of currency management. What is the meaning of currency management? Two things are involved here. First is issue of notes and coins. Similarly, it also means retrieval of the old notes. Retrieval of the old notes, unfit notes from circulation. What is the currency management infrastructure consist of? The currency management infrastructure consists of issue offices, currency chest, small coin depots, spread across the country. Now, the model adopted by RBI to improve the currency distribution system is a hub and spoke model. Hub and spoke model. What does it mean? Fresh notes, which are newly printed, are sent to larger currency chest. Are sent to larger currency chest. They meet the currency needs of a particular area. These chests are identified as hub chests. What do these chests do? These hub chests, they in turn supply notes to smaller currency chests. They in turn supply the notes to smaller currency chests. And this act like spokes in the distribution model. In this manner, fresh notes are distributed to every issue office of RBI. Now, let us study about currency chest in detail. Currency chest. RBI has established a chain of currency chest with several banks. You can find currency chest with several banks. What is the currency chest? Now, currency chest is a place where RBI keeps all excess money in the form of cash under the custody of different banks. Now, these currency chests are nothing but they are some designated branches which are earmarked for this purpose. They are branches of the commercial banks authorized by the RBI. And what do they hold? Banknotes, rupee notes, and coins. What do these currency chests do? These currency chests have the responsibility of distribution. Distribution of notes and coins on behalf of RBI. So they get their notes from RBI, then they are later delivered to the respective banks. So currency chest is the depository framework of RBI. So if the bank is hosting the currency chest, it would be subjected to scrutiny because it's a very important function. So it is subjected to scrutiny by RBI. Also, through a separate policy of and rules of RBI, it exchanges the mutilated notes surrendered by the customers. So, if a note is being torn, it can be surrendered by the customer through the bank branches and through the currency chest. Now, what is a bank note? What is a note issued by RBI? The bank notes which are issued by RBI are promissory notes. There are two types of promissory notes. One is called bearer promissory note, the other is called order promissory notes. And the notes issued by RBI is only bearer promissory notes. In India, only RBI can issue bearer promissory note. The common people cannot issue bearer promissory notes. If common people issue bearer promissory note, it is illegal. So the promissory notes of RBI are bearer in nature. And such notes are exempt from stamp duty. Now, next, banker to the government. Banker to the government. So, RBI is having an obligation to act as a banker to the central government. Now, what should RBI do under this? Accept money. Accept money for account of central government. Point number 2. Make payments. Make payments up to the amount standing to credit of central government. Point number 3. Carry out exchange, remittance and other banking operations. Then last, management of public debt, which belongs to Union of India, government's public debt. So what is RBI's right? To transact government business in India. So what can RBI do? Money, remittance, exchange, banking transaction in India. Now, central government is depositing all cash balance with RBI. So central government deposits money with RBI. And this money is carrying free of interest. So central government deposit all cash balance with RBI. So this is free of interest. What is the one more responsibility of Reserve Bank? Receiving and paying money. On behalf of central government. Then, whether RBI is paid any remuneration for carrying out all these activities? No remuneration. No remuneration for carrying out all these activities. Now, what is RBI entitled? RBI is entitled to get commission. RBI is entitled to get commission for managing public debt. The government transaction work also includes maintaining currency chest. Now, RBI can also enter into transactions with the state government. So, RBI can enter into transaction with state government to transact their business. Now, under section 20, RBI is managing public debt of both central government and state government. RBI is also floating new loans. Floating new loans on behalf of central or state government. And what else be done? Conduct periodical auction of treasury bills. Auction of treasury bills. Issue government securities which are dated. As well, buying and selling the same. So these are all the works done by RBI in the capacity of banker to the government. Now, the RBI has one more duty, extending the ways and means advances. Up to how many days? Up to 90 days. What does this mean? Managing the temporary mismatches in the short-term receipt and payment. Now, RBI also provides investment services. What is investment services? Deploying temporary surplus cash balance in government account. Now, central government of India has three funds. What are they? Consolidated Fund of India. Second is contingency fund. Third fund is called public account. Now, all these three accounts are maintained by RBI. This is the function of RBI as a banker to the government. Now, next is banker to the banks. Reserve Bank act as a banker to all the banks. Now, what is that? This is a very special relationship that is created because of statutory requirements. Now, if a name of the bank is included in the second schedule, then what do we call that bank? We call that bank as scheduled bank. We call that bank as scheduled bank. Now, what should this scheduled bank do? The scheduled bank must maintain cash reserves in account with RBI. Cash reserves in account with RBI. So the scheduled bank status to any bank will give some privileges. What are they? Availing financial accommodation from RBI. Now the Reserve Bank can also provide means of transfer and settlement of fund between banks. This can be on account of clearing, remittances, lending, borrowing, etc. Now RBI provides a platform. RBI provides a platform for interbank financial transaction. For interbank financial transactions. Now, such account of banks are maintained by a separate department called Deposit Accounts Department. So, this is another department. It is called Deposit Accounts Department of RBI. Intra-bank funds transfer also take place through an RBI portal. It is called e-Kuber. So that is for easy facilitation of transfer. This particular portal is being opened and it is known as e-Kuber. Now, next, RBI is called the lender of last resort. Meaning what? Last resort means the last chance. Now, when does this happen? The banks have exhausted all their means for raising the funds. So banks are already exhausted. If that be the case, they go to RBI. So when the banks have exhausted the means for raising the funds, then whom do they fall on? They fall on RBI. Now RBI is the source of finance for all these bankers. So RBI is known as lender of last resort. So what typically RBI grants? RBI grants financial accommodation. So typically RBI grants financial accommodation. Meaning they do sale, purchase and rediscount of eligible bills. And what else they do? They also grant loans and advances. Now, we are going to see about a rediscount of bills. The next topic is called rediscount of bills. Rediscount of bills. Who does it? Rediscount of bills with the RBI by the banks. First rediscount happens with regard to bona fide commercial bills. Bona fide commercial bills. Bona fide means genuine, not fake. Genuine commercial bill. Now, what is the condition for this bill, commercial bill? Two conditions. These commercial bills is forming part of commercial or trade transaction. They must be drawn in India and payable in India. Condition number 1. Drawn in India, payable in India. And what is the maturity? Maturity is within 90 days. Within 90 days from the date of discount by the banks. So maturity is within 90 days. Now with regard to export bills, instead of 90 days, it is 180 days. So export bills relating to export from India, the maturity may be 180 days because this is granted by the government. This is like incentive for the exporters. Instead of the normal bill, it is 180 days. Additional time period is given for the exporters. So 180 days max. What is the other prerequisite? The bill should have two signatures. Two signatures. And one of them should be that of a scheduled bank. We already know who is a scheduled bank. The name of the bank which is included in the second schedule, then that bank is eligible to be called as a scheduled bank. Now, next. Second is bills relating to financing agricultural operations or marketing of crops. What is the maturity for this particular bill? Because this is with regard to agricultural operation, there is a laxity. They are giving some more benefits for such kind of bills. The time period is they have to mature within 15 months from the date of purchase or discount by banks. Point number 3. Bills that are associated with cottage and small scale industry. So these cottage industry and small scale industries are the lifeline of a country. So these bills that are associated with production or marketing aspect of these industries, and they have to mature within 12 months. 12 months of its discount or purchase by banks. And such bills should be drawn in India and payable in India. And two signature, one of that signature is that of a state cooperative bank. So there must be two signature. One signature is that of a state cooperative bank or state financial corporation. supported by a guarantee from state government concerned on repayment of principal and interest on these bills. Next. Bills representing holding or trading in government securities. So once again, such a bill is drawn in India. Payable in India. And has to contain the signature of a scheduled bank. Maturity is within 90 days from the date of purchase or rediscount. Next, foreign bill. Foreign bill is an opposite of an inland bill. So this also must be, this foreign bill arises because of export transaction. And we know that for export transaction, the time period is 180 days. And such a bill must be drawn on payable on any country which is outside India. Outside India. But such a country must be a member of IMF. Now, if it is other than export bill, the maturity is not to exceed 90 days. If it is other than export bill, the maturity is not to exceed 90 days. Now, with regard to financial analysis of banks, there are two aspects to be taken into consideration. What are the two aspects? First is financial analysis of banks can also refer to the financial analysis of the bank's customers. Because one of the main objectives of bank is to lend money to the customers. Before lending money to the customers, bank has to look into the financials of the customers. So we have to know about the customers' financial analysis for analysis of banks. Secondly, the financial analysis also would comprises of the financial analysis of the bank's own statements. So two aspects, financial analysis of the bank's customers, and secondly, the financial analysis of the bank itself. Firstly, we would be looking into some aspects of bank's customers, and secondly, we would move to financial analysis of the banks. Now, so coming to the customer's point of view, banks accept deposit from their depositors, and that is the main source of fund for the bank. Secondly, bank also raise funds in the domestic financial market and international financial market. And these funds are deployed by the banks as loans and advances and also as investments. Hence, a banker at the time of deploying his fund, either as a lending banker or investing banker, needs to be very careful. Like any other investor or lender, banker also need to carry out many type of analysis. Now, what are the types of analysis with regard to financials? There can be a PESEL analysis, fundamental analysis, technical analysis, financial analysis, market analysis, and risk analysis. These are all the different types of analysis. So analysis is an important aspect of decision making. So analysis of different situations and scenarios would assist the banks to take appropriate decision. Now, let's come to the company, the customer's point financials. So the performance of a company or a business can be measured by looking into the financial results of the company. Comparative study would assist the analyst to assess the result. So financial statements of the company is analyzed and interpreted by different class of persons. There is a P&L analysis as well as balance sheet analysis. Financial analysis has its own advantages and limitations as well. Now, with regard to balance sheet analysis, what are the aspects to be taken into account? So, the balance sheet is a very important financial statement. It is prepared annually. It shows assets and liabilities on a particular date. And the assets indicate what the company owns, and the receivables and the liabilities indicate what the company owes. Now, first is to look into assets. Assets may be current asset, fixed asset, and intangible asset. So, current asset, those which are to be liquefied into cash in the near future. What is the composition of current asset? It is bank balance, marketable securities, inventories, bills receivable, etc. Secondly, fixed asset. Fixed asset is an important classification. It comprises of land and building, plant and machinery, fixtures, fittings, etc. Then we have intangible asset. So intangible asset typically comprises of the goodwill, copyright, patents, trademarks, etc. Then on the liability sides, what are the important aspects? First, borrowings from bank. Secondly, sundry creditors. Thirdly, term liabilities. Then you also have what is called contingent liabilities or off balance sheet items. Means what? They do not exist on the date of balance sheet. However, they may arise in the future. Similarly, there is analysis of P&L account as well. So items of P&L is gross sale, net sale, cost of goods sold. Please keep it in mind. With regard to a banking, they are a service sector and you don't have much of what is called cost of goods sold. Whereas in a typical manufacturing company, you would be having cost of goods sold. When a banker analyzes the customer's financials, it may find cost of goods sold, whereas in the bank's own balance sheet, you do not find items like cost of goods sold because that is typical of a manufacturing company. Then you also have gross profit, then operating expenses, operating profit, non-operating surplus or deficit. Then you have profit before interest and tax. Then you have tax, and thereafter you have profit after tax, which is net profit. So these are all some typical items you would find in a normal P&L of a normal company. Now, point number 1. We are going to study about the financial analysis of the bank. So before getting into financial analysis, we have to know about financial statements. So financial statements is very essential to understand about financial analysis. What are financial statements? They are very important reports. They show how a bank is doing, and they are very useful internally for a bank stakeholders and the board of directors. They are also important to the prospective investors, to the government agencies, and for the credit rating agencies, and also to investment analysts and stockbrokers. So the banks are required to prepare documents showing the bank's financial performance. Most of the banks prepare annual statements. It shows the financial wealth of a company. What is the meaning of financial wealth? How much it is owing and how much it owns. But they can be manipulated. So it is often required that the statements for external consumption must be audited by independent accounting firms. Now, point number 1. An organization can examine its own financial performance over a certain period through looking at the financial statements. So how does it help? It enables managers to have a better comprehension of the bank. Point number 2. Potential customers of the bank they may demand information to assist them better. Point number 3. The major advantage of financial statement is it helps lower the vulnerability of a bank to fraud. So, since they offer an insight into banks' operating results, they can easily detect irregularities. Point number 4. It should provide information with the units of financial accounting. Next. To help the investors to assess the prospects of receiving cash from the dividends or interest. Next, provide information about the economic resources of an organization. Next, parts of financial statements. What are the parts? There are 3 basic parts. First is balance sheet. Second is income statement. Third is cash flow or fund flow statement. Now, what does the balance sheet do? The balance sheet shows all the assets and liabilities at the end of the period. Now, the difference between the assets and the liabilities would indicate the net worth of the bank. Next is income statement. So it answers how the bank did from the beginning to the end of the accounting period. Next is cash flow statement or fund flow statement. So cash flow statement typically speaks about the cash of the bank. Where the cash went and where it came. Next, we'll see it one by one. Balance sheet The analysis of balance sheet can tell whether the bank owes too much, whether the bank owes too much or whether it is lending too much. Next, income statement. Analysis of income statement can tell whether business is not high enough to give sufficient profit and what the big and small cost of the business are. Next, cash flow or fund flow statement. Analysis of cash flow can tell whether most needs are met internally through internally generated funds or whether some come from borrowings. Next, to summarize, the three basic financial statements: balance sheet. So it says liabilities plus owner's equity equal to asset. Next, income statement. Sales revenue minus expense equal to profits. Then cash flow or fund flow statement. Sources and uses of capital. Now, next we are going to see fundamental accounting concepts and conventions. So, what is that? Fundamental accounting, basic accounting concepts and conventions. So, now, accounting concepts and conventions are used in accountancy or the rules and guidelines. All accounts and accounting statements should be created, preserved and presented according to the concepts and conventions. Let's see the concept one by one. First concept is called accrual concept. Accrual concept. What is accrual concept? The accrual concept assumes that revenue and expenses are taken account of when they occur and not when the cash is received or paid out. So when do you take all the revenue and expenses? As and when they occur and not when the cash is received. So as and when it is occurred, you recognize the same. So what is the purpose of this concept? It is to ensure that the revenue and cost are recorded in the appropriate statement at the appropriate time. So what is the accrual concept assumes that when revenue is realized at the time of sale of goods or services, irrespective of the fact when the cash is received. Expenses are recognized at the time of services provided, irrespective of when cash is paid. Next is consistency concept. What is consistency concept? Because the methods employed in treating certain items within the accounting records may be varied, concept of consistency has to be applied. So it is now accepted that when an entity chooses to treat items such as depreciation in a year, it should continue to use that method. So continue using the method year after year. If it is necessary to change the accounting method, then an explanation must be shown. Next is separate entity concept. What is separate entity? So the business entity concept or the separate entity concept states that the business and the owner, they are two separate legal entities. Means what? Owner is different from the business he runs. So being an artificial person, company has an existence independence of the members. The company can have own property, enter into contract, conduct any lawful business in its own name. Next is called going concern concept. What is the concept of going concern? Going concern concept, it is one of the fundamental accounting assumptions. Fundamental accounting assumption. So financial statements are prepared assuming that business entity will continue to operate in the foreseeable future without the need or intention on the part of management to liquidate the entity. So this is called going concern assumptions. Next, prudence concept. What is prudence concept? It suggests that, prudence concept suggests that asset and revenue should not be overstated. So assets or revenue should never be overstated. And similarly, liabilities and expenses should never be understated. Next, we have materiality concept. What is the concept of materiality? Financial statements are prepared to help the users with their decisions. All the information which has the ability to affect the decision of the users of financial statement is material. And this property is called materiality. Now, next topic. Characteristics of financial statement. First, understandability. First is understandability. Second, relevance. Third, reliability. Fourth, comparability. So understandability means the information must be understandable to the users. Relevance means the information must be relevant to the needs of the users. Third, reliability means the information must be free of material error and bias and not misleading. Fourth is comparability. The information must be comparable to the financial information present for other accounting periods. Next is limitations of the financial statements. Limitations. Point number 1. Past financial performance, whether good or bad, is not necessarily an accurate predictor of future performance. Next, financial statements do not tell you about changes in senior management. Third, financial statements do not tell you about the loss of major customers. Next, financial statements do not tell you about the competitive environment. In which the company operates. Next, financial statements do not disclose the bank future prospects. Next, the more out of date a customer's financial statements are, the less reliable. Without reading the notes to the financial statements, the credit managers cannot get a clear idea of the risk. Unaudited statements may or may not follow the generally accepted accounting principles, and if they do not follow, relying could be a serious mistake. Financial statements can be even altered legally by adjusting certain type of reserves. Next, financial results can be improved by reducing or eliminating discretionary expenditure. Next, unaudited statements may be inaccurate, misleading, or even deliberately fraudulent. Next, what about audited statements? They also do not guarantee accuracy. Even audited financial statements are subject to a degree of manipulation. So, these are all the limitations with regard to the financial statements. Now, methods of financial analysis. What are the different methods of financial analysis? First method, comparative statement. Second method, common size statement. Third method, trend analysis. Fourth method, ratio analysis. Now first, comparative statements. What are comparative statements? Okay. Comparative financial statement analysis provide information to access the direction of change in the bank. So the financial statements are presented as on a particular date for a particular period. Now financial statement balance sheet indicates a financial position as at the end of the accounting period. The income statement shows the operating and non-operating results for the period. But the financial managers and the top managements are interested in knowing whether the business is moving in favorable or unfavorable direction. So, for this purpose, the figures of current year have to be compared with previous year. Now, comparative financial statement analysis is also called as horizontal analysis. The comparative financial statement provides information about 2 or more years' figures as well as increase or decrease from the previous year's figure and its percentage of increase or decrease. This kind of analysis helps in identifying major improvement and weaknesses. Next, for example, if net income of a particular year has decreased from the previous year, Despite an increase in the sales during the year, it's a matter of serious concern. So comparative financial statement analysis helps to find out whether costs have increased, which have resulted in lower net income than the previous year. Second, common size statement. What is common size statement? Common size financial statements are different from the customary financial statements. When the traditional statements are used for reporting and to report the monetary purposes, the common size financial statements are used for decision making purpose. Next, if an investor want to compare the financial statements of two banks, there have to be some sort of scale to overcome the limitation and match the two unrelated businesses. Since the size of the banks are not the same, this usually leads to misleading and wrongful comparisons. To overcome the problems, many methods of comparing the financial statements of different companies are devised. Third, trend analysis. What is trend analysis? It is also one of the tools for analysis of the bank's monetary statements for the investment purpose. Investor uses analysis tool a lot in order to determine the financial position of the bank. In a trend analysis, the financial statements are compared with each other for the several years after converting them in the percentage. Next, we have ratio analysis. What is ratio analysis? Ratio analysis is a form of financial statement analysis that is used to obtain a quick indication of firm's financial position in several key areas. The ratios are categorized as short-term solvency ratio, debt management ratio, asset management ratio, profitability ratio, and market value ratio. So, ratio analysis is a tool possesses several important features. The data which are provided by financial statements are readily available. The computation of ratios facilitate the comparison of firms which differ in size. Ratios can be used to compare a firm's financial performance with the industry average. Ratios can be used in a form of trend analysis to identify the areas where performance has improved or deteriorated. Now, ratio analysis is also based upon accounting information. The effectiveness is limited by the distortions which arise in the financial statement. Therefore, ratio analysis should be used as a first step in financial analysis to obtain a quick indication of firm's performance and identify areas which need to be investigated further. So, ratio analysis is made under 6 broad categories. What are the 6 broad categories? First category, long-term solvency ratio. Second, short-term solvency ratio. Third, profitability ratio. Fourth, activity ratio. Fifth, operation ratio. And sixth, market test ratio. Now, we are going to see about Negotiable Instrument Act. Okay, Negotiable Instrument Act is one of the oldest laws in this country. Negotiable Instrument Act 1881. So what is this relating to? It is relating to commerce, and it is mainly relating to trade and commerce, and this particular law will enable to facilitate the activities in trade and commerce. What is the source of this law? It is actually the English law. The source of this particular act is the English law. And this particular law is it applicable to whole of India? Yes, it's applicable to whole of India. What is the objective of this act, or the scope of this act, or the preamble of this act? Define. This objective and scope is to define and amend the law relating to three things. What are they? Promissory notes, bill of exchanges, and checks. What is the objective of this act? To define and amend the law relating to promissory notes, bill of exchange, and checks. If you see these three instruments, there is a speciality. Okay, bill of exchange, check, promissory notes. In a way, they are also regulated by RBI to a little extent. Okay, so this particular Negotiable Instrument Act will not affect the RBI Act. If you see promissory notes, or if you see checks, to a limited extent, even RBI Act is affecting them. So what the Act says, even though it is applicable to whole of India, this particular Act will not affect the RBI Act, Reserve Bank of India Act 1934. Okay, and what is the next characteristic feature of this particular act? There is lot of local usage of words used. For example, Hundi, which is being the local Hindi word used in this particular act. Is it allowed? Yes. There are many other native instruments like treasury bills, bearer debentures. They are also considered as negotiable instruments, either by custom or under other enactments. But this particular act is predominantly concentrating on these three areas: promissory notes, bill of exchange, and check. Now, when did this particular act came into force? It came into force on the first day of March 1882. It was passed in 1881. However, it came into force on 1st March 1882 only. Even though it's an old act, because there are some changes which had been made to Banking Regulation Act, and there are some changes made in the Information Technology Act, and there are some changes made in the banking scenarios. So from time to time, NA Act, Negotiable Instrument Act, was also amended. So it was amended in the year 2002, then in 2015, and in 2018. So that is particularly amended because there are some changes in the technological scenario of the country, or there are some changes made in the banking sector, or some other changes were also made from time to time. Therefore, Negotiable Instrument Act was also amended 3 times recently. Now, let's slowly go into the meaning of negotiable instrument. So what is it? Negotiable instrument. Okay. So, first of all, negotiable instrument is an instrument. So what is it? It's an instrument. What is the meaning of instrument? The meaning of instrument means it's a document. Now, what is the characteristic feature of this instrument? This instrument is freely transferable. What is it? It's freely transferable. No restriction to transfer. Why do you transfer it? Maybe due to the customs of trade. from one person to another. Okay, and how do you transfer it? By two methods. Okay, only you transfer it mere delivery, or you endorse it and deliver. So what are the two methods? One is mere delivery, the other is endorsement and delivery. The act is not defining negotiable instrument. However, we try to take the meaning as well. Now, there are three kinds of negotiable instruments specifically provided in this act. What are they? Okay, so the first is a promissory note. Okay, the first is promissory note, also called pro note. Okay, the second is bill of exchange. The third is check. Does that mean only these three are the negotiable instruments? No, there are many other negotiable instruments. However, these three are only specifically covered in this act. Now, there is one section, section 13. It provides for three kinds of instruments: bill of exchange, promissory note, and check, payable either to order or bearer. So there are two modes. One is called payable by bearer or payable by order. We'll learn more about it later on. Okay, so there are two modes. You pay it either to the order or to the bearer. Now, what are the other characteristic features of this negotiable instrument? Okay, point number one. It should be in writing. Clearly, these negotiable instruments should be in writing. So, oral negotiable instruments are not allowed, only written instruments are allowed. It must be signed by the maker. Okay, without signature, this instrument does not have any validity. Then, point number three, freely transferable. So, there is no restriction to transfer it. So, freely transferable from one person to another. Then, how many times can be transferred? Any number of times. You can transfer it any number of times until it is getting satisfied. What is the meaning of satisfaction? Let us plainly tell that it is paid. Until it is paid, you can transfer it for any number of times. Now, the negotiable instrument must either contain a promise or an order. So, either the negotiable instrument might have a promise or it might have an order. Okay, so when it is a promise, you call that as a promissory note. When that negotiable instrument is in the form of a promise, we call it as a promissory note. If it's an order, it might be bill of exchange or a check. Okay, now how does this promise or order should be? It should be unconditional in nature. What does it mean? Can you attach any conditions? No, you can't attach any conditions to this instruments. So whether it is a promise or an order, it must be unconditional in nature. Next one. The promise or order must consist of money only. So when you are dealing with negotiable instrument, you can deal only with money, not in kind. Okay, so money not in kind. So only it consists of money only. Can there be something which is in addition or substitution of money? No, that is not allowed. Money and money only. And the sum payable should be certain in nature. What is the sum you pay under this promissory note or bill of exchange or check should be clear, and it should not be vague in nature. So these are all the characteristic features of negotiable instrument. Now, there are some presumptions with regard to negotiable instruments. So what is this? Presumptions are made with regard to negotiable instruments. What are the presumptions? Okay, so there are 7 presumptions made. So presumption number 1 is with regard to consideration. Okay, presumption number 2 with regard to date. Presumption number 3 with regard to time of acceptance. Presumption number 4 with regard to time of transfer. Then presumption number 5 with regard to order of endorsements. Presumption number 6 is stamps. Presumption number 7 is with regard to holder. Now, what is it? Let us see it each one by one. What is this? First one, consideration. Okay, every negotiable instrument is presumed to be made for consideration. What is the first assumption you make? There is a consideration for each and every instrument. It is presumed that each instrument is made for consideration. Presumption number 2, there is a date. The negotiable instrument has a date. So it is assumed or presumed that the negotiable instrument was drawn on that date. Presumption number 3. This is with regard to time of acceptance. It's applicable only for bill of exchange. Okay. So the bill of exchange, there is a concept called acceptance. Okay. So with regard to bill of exchange, the bill of exchange should be accepted within a reasonable time before the maturity. Then the next is time of transfer. What is it? The transfer should be made before the maturity. Next, order of endorsements. What does it mean? The negotiable instrument can be transferred any number of times and it can be endorsed from one person to another. For example, there is one Mr. A. Can he endorse to B? Yes. Can he further endorse to C? Yes. It goes on. The chain goes on. So, if you just check out the instrument, it appears as A to B, B to C, C to D, etc. So, you presume the first endorser is A, second as B, third as C, fourth as D. This is the presumption you make. The next one is with regard to stamp. Negotiable instrument has a legal validity, therefore, this, whether it is a promissory note or bill of exchange or check, it should have been duly stamped. The holder of negotiable instrument. Holder means a person who has a right to hold the instrument. The holder of the instrument is assumed or presumed to be holder in due course. What is holder? Holder in due course, we'll see it later on. Okay, these are all the presumptions. Can these presumptions are rebuttable? Means, can you contradict these presumptions? Yes. So what we say, the presumptions are rebuttable. What does it mean? You can contradict these presumptions. How? You have to provide proper evidence. So if you are giving evidence, you can contradict all these presumptions. So let us say that there is with regard to date. Okay, the instrument carries one date, but can you contradict it? Yes, provided you give a proper proof for the altered date or contradicting date. Okay, so when you want to rebut it, you can rebut it. However, you have to provide evidence for the same. Now, next topic, we are going to see about promissory note. Okay, so promissory note. So promissory note is being defined in section 4 of Negotiable Instrument Act. Now, what does it say? It says a promissory note is an instrument in writing. So this is the general definition. Okay. Not being a bank note or currency note. Okay, promissory note should not be a bank note or a currency note. Now, what's the difference between bank note and a currency note? Now, bank notes are those notes which are issued by RBI and greater than 1 rupee note. And what about currency note? Currency notes are the 1 rupee notes. issued by Government of India. Okay. So promissory note should not be a bank note or a currency note. Next, we already saw that promissory note should not be conditional. So promissory negotiable instrument should not be conditional. There should not be any conditions attached to negotiable instrument. Yes. So promissory note is unconditional in nature. So it is unconditional undertaking, and it is signed by maker. Who signs the instrument? It's a maker of the instrument. And if you are dealing with it, if you are dealing with promissory note, please ensure that the promissory note should be for a purpose, that is to pay certain sum of money only. Money should be certain in nature. It should not be vague. Now, it can be to the order of a person or to the bearer of the instrument. Typically, in a promissory note, two people are involved. So, one we call as the maker. Okay, maker is the one who makes the promissory note. The other is called payee. So, who is the maker? The maker is a maker of promissory note, one who is promising to pay. So the one who is promising to pay, typically he signs the instrument. Therefore, we call him as a maker. He is also the debtor. Now, there is the other party who gets the money. This party is the creditor, also the payee. So in a promissory note, there are two parties. One is a maker, the other is a payee. The maker signs the instrument and pays, whereas the payee receives the money. One who gets the money, typically the creditor. Now, what are the essential characteristic features of a promissory note? Okay, first, it should be in writing. This is the common point. Negotiable instrument also always should be in writing. So oral promise to pay is not sufficient. And secondly, there must be a promise to pay. Only if there is a promise to pay the other party, it becomes a negotiable instrument, else it's not a negotiable instrument. For example, there is a note where it says, Mr. B, I owe you rupees 1000. Is it valid? No. This is invalid in nature. There is no promise to pay the other party. Okay, it's just an acknowledgement that he is owing money to the other party. So owing money, acknowledgement is not sufficient. There must be a promise to pay. Point number 3, the promise should be definite in nature, and the promise should always be unconditional. What does it mean? The promise to pay should be absolute. There should not be any conditions attached to it. Now, what is it? We'll take an example. I promise to pay B rupees 500 7 days after marriage with C. Why? This is an invalid promissory note. Why? See, the condition over here is marriage. Okay, so marriage may happen or it may not happen. There is an uncertainty involved here. Therefore, you are putting a marriage condition which is uncertain in nature, and hence this is invalid in nature. Whereas there is another promissory note which says, I promise to pay rupees 500 on D's death. This is valid in nature. Why? The death is sure and bound to happen. Therefore, this promissory note is valid. Even though the condition is attached here as death, death is certain. It is bound to happen one day. Therefore, this is a valid promissory note. Next. So next is with regard to signature. See, this is a negotiable instrument. It should be signed. So next point is that promissory note should be signed. Who signs it? The maker of the instrument should sign it. Otherwise, it's incomplete and ineffective. Next, not only that, there must be a promise to pay money only. Okay, it can be only in cash, not in kind. So if there is a promissory note which is involving in kind, it is not a valid promissory note. I promise to pay 500 and deliver my black horse. Is it valid? No. Black horse is not money, therefore it is not valid in nature. Next. The promise should be to pay a certain sum, and the sum must be certain in nature. It must be clear, certain, it must not be vague in nature. Okay, I promise to pay 500 and all other sums which shall be due. It is not certain. What is all other sums which shall be due? You do not know. So it is not certain, therefore this is not valid. Then there are two people involved here. One is the maker, the other is the payee. Can they be both same person? No. They must be certain person, different person, definite persons. Then, very importantly, please note it. Promissory note cannot be made payable to bearer. Why? There cannot be bearer promissory notes. Okay, this is not told in Negotiable Instrument Act, but this is as per RBI Act. What does it say? Promissory note cannot be made payable to bearer. Then, what is the next thing they are telling? Only Reserve Bank of India or central government can issue promissory note payable to bearer, and we call it as the currency note or our rupee note or our bank note, whatever may be. So if you take your bank note, 10 rupee note, it says, I promise to pay the bearer. So what does it mean? Bearer promissory notes are issued only by government, not by individuals. Okay. Next, promissory note must be stamped. There must be stamping should be there in the promissory note. It should be, the stamping must be done in accordance with the Indian Stamp Act. And you have to, across a stamp, there must be the maker's signature or initials or otherwise. So these are all the characteristic features of a promissory note. Now, let's see the specimen of promissory note to understand promissory note in a better manner. Okay, so what do you see in this specimen of promissory note? You see money over here, the amount 10,000 rupees. So what's the amount involved? 10,000. Now there is a place Lucknow and April 10, 2018. April 10, 2018 is the date of this promissory note. And okay, we see two parties involved. Who are all the two parties involved here? The two parties involved are one Mr. Ram, the other one is Ramesh. Okay, two parties are involved here. One Mr. Ram, the other is Ramesh. Now, this is a promissory note. The word promise is important. Okay, so one party is promising the other party. Now, this promissory note is made in April 10th. Now, when should it be paid? It should be paid after 3 months. So, what's the time period over here? 3 months. After date, I promise to pay. So, who is promising? Mr. Ram. So, I refers to Mr. Ram. Ram is promising to pay the other party, Ramesh. Okay, or to his order. This is an order instrument. Okay, so if it is order or to his order, it means that this is a order instrument. Yes, the sum of rupees 10,000 already we have told for value received. So is it certain? Yes, very much certain in nature. Now, who is the maker of this instrument? Ram is the maker of the instrument. Okay, he is the maker of this promissory note. He is promising the other party. Who is the other party? Ramesh is the other party. Ramesh is also called payee. Ram is called the maker, Ramesh is called the payee. So Ram is going to pay Ramesh. Okay. Now, what is the value here? 10,000. Now, here you are also giving the details of Ramesh, his address. Okay. Now, what is it happening? Here, this promissory note should always be stamped. Okay, because it is a legal instrument, this should always be stamped. It stamp must be affixed, and also Ram should sign this instrument. Okay, Ram should sign this instrument as a maker. Now, so this is addressed to Ramesh, done by Ram. So we have seen this promissory note. So what is this? We have seen the place of this instrument, Lucknow. The date, it is April 10. So amount involved is 10,000. How, when is it going to be repaid? 3 months. Okay. Who is the other party who is going to receive? Ramesh, or to the order. How much? 10,000. Is it stamped? Yes, it is stamped. Is it signed? Yes, it is signed. Who is signing it? Mr. Ram is signing it. Who is the payee? Ramesh. You have also given the details of Ramesh. Now, what is a bill of exchange? Okay. Now we come to the next part, bill of exchange. Okay. So what is the first point we saw about bill of exchange? Bill of exchange is an instrument in writing. Yes, first point, it should be in writing, not oral. Second, it's an unconditional order. Okay. Remember, whether it is bill of exchange or promissory note, both are unconditional, but bill of exchange is an order. So that's a point of difference over here. It's an order. Next, it is signed by the maker. The one who signs it is called the maker. Yes, that person will be signing it. Signed by the maker, directing a certain person to pay a certain sum of money only to the order of certain person or bearer of the instrument. It can be either to the order of a person or to the bearer. Okay, this is with regard to bill of exchange. Now, remember in promissory note, you had two parties. But whereas in bill of exchange, you have three parties to this instrument. One is called the drawer. Second is called the drawee. And third is called pay. Okay. So in promissory note, two parties, whereas in bill of exchange, three parties. Who is the drawer of the instrument? It's none other than the maker. Maker of the instrument is the bill of maker of the bill of exchange is a drawer. Now, who is a drawee? The drawee is the person who is directed by the drawer. Drawer orders the drawee to pay. So what is this? He is the person on whom the bill is drawn. So what is drawee? The drawee is the person on whom bill is drawn. So he is directed by the drawer to pay. Now, who is a payee? The person who gets the money. Okay, so who is paid? Who is directed to be paid? Okay, so typically three parties: drawer, drawee, payee. Drawer is the maker, drawee is the person who is directed by the drawer to pay, payee is the person named in the instrument and to whom the money is being paid. Okay, so the one who receives the money in this instrument is called pay. Now, what are the characteristic features of bill of exchange? Again, similar characteristics. First is writing. It should be in writing. Point number 2, this is an order to pay. Remember, bill of exchange is order, not a promise. So this is an order to pay. Order is definite in nature. Order is definite, order is unconditional. Then, who must sign this instrument? It's a drawer. Drawer is the person who signs the instrument. So all negotiable instruments must be signed. Here the drawer is the one who signs it. The sum should be certain in nature. And it must be to pay money only. Then it must be stamped, just like any other condition. Now, what's the last condition here? We'll see about the drawer, drawee, and pay. Okay. See, you have drawer, drawee, and pay. Sometimes the drawer, drawee, and payee may be three different persons. Sometimes they can be, instead of three, there can be two persons as well. Okay, so the drawer, drawee, and payee must be certain. Sometimes they may be three different persons. Sometimes instead of three, there can be two distinct persons. Is that possible? Yes. Okay, when is that happening? Okay, so drawer is one person. Okay, so drawee is one person. Now the drawer of the bill of exchange, okay, and the payee can be one of the same. How is it? Drawee can be one person. Let us say drawer is Mr. X, drawer is Mr. A. So drawee is Mr. X, drawer is Mr. A. So A is the one who is drawing the bill of exchange. On whom? On drawee Mr. X. Now, what does this bill of exchange says? Pay A or order, meaning the drawer is ordering the drawee to pay to himself. So here the payee also is A. So here in this case, drawer and the payee will be the same person. If that be the case, instead of three different persons, there can be two persons only. What is the situation? Drawer of the instrument and payee can be one of the same. Now, specimen bill of exchange. We are going to see about bill of exchange here. Okay, so here in bill of exchange, three parties are involved. In our example, let us see Mr. A is the one of the party. Then similarly, who is the other party involved? The other party involved is Mr. B, and the third party involved is C. So how many parties are involved in this bill of exchange? Three parties. Now, who is a drawer? Drawer is the one who draws the instrument or makes the instrument. Okay, drawer is the one who draws the instrument or makes the instrument. Here Mr. A is a drawer. So what is his address? It is in Bhopal. Now, what is the time? It is, what is the date? April 10th. Okay, April 10th is the date. It is given. It is the date on which the instrument is made. Now, what is the amount involved in this instrument? 10,000. Okay, it is certain in nature. It is clearly given. Now, 4 months after date. So what is the time period after which the money has to be repaid? It is after 4 months. Pay to Mr. B. Okay, so the payee is the one who receives the money. So one who receives the money is called the payee. Who is it here? Mr. B. How much is going to be received? 10,000. So what is it? The one who draws the instrument is called the drawer. He is the one who is signing this instrument, Mr. A. Okay, Mr. A is the one who is signing the instrument. He is called the drawer. Now what is this? Who is going to receive it? Mr. B is going to receive the amount. How much? 10,000. After how many months? After 4 months. Okay, now who is going to pay Mr. B? It is not A. A is only making the instrument. A is not going to pay Mr. B. Instead, it is the drawee who is going to pay Mr. B. Please keep it in mind. A is asking Mr. C. The maker of the instrument is asking Mr. C to pay to B. So A is giving an order to C. So A is ordering C to pay to B. Okay, so A is the one who is the maker of the instrument. He is ordering Mr. C, who is a drawee, to pay 10,000 to B. Okay, so A is the maker, who is a drawer. He is giving an order to Mr. C to pay the money to B. So B is the payee. The one who receives the money is the payee. One who makes the instrument is the drawer. One who is going to pay the money, one who is directed by the drawer, is the drawee. Okay, now here 3 different parties are involved in this instrument. Yes, so typically in a normal bill of exchange 3 different parties are involved, but there are cases where instead of 3, 2 parties are also involved. How is it? Instead of B, it can be A also. Okay, instead of B, it could be A also. So instead of payee, can payee and the drawer be one and the same? Yes, there are possibilities that even the drawer and the payee be one and the same. If that be the case, there could be 2 parties involved. Why bill of exchange is called an unconditional order? Because A is ordering C. A is giving an order to C. Remember, in promissory note, the one who is making the instrument was promising. Here there is no promise at all. It's an order. It's a blanket order from the maker to the drawee. Okay, so this is an order. Bill of exchange is an order. 3 parties are involved. In some cases, instead of 3, 2 parties may be involved. So here, sometimes in the limited situations, even the drawer and the payee might be one and the same. If that be the case, 2 parties are involved. So in some limited cases, the maker of the instrument, that is the drawer, and the payee might be one and the same. Now, what happens? See, we are going to see the differences between promissory note and a bill of exchange. Differences. Okay, what are the difference between the same? First is a definition. Yes, with regard to promissory note, what does that mean? You it? It's an instrument in writing. Yes, an unconditional undertaking. So there is an unconditional undertaking. It is signed by the maker, and it is to be paid to a certain person. Yes. Now, where is a bill of exchange? What happens to a bill of exchange? Bill of exchange is a unconditional order. Okay, so it's an order. Typically 3 people are involved here. Who are they? Drawer, drawee, and payee. Yes. The next difference is nature of instrument. In promissory note, there is a promise to pay. Okay, remember, I promise to pay so and so. Whereas in the bill of exchange, there is an order for payment. Okay, pay A or order, pay B or order, which means there is a order. Parties. In promissory note, there are 2 parties. Who are they? Maker and the payee. Whereas in a bill of exchange, there are 3 parties. Who are they? Drawer, drawee, and pay. Okay. Next, okay, there is something called acceptance. Acceptance comes only in the case of bill of exchange. Why? Because it's an order. You are giving an order to another person, the other person has to accept it. Yes or no? So because it's an order, the concept of acceptance also coming in. So bill of exchange, there is acceptance, whereas no acceptance is required for promissory note. Yes. Next, with regard to bearer instrument, promissory note is cannot be made payable to bearer. Why? Only government reserve bank can do it. Individuals can't do it. Bill of exchange, can it be payable to bearer? Yes, that is possible. So what is it? Bill of exchange can be made payable to bearer. What it cannot be done is, it can't be payable to bearer on demand. Okay, what is can't be done? It can't be made payable to bearer on demand. So let's recall what are the differences. Promissory note is an undertaking, whereas bill of exchange is an order. Promissory note is a promise, bill of exchange is an order. Parties, two parties are there, bill of exchange, three parties. Okay. With regard to bill acceptance, bill of exchange, you require acceptance. No acceptance is required with regard to promissory note. Okay, so what is it? Bill of exchange, you require acceptance. No acceptance for promissory note. Promissory note, you can't make payable to bearer because only government can issue currency notes made payable to bearer. Whereas bill of exchange, yes, it can be payable to bearer, but it cannot be payable to bearer on demand. Now, next we are going to see about check. Okay. So what's a check? Check is also a bill of exchange. It's a type of bill of exchange. But what's the matter with the check? Check is always drawn on a banker. This is the most important point. Check is always drawn on a specified banker. And check is always a demand instrument. It's not a time instrument, it's a demand instrument. So check is a bill of exchange. It's drawn on banker. It is always a demand instrument. And check includes, this is the latest thing, check includes electronic image of a truncated check. Then, and a check in electronic form. Okay, these are all the latest additions. Now, there are two types of instrument, demand instrument and time instrument. Okay, demand instrument means the instrument should be payable whenever the holder is choosing to present it to the banker. What does it mean? On demand, you have to make the payment. Time instrument, you are given a time after which you can make the payment. The banker here includes any person acting as a banker and also includes a post office savings bank. So, who are all the parties to a check? Okay, the parties to a check, we have three parties, just like a bill of exchange. You have a drawer, you have a drawee, you have a pay. Okay, who is the drawer? The one who draws a check. okay, or makes a check. You can also call this person as a debtor. What about the liability? Liability is always primary and conditional in nature. What about drawee? The specific bank on which, the specific bank on whom the check is drawn. Okay, here drawee is always a banker. Next, payee. Who is a payee? The payee is someone who is named in the check. The payee is someone who is named in the check to whom money is paid. Okay, sometimes the payee may be the drawer himself or a third party. So who could be the payee? It could be drawer or third party. Okay, so what are the characteristic features of a check? Check is a specified bill of exchange. It has all the essential characteristics of bill of exchange, drawn on a specified banker, payable on demand. So drawn on a specified banker and payable on demand are the two special features of a check. And this is distinguishing the check from a bill. So what can we conclude? All checks are bills, but all bills are not checks. Now we are going to see the specimen of promissory specimen of a check. Okay, in check there is date. Check should be dated, and then the format says pay, and there is a dash. You can fill it to whom you have to pay. A sum of rupees. Here you have to write it in words. Then there is account number is given. ABC Bank is a drawee bank. Please remember, in a check, the drawee is always a bank. Okay, check drawee is always a bank. This is the bank address in Indore, MP. And then you have, here you have some numbers over here. This is for the control purpose of the bank. Then you have signature. Now, situation number 1. Let's say this is Mr. A. A's check. Okay, so what is this? The one who is making this check is the maker. Okay, let's assume it to be A. Okay, so A is the maker of the check, and he is the one who is going to sign this check. Now, ABC Bank is a drawee bank. What does this mean? A is maintaining his account with ABC Bank. What does this mean? A maintains account with ABC Bank. Okay, so what is this? The money belongs to A. However, bank is only maintaining the same. So A is a drawer or the maker, and drawee is always a banker. So the drawee bank is the bank of the Mr. A. The drawee bank is the bank of the drawer. So A is maintaining account with ABC Bank. So point number 1, in a check, the drawee is always a banker. So the banker, drawee bank is a bank of the drawer. Drawee bank is a bank of the drawer. Now, what can you do here? You want to pay somebody through a check. Okay, you can write the date over here, and similarly pay dash. In this area, you would be giving the name of the person. So scenario number 1, you can tell pay C. Is it allowed? Yes. C is a third party for whom A wants to pay the money. A wants to pay the money to C. Therefore, A is ordering his bank, ABC Bank, to make payment to C. So what is it? A is ordering his bank, ABC Bank, to make payment to C. Why? A has already borrowed money from C. A want to settle C. Therefore, A is ordering his bank, ABC Bank, to pay to C. This is scenario number 1. Or there is a second scenario also being there. Pay instead of C. Can it be paid to self? Yes, that is also allowed. Okay, so what is allowed here? First scenario, you can pay to a third party C. So the drawee bank will make the payment to a third party. Similarly, pay A. Can it be done? Yes. So here what happens? The drawer and the payee are one and the same. Is that possible? Yes, that's also possible. Okay, so what is this? Pay a sum of rupees so and so. Is that allowed? Yes. This type of check is called self check. You pay to self. Okay, so why this happens? Suppose you have lost your debit card. So what do? You want to withdraw money from the bank. So you take a check, pay to self or pay yourself, pay self or pay your name, and so amount is be filled. So this is a self check. In a self check, the drawer and the payee are one of the same. Is it allowed? Yes, very much allowed. Okay, so in a check there are three parties: drawer, drawee, and the payee. Drawee is always a bank, so we call a check to be a modified bill of exchange. Okay, can the drawer and the payee be one and the same? Yes, that's possible in case of a self check. Okay, and the drawee bank is the bank of the drawer. Okay, so drawee bank is a bank where the drawer is maintaining his money. Next, okay, we come to something called acceptance. Okay, what is this? Acceptance. What is acceptance? Acceptance is an indication by drawee of his assent to the order of the drawer. Okay, so acceptance comes only for bill of exchange. Acceptance is not applicable for promissory note. So what is acceptance? It's an indication by the drawee. Okay, so of his assent to the order of the drawer. So technically speaking, what is acceptance? It's a signature. Signature of whom? The drawee, who has signed his assent upon the bill and delivered it. Okay, so acceptance should be always in a written manner. Oral acceptance is not acceptance. So oral acceptance is not acceptance. Here acceptance means only written acceptance. Okay, so signature is more important than the word accepted. Okay, now who are all the people who can accept? Okay, so first one, we know that a drawee of the bill can be the acceptor. So drawee can be the acceptor. Now normally this is what happened, drawee only accepts a bill. So other than the drawee, can somebody else accept it? Yes, if there are more than one drawee, any one of the drawee can accept it. That is also allowed. Now there is a concept called drawee. Okay, in case of need. Okay, what is this? Drawee in case of need. What is the meaning? So when in the bill the name of any person is given in addition to the drawee, then that person has to be resorted in case of need, and this person is called the drawee in case of need. So drawee in case of need, you resort it to that person only in case of need. So when in the bill or in any endorsement, the name of any person is given in addition to the drawee to be resorted in case of need, such person is called drawee in case of need. Okay, he is typically like a guarantor. So normally the drawee is only responsible. Then only when the drawee is not accepting, the other person comes into picture. Now next is called acceptor for honor. Acceptor for honor. Okay, so what is acceptor for honor? The drawee, other than the drawee, somebody else is accepting the bill. Okay, so when a bill of exchange has been dishonored by non-acceptance, any person accept it for honor of the drawer. Okay, any person accept it for honor of the drawer or any other endorser, the person is called acceptor for honor. So acceptor for honor is other than the drawee. Okay, he is not a drawee, but he is a person other than the drawee. Okay, so he is accepting it for the honor of any of the persons. Now can he make payment? Yes. Okay, if he makes payment, it is called payment for honor. When he accepts, it is called acceptor for honor. When he make payment, it's called payment for honor. Okay, so what is it meaning? It's an undertaking by a third party to accept and pay a bill of exchange. Okay, and that person also makes payment. So when he is making payment, it is called payment for honor, and when he is accepting, it is acceptor for honor. So when there is an acceptor for honor, is he the drawee? No. So typically, if this is the case, remember, there is a drawer, there is a drawee, there is a payee. Yes. Now the drawee is not accepting, it is accepted by the third person who is the acceptor for honor. So this is a typical case where there are 4 different parties are involved in the bill of exchange. Okay, so is this also possible? Yes. So what is this? When a drawee is not accepting the bill, somebody else is accepting, and that person is accepting for the honor, and you call that person as acceptor for honor. Payment he makes is called payment for honor. So here in this case, 4 different parties are involved. So remember, in bill of exchange, can there be 3 parties? Yes. Can there be 2 parties? Yes. One party play the role of 2. Can there be 4 parties? Yes. When the drawee is not the acceptor. Now, we are going to see some important points with regard to holder and holder in due course. Okay. Who is a holder? So this holder concept comes in promissory note, bill of exchange, as well as in check. Okay. So first is holder could be any person. Any person could be a holder. And literally it means the owner of the instrument. Okay. So holder typically means the owner of the instrument. What is the important point to be noted? The holder should have a right to possess. What is this? Right to possess. Holder should have a right to possess. Now, the person is possessing the instrument without having a right to possess. Can you call that person as a holder? No. So, holder could be any person. Normally speaking, it's a owner. What is important is a right to possess. If the person is possessing the instrument without the right to possess, it is not a holder. Now, let me give you another example. There is a thief who steals the instrument. Can you call this thief as a holder? No. Why? He does not have the right to possess the instrument. So, this thief is stealing the instrument and holding the instrument. Can you call him as a holder? No. Why? The thief does not have the right to possess the instrument. Therefore, the thief is not a holder. Now, if a person is finding the instrument somewhere, what is the duty of the finder? Finder has a right to return the instrument to the original owner. So whoever finds the instrument has to return the instrument to the original owner. The person does not have the right to possess the same. So what are the other rights of a holder? Okay, we know that the holder has a right to possess the instrument. So first is the holder has a right to possess the instrument. Yes. Similarly, can the holder receive money on the instrument? Yes. The holder has a right to receive the money. Okay. This is also the right. So right to possess, right to receive the money. Next, we'll see one more concept, a closely linked concept, which is called holder in due course, HIDC. Okay, so what is HIDC? Holder in due course. It's a modified form of holder. Okay, holder in due course. Holder in due course has got more benefits than holder. Okay, typically speaking, a holder in due course is also a holder but with more benefits. A holder who has more benefits is called a holder in due course. So holder in due course means a typical holder but with more benefits. Why he is getting more benefits than a holder, normal holder? Okay, holder in due course has got an instrument for consideration. Okay, he has paid for the instrument. Therefore, he is called a holder in due course. So, first is consideration. Second, he had acquired the instrument before maturity. He had acquired the instrument before maturity. Third, he has obtained the instrument in good faith. So, what are the 3 points? He has obtained the instrument for consideration before maturity and in good faith. The instrument should be regular, complete in nature, and things. So, okay, so what are the 3 points? Holder in due course has obtained the instrument for consideration before maturity in good faith. Such an instrument must be complete and regular. Now, remember, let's recall the rights of a holder. Holder has a right to possess the instrument, right to receive the instrument. Now, there is an important difference between holder and holder in due course. Okay, with regard to the rights. Holder typically does not have a right to sue. No right to sue. Okay, whereas holder in due course has a right to sue. Okay, so holder does not have any right to sue, whereas holder in due course has a right to sue. Why is this difference? Remember, holder in due course has got the instrument for consideration in good faith before maturity. Because these 3 points are extra there for a holder in due course, he has got a right to sue. Whereas holder has not got the instrument for consideration, therefore he has no right to sue. Okay, because holder in due course has got it for consideration in good faith before maturity, he gets good title. He gets good title. Therefore, holder in due course has a right to sue, whereas holder does not have right to sue. Now, who else could be the holder and who could be holder in due course? Remember, holder in due course. Who are all the person who could be called as a holder in due course? Now, holder in due course might be either the payee of the instrument, or it could be the possessor of the instrument, or the endorsee of the instrument. Okay, so who could be holder in due course? It could be the payee, or it could be the possessor, or it could be the endorsee. So this is with regard to holder and holder in due course. Now we are going to see the classification of negotiable instrument. Okay, now depending upon the persons, we can classify whether it is a bearer instrument or it's a order instrument. Okay, now what's a bearer instrument? Okay, bearer instrument is an instrument where name of the payee is blank. Okay, first is name of the payee is blank, or the name of the payee is specified with the words or bearer. Okay, or third situation, the endorsement is in blank. The last endorsement should be in blank. So 3 situations where the instrument could be called as a bearer instrument. What is this? Name of the payee is blank, or the name of payee is specified with the word bearer, or the last endorsement is blank. Now, what is the other feature of a bearer instrument? How do you negotiate such a bearer instrument? Bearer instrument is always negotiated by a mere delivery. Now, come to the next one, which is called order instrument. Okay, first point, what is that you talk? In an order instrument, the instrument is payable to a particular person or payable to a person or his order. So we say pay A or order. So to his order. Third, or payable to order of a person, or last endorsement is filled. Okay, it is not blank, the last endorsement is filled. Now, how could such order instrument be negotiated? The order instrument is negotiated by endorsement and delivery. Not merely an delivery, it is endorsement and delivery. Now come to the next classification, next type of classification. Okay, so we can classify the instruments either as an inland instrument or a foreign instrument. Okay, now inland instrument. Okay, what's an inland instrument? Now, inland instrument is a instrument. It could be a bill of exchange or a promissory note or a check. Okay, it is, first point, drawn or made in India. Okay, drawn or made in India. Point number 2, and it's payable, it's made payable or drawn upon a person who is resident in India. Okay, so what is this? Inland instrument could be a bill of exchange or a promissory note or a check, drawn or made in India, and made payable or drawn upon person resident in India. Now, what's a foreign instrument? Okay, what's a foreign instrument? Okay, foreign instrument is, it could be a bill of exchange or it could be a promissory note or a check, and what are the points here? It is not drawn in India, or it is not made in India, or it is not made payable in India. Okay, so what are the possibilities of a foreign bill? First one, bill is drawn outside India. And made payable upon any person in any country outside India. Point number 2, bill drawn outside India but payable in India. Drawn upon person resident in India. That is also foreign bill. Next, bill is drawn in India. Made payable outside India. Or drawn upon resident outside India. Not payable in India. So that is foreign bill. So what is this? So we can know some criteria for inland bill. We can also know some criterion for foreign bills. Now, why should we know whether it is a foreign bill or an inland bill? With regard to a dishonor of a foreign bill, there are stringent actions to be taken. More regulations will be coming into picture. That is why we should know whether it is a inland bill or a foreign bill. Next type. Whether it is a demand instrument or whether it is a time instrument. Now, what's a demand instrument? So, in demand instrument, what are the things which should be coming into picture? A promissory note or bill of exchange. Checks are always demand instrument. Okay, checks are always demand instrument. So we are giving the criteria for promissory note or bill of exchange. A promissory note or bill of exchange in which no time is mentioned. No time is mentioned is payable on demand. So what is this? Promissory note or bill of exchange in which no time is payable, no time for payment is mentioned, is always payable on demand. Now what happens to a check? Check is always a demand instrument. Okay, check is always a demand instrument, whereas a promissory note or bill of exchange in which no time is mentioned is payable on demand. Now next is time instrument. What is the next one? Time instrument. What is a time instrument? It could be a bill or it could be a promissory note. We know that check is always a demand instrument. Okay, now what is a time instrument? It's a bill or a note which is payable after a fixed period. So what is the first one? Time instrument is payable after fixed period or after sight or on a specified date or on a specified date or on the happening of an event which is certain to happen, then you call it as a time instrument. So what comes under time instrument? A bill of exchange or a promissory note. Why? Check is always a demand instrument. So a bill or note which is payable after fixed period or after sight or on a specified date or on the happening of an event which is certain to happen. Please note it, the word used here is called after sight. Okay, why? If it is at sight, it becomes a demand instrument. If the word used is called at sight, then it becomes a demand instrument. So a bill or a promissory note is payable on demand when it is called at sight. Okay, now we use the word at presentment, then also it becomes a demand instrument. Okay, so at sight, at presentment, then the instrument becomes a demand instrument. If it is after an event or after sight, then it becomes a time instrument. So on demand instrument, we see the words at sight or at presentment. Okay. Now let's go to the questions. Question number 1. Explain the essentials of a promissory note. State giving reasons whether the following instruments are valid promissory notes. So what is this? X promised to pay Y, a promissory note, a sum of 5,000 15 days after the death of B. Question number 2. X promised to pay Y, a promissory note, by a promissory note, 5,000 and all other sums which shall be due. Now, what are the points we have to keep it in mind? First question, X promising to Y, pay Y. Yes, it's a promissory note. Now, what is the amount? 5,000. Is it certain? Yes. When is it to be paid? 15 days after the death of B. Remember, in a promissory note, there should not be any conditions. Okay, you cannot have any conditions. However, there is a condition attached here. This is called the death of B. Okay, normally if a condition is being attached to a promissory note, it is not valid in nature. However, in the first case, the condition attached is the death of a person. Okay, even though death is a condition which is being attached in this promissory note, death is bound to happen. Death is surely will happen, certainly will happen. Therefore, this is a valid note. Okay, with regard to a promissory note, you cannot have any conditions. However, there is only one condition allowed, that is called the death. Why? Death is certain in nature. So in case number 1, payment is made in 15 days, though the date of death is uncertain, we shall die. It is certain. Therefore, the instrument is valid. In case number 2, X is promising to pay Y by a promissory note 5,000 and all other sums which shall be due. Remember, one of the important point with regard to promissory note is that it must be certain in nature. However, what does this word says? 5,000 and all other sums, meaning this is the amount to be paid is uncertain in nature. Why? We don't know what is all other sums which shall be due. Therefore, in the second case, because the word all other sums is being used, all other sums is used and we do not know about the same, the amount is uncertain in nature. So sum payable is not certain, therefore it is not a valid one. Okay. Question number 2. What is question number 2? Examine the validity of the promissory note IOU. Okay, IOU sum of 1,000. A tells B. Question number 2. X promises to pay Y a sum of 10,000 6 months after Y's marriage with Z. Now, in condition number 1, this is a mere acknowledgement. Okay, so what is a condition for a promissory note? There must be a promise. Is this a promise? No, this is a mere acknowledgement. Therefore, this is not valid in nature. Point number 2, X is promising to pay Y a sum of 10,000 6 months after Y's marriage with Z. Meaning, marriage is a condition attached in this instrument. Yes, what is the only condition which is allowed in a promissory note? That is the death. But here it is marriage, which may or may not happen, which means there is an uncertainty. Yes, so is it valid? Not valid. Okay, so first case, what they are telling, it's not a promissory note because there is no promise to pay. In the second case also, it's not a promise note because marriage is the condition which is being attached. We don't know whether it may happen or may not happen. So death, it is sure, but marriage, it is not sure. Next is with regard to holder. Okay, who is holder in due course? How is different from holder? Remember, holder and holder in due course are two different concepts. What is the difference? Okay, remember, holder in due course, he possesses the instrument for consideration. Holder will possess the instrument even without consideration. So holder in due course, when he possesses it, there must be a consideration involved. This is must. However, for holder, he may possess the instrument even without consideration. Then, second, holder in due course possess the instrument before maturity. Okay, holder in due course against a holder must become the possessor before the amount becomes payable. Meaning, second condition is before maturity. Okay, this is a second condition for holder in due course, which is not there in holder. Third, holder in due course must have become the payee of the instrument in good faith. Third is important condition for holder in due course is that he becomes the payee in good faith. Holder in due course must have become the payee in good faith. Okay, that is important condition. Question number 4. What are the essentials of a promissory note? What are the whether the following notes may be considered as valid promissory note? We know the essentials. It must be in writing. There must be two parties, and there must be a promise to pay. Okay, it cannot be in kind. It should be in money only. All those things. Here, first one. I promise to pay 5,000 or 7,000, meaning the amount is uncertain. Amount should be certainly certain. It should be certain in nature with regard to promissory note. However, here it is uncertain in nature. Therefore, it is not a valid promissory note. In question number 2, I promise to pay to Mohan 500 if he secures 60% marks, meaning here condition is attached. Okay, we can attach a only condition, that the only allowed condition to be attached is death, but here it is linking to marks. Therefore, this is not valid. So first case also not valid, second case not valid. Third, I promise to pay 3,000 to Ravi after 15 days of the death of A. Death is sure, bound to happen. Therefore, even if it is given as a condition, this is valid in nature. So third one alone is valid because death is certain even if the time of death is not uncertain. Next, We have to find out whether the following cases, whether the person is a holder or not. Okay, holder is typically the owner who has a right to possess the instrument. That has to be kept in mind. So first one, X who is obtaining check drawn by Y way of gift. So in gift, there is no consideration involved. However, X is giving it to Y. So whether Y has a right to retain it? Yes. Right to get the amount? Yes. So can we call the person who has it as a holder? Yes. X can be termed as a holder because right to possession is there, right to receive the amount is also there. Second, A is the payee of a check who is prohibited by a court. What does it mean? A cannot receive the money. Cannot receive the money because of a court order. Therefore, he is prevented from receiving the money. So is he a holder? Is he having a right to receive the money? No. He is not a holder because he does not have the right to receive the amount. So holder must be entitled not only to possession but also to receive the amount. Here, the person does not have the right to receive the amount. Third, M who finds a check payable to bearer on the roadside and retains it. Remember, he does not possess that particular check. No, he does not have a right to possess that check. Why? He is taking somebody else's check and keeping it with himself. So does he have the right to possess it? No. Okay, he is not a holder because he is not entitled to possession, meaning he does not have a right to possess. Next, B, the agent of C is entrusted with an instrument without endorsement by C, who is a payee. What does it mean? Agent, here the agent is involved. Agent is doing on behalf of the principal. He may receive the amount, but he is not a holder because he has no right to sue. Next, B, who is stealing the blank check and forging A's signature. So stealing it just because you have the check does not make you a holder. You should have the right to possess the check. Do you have the right to possess the check? No. It is being stolen. Therefore, he is in wrongful possession and he is not a holder. Now, pick out the correct answer from the following and give the reason. P obtains a check drawn by M by way of gift. So what is it? No consideration is involved, but it is rightful possession. So is he holder in due course or holder of for value or holder or none of the above? We can just say that the person is holder. Why? No consideration. Okay, he can be termed as a holder because he has a right to possession and to receive the amount in his own name. Why he is not called as holder in due course? Why he is not called as a holder in due course? Because no consideration is involved. This is just a gift. Now, one of the very interesting features of the checks in India is check truncation system called CTS. It's a very recent phenomenon and it is very unique to India. And India is one of the successful countries which have implemented CTS. What is CTS? Check truncation system. What does it mean? The check gets truncated. The term used is called truncation. So what do we say? We say the check is truncated. Now, what is the meaning of truncation? So next is, what is truncation? Now, truncation is a process of stopping the flow of physical check. So you are restricting the further movement of a physical check issued by a drawer to the drawee branch. So what happens to that instrument, physical instrument? The physical instrument check will be truncated at some point. We say the physical instrument check is truncated at some point en route to the drawee branch. And what will happen when the check is truncated? Electronic image of the check is transferred. So when the physical movement is restricted, what is allowed is called the electronic image of the check. So you are restricting the movement of physical movement of the check. However, what does the bank do? The bank is capturing the electronic image of the check. That would be sent to whom? Electronic image of the check is sent to the drawee branch. Now, when we send the electronic image, what are the other relevant information which are required? You give the details of MICR field, then you give the details of date of presentation of check. You also give details of the presenting bank, etc. Now, what happens to the physical movement of the check? The physical movement of the check is restricted. So, physical movement of the check is not required. But in some exceptional situations, when you have a doubt regarding the electronic image, you can use the physical movement of a check. So, only when there is an exceptional situation, the physical movement of check would be allowed. Otherwise, it is not allowed. So, what are the benefits of this truncation process? Because of this truncation process, time required for payment of check is reduced. So, time is getting reduced because of this process. Why? Instead of physical movement, you are replacing it with the electronic image. Therefore, the time gets saved. Then, not only that, the cost of transit is reduced. Cost of transit, when there is a physical movement, it involves huge cost, so cost of transit is reduced, and delay in processing of the checks by the banker is also reduced. So what happens to the process of collection? Ultimately, it gets speed up because of this truncation process. What are the other benefits of this particular system? Because of this particular system, your customer service gets improved and reconciliation problem is highly reduced. Reconciliation problems are also highly reduced. Then logistics problems are curbed because of this electronic image. Now, what about the security? This check truncation is more secure system than the physical documents. That is the next one. More secure in nature comparing to the physical movement of check. So, it is very important efficiency enhancement initiative in the payment system area. Now, what is the process of this image transmission? That is the next step. See, where is the image is being generated and that is being transmitted. Now, where is this image first captured? It is first captured in the presenting bank of the customer. Presenting bank only it is first captured. Second step, after that, where does the image being transmitted? The image is thereafter transmitted to the clearing house. Then thirdly, from the clearing house to the drawee bank. So from the presenting bank to the clearing house and then to the drawee bank. Now digital signatures also would be sent along with this. So instead of the normal signature, it is digital signatures are also transmitted. So each image would be carrying the digital signature apart from the physical endorsement. Now, when the image is being electronically transmitted, what is important to be noted? The important aspect to be noted is the quality of the image. So very importantly, you have to look into the quality of the image. Because all the numbers are very important, the numbers should be clear and legible in nature. So quality is very much important with regard to the image. So in order to check the quality of the image, what is necessary is a quality check process. Whether it is adhering to the quality guidelines or not will be checked. So where it will be checked? It will be checked at the clearinghouse interface. Now what are the additional safeguards you can adopt it? They can also adopt holograms, barcodings and other features. Now to ensure safety, one more system is implemented. It is called safety and non-repudiation of PKI. What is PKI? Public key infrastructure is implemented across the system. So what will happen if you implement this system? The bank will send the captured image and data to the clearing house and thereafter to the drawee bank. So there is a specific software, that specific software called the clearing house interface. So what will the clearing house do? The clearing house is processing the data and arriving at the settlement figure and send the required data to the drawee bank. So there are some banks who are all could participate in this check truncation system. First, they should have a membership of the clearing house. So first of all, the bank should have the membership of the clearing house. Necessary requisite. Second requisite, members of the Indian financial network, that is Infinite. Secondly, the bank should have the Infinite membership. Now, next is with regard to the quality. How will the images be captured and what is the quality? Quality of images. Now, the check images can be of three types. What are they? It could be black and white. First option. Secondly, it could be gray. Thirdly, it could be color. So there are three options for the images. Either it could be black and white or gray or it could be color. Now, what is the drawback of using black and white images? If black and white images are used, they do not reveal the subtle features because the numbers get blurred and it is difficult to see the very little subtle features. So colored images can be a substitute for the same. But what is the problem if you use a colored image? If you are using colored image, it increases the storage and network bandwidth requirements. So mostly electronic images of truncated checks are in grayscale technology, in the intermediate technology. Now what is that next step? You will also have to ensure the quality of the image. RBI specifies the image standards and the presenting bank has to perform the quality audit. The drawee bank, can they ask for physical instrument? Yes, they might ask for physical instrument if they are not satisfied about the image quality for payment processing. So what will happen to the physical instrument? So what will happen to the physical instrument? That is a physical check. Physical instruments has to be warehoused, stored. By whom? By the presenting bank. So for a prescribed period, the presenting bank has to warehouse the physical instrument. So if a customer wants the paper check back, can they get it? Yes, they may get it. So in case the customer desires to get the paper instrument back, then the instrument can be sourced from the presenting bank. So the physical instruments cannot be thrown away just like that. It has to be preserved for a specified period of time. Now, what is it they are talking of check? Check includes check in electronic form. Check includes check in electronic form. What is the meaning of check in the electronic form? Point number one, it is a check drawn in electronic form by using any computer resource. So you draw it by using a computer. And you are signing it using a secure system. And signing it in a secure system. Now, how do you sign it? With a digital signature. digital signature. Now, the digital signature could be with biometric signature or without biometric signature also. And asymmetric crypto system. Asymmetric crypto system. Or electronic signature as a case may be. Now we are seeing lot of new expressions here. What are they? Asymmetric crypto system, computer resource, digital signature, electronic form, electronic signature, etc. Now these are the terms which are included in this definition of check in the electronic form. So this particular definition has come because banking has undergone lot of technology changes. Because banking has undergone lot of technological changes, electronic form check is being allowed. Now, the digital signature and other related jargons are not defined in Banking Regulation Act, but instead these meanings are taken from the Information Technology Act, IT Act 2000. So, digital signature, asymmetric crypto system, digital signature, computer resource, all these have the meanings as given as per Information Technology Act 2000. Now, next, we also are going to see a new concept which is called payment in due course. What is this? Payment in due course. So, payment in due course is a new concept. In short, it could be called PDC or PIDC. Already we have studied about holder and holder in due course. Now we are going to see payment in due course. What is payment in due course? Point number one, it is a payment made in accordance with apparent tenor. Apparent tenor of the instrument. So first point is the payment is made in accordance with apparent tenor of the instrument. Second, it is a payment made in good faith. Third point, the payment is made without negligence to any person. In possession thereof. Under circumstances which do not afford a reasonable ground for believing that he is not entitled to receive payment of the amount therein mentioned. So this is called the definition of payment in due course. What is a detailed explanation of the same? We'll be seeing it. Now, let me give you an example to make you understand what is a payment in due course. Now, we are going to see about payment in due course or PDC or PIDC. Let's take, for example, a check. Okay, pay A. Okay, so the amount has been left blank, and the one who wants to pay it is Mr. B. Okay, so the bank is SBI. Mr. B is maintaining his account with the SBI. Therefore, he has given a check, SBI check, and he want to pay Mr. A. Now, the amount he wants to pay A is 1000 rupees. 1000 rupees. And what happens? He is inserting 1000 over here. But he fails to write the 1000 rupees in words. Now, Mr. B wants to pay A 1000 rupees and therefore he is giving a check for 1000 rupees. The banker is SBI. Now, what happens if one more zero is added to this particular check? Will a normal person of normal intelligence be able to detect the difference? Not at all. So what happens if the one more zero is being added? Can a normal banker identify it? No. So is it apparent, the addition of one more zero, is it apparent for the banker to detect it? No. Now, if SBI is making payment for 10,000 rupees, later on, can Mr. B come and blame his banker SBI? No, you can't blame SBI. Why? It is done in accordance with the apparent tenor. And it is done in good faith without negligence by the banker. So banker has done in accordance with the apparent tenor, in good faith and without negligence. So SBI is getting protected here. SBI does not know whether the actual amount intended is 1,000 or 10,000 because the words are absent here. Now, so if it is in due course, SBI is getting protected. Now, situation number 2. Here, the check is Mr. B's check. He want to pay A. B's banker is SBI. Now, B is inserting his signature over here. What if the signature is unclear? What happens if the signature is unclear? Should the bank go ahead with the payment? No. If the signature is not clear, then bank should not proceed with the payment. So bank should have taken care and should not clear the check. So if the banker is clearing the check, then we say banker has acted negligently. So what are the points we saw? When can you say the payment in due course? When it is made in accordance to the apparent tenor, in good faith and without negligence, the banker is protected. We say that the payment is in due course. However, if there is something wrong and it is very much clear that there is some kind of discrepancy, should the banker go ahead with the check? No. If the banker is acting negligently, then banker is liable. Now let us see some more instances. Instance number 1. There is a payment of a post-dated check. Post-dated check is called PDC. Now, let us say the check is bearing a date of 20th July. So, it is a payment of a post-dated check. It is bearing a date on 20th July. However, it is paid earlier on 15th July. Second instance. There is a check bearing crossing in the name of SBI, State Bank of India. However, it is paid to when presented by Bank of India. Third instance. A check the payment of which was already stopped by the drawer. Is paid when presented. So these are all the 3 instances, some examples where payment of the check is not a payment in due course. So these are all 3 instances, 3 examples where the payment of check is not a payment in due course. Now, next we are going to see a concept of negotiation. So negotiation is a concept which is there with regard to negotiable instruments. So negotiation and transferring is not one and the same. So what is the meaning of negotiation? When a negotiable instrument is transferred to any person to make that person the holder thereof, we say that the instrument is negotiated. Now, whether transferability and negotiation, are they one and the same? No. Transferability and negotiation are not one and the same. They both are different concepts. Let's keep that in mind. What happens in the case of transferability? So in transferability, one person transfers the goods or things to another person. Now, so what happens in a transfer? The transferer cannot pass better title than what he has. So this is with regard to transferability. Now, what happens in negotiation? Now, what happens in a negotiation? The transferee can get better title than transferor. What does this mean? So in normal transferability, the transferee's title depends on the transferor's title. So what do we say in transferability? There are two persons. A has transferred his things or goods to B. So we say that in a normal transfer, B's title depends on A. So if A has defective title, then B also has defective title. So if A has defective title, then B also has defective title. Now what happens in negotiation? A has negotiated an instrument with B. As per Negotiable Instrument Act, when B is not aware of the A's position, B is not aware of the background of A, and B has taken the instrument in good faith for value and before the due date, then B, the transferee, gets good title, better title than A. So what is that they are telling? There is a difference between transferability and negotiation. In normal transfer, the transferee's title depends upon A. So if A has defective title, B has also defective title. For example, let us go further deep into transfer concept. If A sells a TV set to B, A sells a TV set to B. Now, actually, the TV set is a stolen TV set, meaning A has stolen from somebody and he has sold it to B. Now, B is purchasing the price to A. So, A has stolen from someone, B is purchasing it in good faith, and B has paid the price to A. No, B is not aware that it is being stolen one. Now, for example, there is C. C is the owner of the original TV set, and it is proven to be that C is the owner. Then what happens? B should return the TV set to the true owner. So B should return the TV set to the true owner even though he has purchased from A. However, he can claim damages from A. That is another issue. Now what happens here in negotiability? A check where B was not aware that A had taken it by wrong means. However, B had taken the check from A for consideration in good faith before the due date, and without having knowledge of the defect in the title, B can have better title than A, even though there is a defect in the check. So what is that they are telling? In negotiation. You can get a better title than the transferor. So transferee can get a better title than transferor. Next, endorsement. What's the meaning of endorsement? Endorsement is also sometimes called endorsement. There are two parties here in endorsement. Now, what does it say? There is a maker of a negotiable instrument or a holder, maker or holder. So one who makes the instrument or one who has a right to hold the instrument. We are talking about that person. So what does the maker or the holder do? The maker or the holder sign the instrument other than as a maker. For what? For the purpose of negotiation. Merely for the purpose of negotiation. Where do they sign it? They have been given three options. Okay. Signature, where can they sign it? They can either sign on the back of the instrument or they can sign on the face of the instrument, or they can also sign on a slip of paper annexed. The slip of paper attached is called a launch. Now, when this is being done, we say that the party has endorsed the same, and the person is also called as endorser or endorser. Now, what happens if the endorser is signing his name only the name alone? We say that the endorsement is a blank endorsement. Second, he is also adding a direction to pay the amount mentioned or to the order of a specified person. So when he is just signing his name, it is just a blank instrument. However, he is specifying a specified person to whom it is to be paid. So he is giving the name of a specified person. Then the endorsement is said to be full. Endorsement in full. So the person specified is an endorsee. The one who is endorsing is called the endorser. The person so specified is an endorsee. What are the other types of endorsements? Point number 1. So other types of endorsement in addition to blank or full endorsement is first is conditional endorsement. Second, restrictive endorsement. Third, sans recourse endorsement. Fourth, facultative endorsement. These are all some of the types, other types of endorsements. Now, we are going to see something called material alteration. Material alteration. So what does negotiable instrument says? The negotiable instrument should not be altered. And if there is a material alteration, remember, not every alteration is the same. Some alterations are serious, whereas some alterations are not. Now we are talking only about material alteration. What will happen if there is a material alteration to a negotiable instrument like a check? The check becomes void. You cannot alter a check because it's a negotiable instrument. So the material alteration makes the instrument void. Why they say it makes an instrument void? Because you don't get the consent of the other party. So without getting the consent of the other party, if you make a change to the instrument, it makes the instrument void. So material alteration renders the same void. Okay, because other party does not consent to the change. So what will happen if one of the party is making the material alteration, the other party will be discharged from the liability. Now, we have to come to the next point, that the alteration should be material. So materiality is a very important concept with regard to this alteration. So what is called a material alteration? Can every alteration be called material? No. So point number 1, when do you call an alteration of a negotiable instrument as material alteration? So point number 1 is the alteration is material if it alters the operation of the instrument. And secondly, it should affect the liability of the parties. So if the alteration is material, what does it do? It alters the business effect of the instrument for any business purpose. And because of the alteration, the outlook of the instrument gets changed. Okay, because of which we can call the alteration as material alteration. Now, there are some specific examples of material alteration. There are some case laws which has specifically quoted some instances as material alteration. Example number 1. When do you call there is a material alteration? When there is an alteration of date. When the date gets changed. What does it mean? When the time of payment is accelerated or postponed, then we can call it as a material alteration. Second, with regard to other negotiable instrument, when there is an alteration of rate of interest. Third, when there is an alteration of sum payable, meaning what? The check is for 500 rupees. So instead of that, you add one more zero. You alter it as 5,000 rupees. What happened here? The sum gets altered. So it is a serious thing. So we say that it is a material alteration. Next, alteration in the time of payment with regard to bills and others. Alteration with regard to the place of payment, where it should be paid. Then, if you are making some changes in the parties, then we call it as a alteration, material alteration. Then, you are tearing the part of the instrument which is very crucial. So, you are tearing material part of the instrument. Very important part of the instrument is torn. Tearing material part of the instrument. So, what the instrument is materially altered. With regard to bills, you are altering by increasing or affixing the stamps. Stamps get, because of stamp, we are changing the instrument. Now, with regard to check, alteration by the erasure of account payee crossing. Account payee crossing is being erased. So, what happens? Is it material alteration? Yes. Then, converting an order check to a bearer check. You are converting an order check to bearer check. Material alteration. Now, there are some instances where you call it as alterations, but still not affecting the liability. Not affecting the liability. Even though there is changes, but does not affect the liability of the parties. What are they? Point number 1. Alteration is unintentional. Alteration is unintentional and due to pure accident. Meaning what? Somebody was shaking, therefore your pen scribbled. So what happens? Alteration is unintentional. Now, alteration is made by a total stranger without the concern, but however, there is no intention of fraud. Now, there is alteration to correct a clerical mistake. Meaning what? See, when you are writing the date, you wrongly wrote the year as 2010 instead of 2020. Meaning what? 2010 has long gone past. So there is a clerical error. So if there is an alteration made to correct a clerical error, then you can correct the mistake. The correction is giving the original intention of the parties. So can you give some wrong intention for the correction? No. Now, if the alteration is to carry out the common intention of the parties, both the parties have agreed and it is the intention of the parties, no wrong intention is there. So it is permitted. Then you are making a correction with the consent of the parties, both the parties agreeing to the same. Then it is very much allowed. Then alteration which is not at all material, we know that it does not affect the instrument at all. Now, explicitly they have allowed some alterations. What are they? Some alterations are permitted to be done. What are they? Point number 1. See, the incomplete instrument is given by one person to another. If incomplete instrument is given, the intention is just to fill up the instrument. So in case of incomplete instrument, the intention is just to fill up the instrument. Second, enabling the holder to convert a blank instrument into a full instrument. So blank instrument is converted into a full instrument. Is there anything wrong? No. Third, uncrossed check. Uncrossed check is converted into a crossed check. So you do a general crossing or you do a special crossing or make it a non-negotiable crossing. This alteration is permitted. And the alteration should be apparent on the face of the instrument. Now, we are going to see a topic called crossing of checks. So crossing of checks, it's very important. So let's understand it one by one. So checks are of two types. One, it is called open check. The other is called crossed check. What is the difference between the both? Now, what is an open check? Open check is a check which can be presented only to the banker and can be paid at the counter of the bank. Very important. So, a open check is paid at the counter of the bank. So, this is a little risky kind of check. Why? Anybody can get the payment across the counter. Now, let us assume that the person has lost an open check. Somebody is finding it and they may go to the bank and they may get the payment. So there is a huge risk involved here. Then the finder may also transfer it to somebody else. So open checks are highly risky in nature. There are huge losses waiting if a person gives an open check. So, in order to prevent the loss incurred by open checks getting into the hands of wrong person, concept called crossing of check came. Now, what is meaning crossing of check? When you say that a check is crossed or the crossing of check has happened, we say that the check is bearing across its face two parallel lines. The lines are two parallel transverse lines. Now the check is said to be crossed. Now where do this crossing happens? This crossing usually happens at the left corner of the left and top corner of the check. Left and top corner of the check, you may normally find the crossing. But can this crossing be drawn anywhere across the check? Yes, but mostly left hand corner is preferred. Can you cross it anywhere else? Yes. Now let us come to the topic. What is the meaning of crossing? What is the meaning of crossing of a check? Crossing means instruction. Crossing of a check means instruction. Instruction to whom? To the drawee. So typically in a bank check, the drawee is always a bank. So it is check means, and crossing of a check means an instruction to the drawee bank. What is the instruction? The instruction is payment should not be made at the counter. Now, crossing of a check means, what is that? You are giving an instruction that the payment should not be made at the counter. Now, how should the payment be made? It should be made through a bank. It should be made through a bank. So you cannot make the payment across a counter. However, you can make the payment through a bank. Now, what is the objects of crossing? Now, crossing is said to be a warning to the bank. Warning to the bank not to make payment over the counter. So it's a caution to the banker. Now, what happens when a check gets crossed? Point number 1. Crossing affects the mode of check. What affects? Crossing affects the mode of check. So what happens to an open check? Open check or uncrossed check is payable to the payee or holder at the counter of the bank. Now, what happens if the wrong person takes away the payment? It is difficult to trace it. So, payment of a cross check, however, can happen only through a banker. So, crossing is a mode of assuring that only the rightful holder gets a payment. Now, point number 2. Crossing does not affect the transferability or negotiability of the check. What is it? Crossing does not affect the transferability or the negotiability of the check. Now, the cross check, can it be negotiated? Yes. Crossed check can be negotiated, no problem. It does not affect the negotiation. So, cross check can be negotiated, just like an open check. So, what will happen if a person gets a cross check in good faith? He becomes a holder in due course. Now, third point. Crossing is a material alteration. Already we know what is a material alteration. It's alteration which is material enough. But does it affect the rights? No. Crossing is a material alteration, but crossing does not affect the rights in respect of the checks. Not affect the rights. So, crossing is a material alteration, but does not affect the rights in respect of checks. Now, what are the types of crossing? First, general crossing. Second, special crossing. Third, account payee crossing. Fourth, not negotiable crossing. So there are 4 types of crossing: general crossing, special crossing, Account payee crossing and not negotiable crossing. Now, we are going to see the types of crossing. First is general crossing. So, what is general crossing? We already saw crossing means you cannot pay across the counter. So, general crossing means a check which has two parallel lines in it. With or without the words and company are not negotiable. So, something there can be words inside or there cannot be words inside. So generally the normal crossing is a general crossing. So what does it say? It can contain words inside or without the words. Okay, there may be absence of words or there can be words. So it can be plain like this or there can be some words inside. What it could be? It could be something like and company and co, or it could be something like not negotiable. So this is a general crossing. Second, after general crossing, we saw something called special crossing. So what is special crossing? Where the lines of crossing bear the name of a banker with or without any additional words. So you have the name of a banker inside, SBI. Now what happens if there is a banker's name inside? The payment can be obtained only through that particular banker. So here payment can be obtained only through SBI, not through any other banker. So what will happen to that effect? The payment can be obtained only through the particular banker whose name appears between the lines. Now, can there be more than one banker? Yes. With regard to special crossing, yes. Now sometimes the check can be crossed specially to more than one banker. So can there be more than one banker? Yes, more than one banker is also possible with regard to special crossing. Now what happens where a check is crossed specially to more than one banker? When it can be done? One banker is appointing another banker as his agent for collection. That is why it is crossed specially for more than one banker. So where a check is crossed specially to more than one banker, the banker to whom it is crossed may cross it specially to another banker, his agent for collection. So why do you cross the name of, why another banker's name is also there over and above the existing banker? Because the second banker could be an agent. Then third point, account payee crossing. Account payee crossing, or it can be account payee only. So what it is a modified form of general or special crossing. So it's also called restrictive crossing. What does it mean? When you are inserting the word account payee, the banker is supposed to collect the check on behalf of the payee only whose name appear on the face of the check. If the banker is collecting the check from any other person other than the payee, he can be held responsible. Okay, so the liability of the banker is a lot more in this type of crossing. Then fourth, not negotiable crossing. Not negotiable crossing. What is not negotiable crossing? Inside the two lines, you write the word not negotiable. So you can write the words either inside or outside. So a person taking a check bearing the word not negotiable shall not be capable of giving a better title to the check that which the person from he took it. So what does it mean? What does it mean? Let us understand it little by little. There is a special catch over here. Normally, with regard to negotiable instruments, what did we study? In a negotiable instrument, if the title of transferor is defective, the transferee, if he is a holder in due course, will have a good title. Yes. So what happens? There is one called transferor, the other is called transferee. Now, the transferor, let us say, is A here, B here. The transferor title is defective. Now, what happens? He transfers this to one Mr. B. However, B is taking the instrument from A in good faith for value before due date. So what do we say? Even though transferor title is defective, the transferee will get a good title. This is the normal rule. Now, what happens if the transferred instrument is a not negotiable check? A not negotiable crossed check. What will happen? So the same situation once again, A and B. A's title is defective. Now B is a holder in due course, meaning in good faith for value and before due date he gets a instrument. But the instrument is a not negotiable crossed check. So because the words not negotiable are written, will a holder in due course get good title? No. This is also becoming a defective title. So in other cases, with regard to negotiable instruments, if the holder in due course get a good title, whereas with regard to not negotiable cross check, even the holder in due course get a defective title if the transferor's title is defective. So can we say that a not negotiable cross check cannot be transferred? No, nothing like that. So just because you add the words not negotiable, does that mean that the check cannot be transferred further? No. You can transfer it further, but the main feature of negotiability is being taken away. So not negotiable check can be transferred, but the essential element of negotiability is being taken away. Next, who may cross a check? Who are all entitled to cross a check? The one who draws the check, drawer of the check can cross it. How he can cross it? Either he can do general crossing or special crossing. Now, holder of the check. One holder of a check is a person who has a right to hold the check. The holder may cross the check generally or specially. Okay, so even the holder may cross the uncrossed check generally or specially. Now third, banker. Banker has also the right to cross the check. So a banker may cross an uncrossed check. Now what happens if the crossing is general? If the crossing is general, the banker may cross it specially. Banker may convert the general crossing into special crossing. Now, what happens if the crossing is a special crossing? The banker may cross it once again to another banker, his agent for collection. This we already saw. You can have two bankers' name. Is that allowed? Yes. If that be the case, we have to understand that the second banker is the agent for collection. Now, we are going to see some samples of crossing. First is general crossing. So in general crossing, it can be with words or without words. If it is without words, there can be two parallel lines just like this. If there is words, it could be ANCO or account pay or not negotiable. Second is a specimen of special crossing. Within the two lines, you have a name of a banker. State Bank of India account pay, State Bank of India not negotiable. Third is account pay. So in account pay, you have two lines. Within the two lines, you have account payee, the word. Then next is not negotiable. So you have two lines. Within the two lines, you have the words not negotiable, State Bank of India. So these are all the samples of the cross check. Let us know few other points with regard to bank checks. First point.
There could be instance where there is a mismatch between the amount written in words and amount written in numbers. The amount stated in words and the amount written in figures might be different. What would happen? Which should you go as per? Should you go as per words or as per figures?
For example, pay A.
You have written it as 10,000
only. But when you sign, you have signed it for 1,000 rupees. Now the question arises, should you take as per the words or as per the figures? Now, Negotiable Instrument Act says where the amount is to be paid is stated differently in figures and in words, you have to go only as per the amount stated in words. So you should not take, in this example, 1,000, you have to go and take as 10,000. So when there is a mismatch between words and figures, you have to take the amount stated in words. So amount stated in words shall be final. Now, point number 2. We always know that check is payable on demand. So check is a demand instrument, it's not a time instrument. So check is always payable on demand. Whereas a promissory note and a bill of exchange, if there is no time is specified, then it becomes a demand instrument. So check is always a demand instrument. Now, next point. This is with regard to a minor. Can a minor draw a check? Yes. Minor can draw a check. Can minor endorse a check? Yes. Minor can endorse a check. Can minor deliver a check? Yes, minor can deliver a check. Can minor negotiate a check? Yes, minor can negotiate a check. So, a minor can draw, endorse, deliver and negotiate the check. Now, if there is some wrong thing happen, if there is something wrong, can the minor be made liable? No. Minor cannot be made liable on a negotiable instrument. Minor cannot be made liable on a negotiable instrument. So all other parties other than the minor can be made liable, but minor himself is not liable. So minor cannot be made liable. So minor may draw a check, endorse a check, deliver a check, negotiate a check. However, minor cannot be made liable on any kind of negotiable instrument. Next point. Now, we are going to see something regarding agent. Okay, agent is a person who works on behalf of his principal. So, agent does not act on his own, agent acts for a principal. Now, what happens when an agent signs a negotiable instrument like a check? When an agent signs a negotiable instrument like a check, if he is signing without indicating that he is an agent, then he will be personally liable. So very important point with regard to our agent is that when he signs, he should clearly tell that he is signing on behalf of the principal. When he signs, he should clearly specify that he is signing on behalf of principal. If he fails to do so, then he is personally liable. He is personally liable. So, an agent who is signing his name without indicating that he is an agent is personally liable on the instrument. Next, we are going to see about drawer and drawee in a check. We are going to see a drawer and a drawee in a check. So, we know that drawer can be an individual in a check, whereas drawee will always be a banker. Yes. So, what happens? Now, the drawer is drawing a check. Now, what happens to the check? The check is dishonored. So, notice of dishonor. The drawer of a check is bound in case of dishonor to compensate the holder. And not only that, due notice of dishonor should have been received. So, what is this? Drawer Is he bound? Yes, drawer is always bound in case of dishonor. To whom should he compensate? Drawer of a bill or check is bound in case of dishonor to compensate the holder. So who will be compensated? The holder of the check will be compensated. What is the extra point to be noted here? Notice of dishonor should have been received. So extra point is notice of dishonor should have been received. Next. Already we have seen the drawer is an individual, whereas the drawee is a banker. Now, what happens? The drawer is maintaining his bank account with the drawee banker. Now, there is a critical situation. What happens? Drawer is maintaining his accounts with the drawee bank, but so drawee is having sufficient funds. The drawee banker is having sufficient funds of the drawer. Then, whenever the payment is asked to be done, the payment must be done whenever required to be asked. So whenever the drawee banker is asked to make the payment, he has to make the payment without any fail. Now, if the drawee banker is failing to make the payment whenever he is asked to do so, then the drawee banker should compensate the drawer. Why? It is the fault of the drawee bank. So, drawer is maintaining his bank account with the drawee bank, and there are sufficient funds available, and whenever the drawee is asked, he has to make the payment. Drawee of a check having sufficient funds of the drawer in his hands, properly applicable to the payment, must pay the check whenever asked to do so. If the payment is not done, then the drawee must compensate the drawer for any loss or damage caused by the default. Now, can the check be negotiated? Yes. So check can be negotiated from one party to another. Now, let us say A has negotiated a check to B, B to C, C to D, and finally it reaches E. Now, if E is a holder in due course, meaning E has got the check for value in good faith before the due date, then what happens? E is the holder in due course, then E can make every prior party liable. So E can make A, B, C, D liable on the instrument until the instrument is satisfied. So this is what being told with regard to prior party. Now, we are going to see about an important topic called dishonor of a check. Dishonor of a check is a very serious offense, and therefore it is given very lot of prominence. Now, Negotiable Instrument Act talks about dishonor of a check. That is section 138 to 147 talks of dishonor of check in particular. Now, penalties in case of dishonor of check is for insufficiency of fund in the account. This particular dishonor of a check was added to the Negotiable Instrument Act with effect from 1989. Negotiable Instrument Act is one of the oldest act, but however, it does not talk of dishonor of a check. Therefore, in the year 1989, it was added. Why? What is the objective behind penalties for dishonor of a check? The objective is to discourage people issuing check without maintaining sufficient balance in the account to honor the same, and remedies and penalties for bouncing of the checks. Is it applicable for electronic fund transfer EFT? Yes. So applicable to EFT also. Now most of the fund transfer is through EFT. So these provisions are applicable even to electronic fund transfer. Now, what is the provision? What does the provision state? When the check is returned unpaid due to insufficient funds in the account, the drawer is deemed to have committed criminal offense. What are the conditions for prosecution? First one. The condition of first one. The check should have been issued in discharge in whole or in part of any debt or other liability. So what is this? The check should have been issued in discharge of a debt, whether it is whole or in part. So it should have been issued in discharge of a debt. That is the first point. Second point. Check is returned by the bank. Check is returned by the bank. Why? For insufficiency of funds, or that it exceeds the arrangement. Now, third point. Check should have been presented within the validity period. So there must not be any default in this area. Check should have been presented within the normal validity period of the check. The payee or holder in due course should give notice to the drawer. The holder in due course or the payee should give notice to the drawer, demanding payment. This is very important. Within 30 days from the receipt of information about return of the check. Now, next point. If the drawer is failing to make payment within 15 days, so first cutoff is 30 days, next is 15 days. If drawer fails to make the payment within 15 days, then a cause of action arises. Sixth point. The complaint can then be made within 1 month. 1 month from the date of cause of action. Then any court lower to first class judicial magistrate or metropolitan magistrate will not try the offence. So these are the steps. So we can understand these steps through an illustration. Now let's understand the dishonor of check through a practical illustration. Point number 1, let us assume that the check was issued on 20th February. So it was presented to the bank the very next day. So it is on 21st February. Third point, the collecting bank informs about dishonor of check. This happens, let us say, 3 days later on 24th Feb. Now, what happens? Next point. This is where the procedure starts. We already saw the payee or holder in due course should give notice to the drawer. So the payee or the holder of the instrument should give notice to the drawer demanding payment within 30 days from the receipt of information about return of the check. So it was informed, let us say, on 24th February. So let us say there is a person called A. Okay, A is the payee or the holder in due course, and the drawer, let us say, is Mr. X. So A is payee or holder in due course and the drawer is X. So A should inform X. Within how many days? Within 30 days. Within 30 days. 30 days should be counted from which day? 30 days from 24th February. Already 24th February is available. So 30 days from 24th February. Now, what is happening? So 30 days plus 24th February. You are calculating 30 days from 24th February. So it comes around to 26th March. Now this is the last date of the notice. This is the last date of the notice. So the payee should give notice to the drawer demanding payment within 30 days from the receipt of information. So the last date is 26th March. Now, next point. What is the next step? So drawer receives a notice. After receiving the notice, drawer should make the payment. Yes. Now, what is the time period given? 15 days. Now, the next situation is if drawer fails to make payment within 15 days from the date of notice, action arises. So, what is this? 26th March. Next, from 26th March, you are counting. So the drawer should make a payment within 15 days. 15 days counted from which date? From the date of receipt of notice. Let us say on 26th March. He is getting, that is the last date. So here, which is the last date in this step? Drawer should, if drawer fails to make payment within 15 days from the date of receipt of notice, action arises. So we already know 26th March was the last date. Now from 26th March, count 15 more days. So what is this? 10th April. Now, payment should be made by the drawer and this is the last chance given to the drawer. What is the next step? Drawer is failing to make the payment. If drawer is failing to make the payment, what is the next step? Complaint can be made within 1 month from the date of cause of action. So what is the last date we already saw here? 10th April. Now from 10th April, add 1 more month. So it comes around to 10th May. Now, what is this 10th May? 10th May is the last date where the payee or the holder can sue the drawer. So this is the last date to sue. So who is going to sue? The payee or holder in due course can sue the drawer. So who can, what about the court? Any court lower to first class judicial magistrate will not try the offense. So this is the chronology of the events. Now, we are going to see the next topic. It is called bouncing of check. Bouncing of check means the return of check and what happens if a check is returned and the implication. Now, first one, what happens? The banker is dishonoring a check. If that be the case, reason should be given in writing. So, appropriate reason should be given in writing. And it should be duly signed by the official. So, second point is that it must be duly signed. Then, such a check may either be returned across the counter or through the clearing. Now, what are the reasons for the check to be returned? First one, the drawer has not arranged funds in the account to honor the check. So, scarcity of funds. So, drawer has not arranged for the funds. Point number 2. Drawer has deposited the check which is sent for the clearing but not yet realized. Not yet realized. Drawer has submitted some bills for collection. The payment is expected to be received. So funds are expected, so present it again. Where the drawer has submitted some bills, then the payment of which is expected to be received. Now, next is OD or cash credit. When the OD or cash credit facility sanctioned to the drawer exceed the limit. Next, payment is stopped by the drawer. Payment is stopped by the drawer. Next, drawer signature differs. So, signature difference. Then, check is outdated. meaning stale check. So these are all the common reasons for which the checks are written. Now, we are going to see about forged instruments. Forged instruments. Now, let's understand that law takes forgery very seriously. So, forgery is considered to be a nullity. So, forgery is considered to be a nullity. Now, what is the meaning of forgery? Forged instrument, meaning the signature of the person is fraudulently put by someone else. So, fraudulently, you are putting the signature of someone else. Now, what happens if the negotiable instrument contains a forged signature of drawer or a maker or an acceptor? What happens? That instrument becomes ineffective. The instrument becomes ineffective. Can the holder enforce payment? No. Holder can't enforce payment. Holder can't enforce payment. Now, with regard to a forged instrument, who gets the rights? It's a true owner. True owner can always sue for the recovery of the amount. So it's a true owner who gets the rights with regard to a forged instrument. Now, if the signature of the drawer or the maker is it is fraudulent, then what happens? If the signature is not genuine, the instrument is totally worthless. So even though a holder in due course might have got it in good faith for value, and before the due date, he cannot even get good title. So this is the only case where holder in due course cannot acquire any title. Why? Because this is a forgery. Okay. Next, the negotiable instrument with forged signature of endorser does not pass on valid title to the endorsee. Okay, so if the signature of endorser is forged, what will happen? No valid title to the endorsee. Who will get entitled? Only the true owner gets all the entitlements. Now, we can just study the stand of a paying banker. What happens if the paying banker makes a payment against a check with forged endorsement? What happens if it is making a check which has forged endorsement? Then there is second situation. The forgery is with regard to the signature of the drawer. So first case, it is an endorsement which is forged. Second case, it is a drawer signature which is forged. Is it one and the same? No. Let us understand this with an example. Let us understand this with an example. See, let us say there is one Mr. A. A is maintaining his account with X bank. A is maintaining his account with X bank. So he is giving a check and he says pay B or order. And there is an amount given. So what is the facts of the case? A is a drawer and X bank is a drawee bank. Now, what happens before the check is getting passed? Drawee bank should take maximum care to ensure that the drawer's signature is not forged. Why? Because A is maintaining the account with the ex-banker. So, the banker is supposed to know the signature of A, true signature of A. So, if the signature of A is forged and it has been passed by X bank, will the bank be excused? No. So, if the signature of drawer is forged, then will the banker get protection? No protection to the banker. there is no protection to the banker. Now let us take another case. Second case. A is a person, X bank, pay B or order. So A is the drawer, X is the drawee. And what happened here? B is endorsing it to one Mr. C and C is further endorsing to D. Now what happens? Let us keep it in mind that C's signature is forged. So we say that the endorsement is getting forged here. Now, please understand the fact that X banker knew only about A because A is a drawer and X bank is a drawee. Therefore, A is maintaining the account with X bank. Therefore, X bank only knows about the signature of A. Does he know about the signature of B? No. Does he know about the signature of C? No. Does he know about the signature of D? No. So in that case, if C's signature is forged, will X is able to understand the forgery? No. So here what happens? Paying bank gets protection. Gets protection against what? Against payment of check with forged endorsement. So if the endorsement is forged, the banker gets protection. However, if the signature of drawer is forged, banker will not get protection. Now, we are going to see about offenses by companies. What happens if companies are involved in a check offense? Okay. Now, somebody has committed if a person committing an offense under section 138 is a company. So what is 138 dealing about? Dishonor of check. What will happen? Who are all responsible? Now, 3 people are responsible. Who are all responsible? Every person who at the time of the offense was committed was in charge of the company. The person in charge of the company would be responsible and as responsible to the company for the conduct of the business of the company. Then even the company will be held liable. Person in charge and the company will be deemed to be guilty of the offense. Now, what happens if the person was not purposefully doing it? The person was not aware of that offense and the offense was committed without his knowledge, meaning he is an innocent person. He is not a party to the offense. Offense was committed without his knowledge and he had exercised all the diligence to prevent the commission. In spite of that, something had happened. Will he be punished? No punishment. So if he is innocent and had not committed the offense and he is not a party to the offense, then he is innocent in nature, therefore no punishment. Now, in bigger companies, there are nominee directors and independent directors. So there are some nominee directors who are nominated by central government and state government. Now we also know that the persons who are in charge of the company are punished under this particular section. What will happen to the nominee directors of central government or state government? Will they be punished? No. So directors appointed by central government or state government will not be punished under this section. Now, one more. Any offense has been committed by the company and the director or the top people who have committed it has also taken the help of any manager or secretary or officer of the company, then such secretary officer shall also be held to be guilty. What does it mean? The person who has committed this mistake has taken the help of any secretary or officer or any manager in the company. Then this secretary, officer and manager also will be held responsible for the offense, and they will also be punished with the person in charge. Today we are going to see about information technology in banking. Information technology is very much inevitable in banking sector. So information technology has brought a revolution in banking sector. A revolution in banking sector. There is variety of products and services offered by banks today are information technology based only. And that has introduced efficiencies in the working of bank. Now the changes are going on an ongoing basis. Continuous changes are happening in the banking sector. And it is benefiting both the customers as well as the bank. And not only that, with all these advancements comes risk as well. So more advancement in information technology in banking system and also more risk. So we have to make a level playing field to address all these issues. So banking, a person who is a student of banking and who is a professional of banking should be aware of all the risk as well as know how to manage the same. So technology is playing a very vital role by bringing in a fundamental shift in the functioning of the banks when compared to the manual system. And what are the other features? It helps the banks in improvements. Technology has broken the boundaries and bringing seamless banking and encourage speedier cross-border banking business. Now, first, real-time gross settlement, RTGS. So, what is RTGS? RTGS is a system where high-speed fund transfer takes place. What is this? High-speed fund transfer system. It takes from one bank to another for settlement of transaction. So it is called a real-time gross settlement. What is the meaning of gross settlement? Gross settlement means the transaction is settled on a one-to-one basis. This is important. It is not fully done, it is one-to-one basis. What is the meaning of the word settlement? It means once a process is finished, the payments are final and irrevocable. You cannot do anything about it after the payments are done. Now, where is RTGS used? RTGS is typically used for high value transaction. High value transaction that require and receive immediate money transfer. And the central bank works as an intermediary between the banks, working on specified hourly batch basis. So this RTGS is cleared on a batch basis between the banks, and who works as an intermediary? The central bank. So let us recall what is RTGS. So RTGS is nothing but fund transfer system that allow for instantaneous transfer of money or security. So what is the first feature? First feature is instantaneous money transfer. You need not wait for a long period of time. And it is a continuous process. Remember, there is no snag in between. It's a continuous process. And settling is done on an individual order basis. So individual basis, one-to-one basis only, this particular settlement take place. Without netting debit with credit, without netting of debit with the credit. So who is managing and running all these systems overall? It is their central banks. So real-time gross settlement works on a real-time basis, meaning the settlement happens as soon as it is received. Next, we are going to see about NEFT. What is NEFT? NEFT stands for National Electronic Fund Transfer. Now, it's a electronic fund transfer system maintained by the central bank. It's a facility enabling bank customers to transfer funds between any NEFT enabled bank accounts. On what basis? One-to-one basis. How is it done? It is done via electronic messages. Now, what is the difference between RTGS and NEFT? Unlike RTGS, fund transfer through NEFT do not occur on real-time basis. No real-time basis. Then how is it done? It is done in batches. It is done in batches. NEFT settles fund transfers in half-yearly batches. Only half-yearly batches. And totally there are 23 settlements. So what are the advantages of using NEFT? What are the advantages of using NEFT? First point, it is available round the clock throughout the year. Round the clock availability. Second, full coverage through large network of branches of all types of bank. So settlement is done in a very secure manner. Then, penal interest provision for delay in credit or return of transaction. No levy of charges by the central bank from the banks. No levy of charges by the central bank from the banks. No charges to savings bank account customers for online NEFT transaction. NEFT can be used for a variety of transactions including payment of credit card dues, EMI, payment of loan, etc. Now, UPI. UPI. What is UPI? Unified Payment Interface. What is UPI? Unified Payment Interface. Now, UPI is a system that powers multiple bank accounts. Multiple bank accounts into a single mobile application. So, what happens here? Multiple bank accounts are powered into a single mobile app. So what is it doing? Merging several banking features. Merge several banking features. And there is seamless fund routing. So transfer of fund is seamless in nature. You don't have any hassles. and merchant payments into one hood. So what kind of mode is this? This is peer-to-peer collect request. So it can be scheduled and paid as per requirement. Scheduled and paid as per requirement. So how is it unique in nature? What are the plus points of this particular mode? First one, immediate money transfer. So you need not wait, immediately you get the money transfer. You get round the clock service 24/7 and 365 days. Second, there is a single mobile app. Third, it is single click two-factor authentication. It provides very strong feature of seamless single click payment. Then there is a virtual address for the customer. There is a virtual address for the customer, and the customer is not required to enter the details like card number, account number, IFSC, etc. So there is a virtual address, therefore it makes work very easy. So you can also do bill sharing. Bill sharing is possible. So what can happen? Instead of suffering for cash on delivery mode or running to ATM, you can have a substitute as IMP, Unified Payment Interface. And you can also do merchant payment. Merchant payment is also possible. Then you can do utility bill payments. Utility bill payments like telephone bills, broadband bills, EB bills, all that can be done. And there is also barcode based payments. You scan the code and make a payment. So barcode based payment can also be made. What else can you do? You can make donations. You can make collections. You can make disbursements. And if there is a problem, you can raise complaint directly from app, mobile app. So who are all the participants? Who have all participated here? The participants in UPI. First is remitter bank, beneficiary bank, remitter, beneficiary, then NPCI, bank account holders, merchants, etc. So what is UPI? UPI is instant in nature, instant, real-time payment, real-time payment system. Who has developed it? NPCI. Who is NPCI? National Payments Corporation of India. What do they facilitate? Interbank transaction. Who is regulating the same? RBI. RBI regulates the interface. And how does it work? Transferring fund between two bank accounts, but on a mobile platform. So instead of using beneficiary's IFSC code and account number, you use a virtual ID. Now, next topic, IMPS. So IMPS stands for Immediate Payment Service. So it's also an instant real time interbank fund transfer system in India. What happens? IMPS is offering interbank electronic fund transfer through mobile phones. Now, what is the difference between IMPS and NEFT and RTGS? So, NEFT and RTGS can be done only on bank working days, whereas IMPS is available 24/7 throughout the year, including banking holidays. Who is managing IMPS? NPCI, National Payments Corporation of India. And it is built upon using National Financial Switch Network. National Financial Switch Network. Okay. So now comes the question. What is the difference between UPI and IMPS? Both come under NPCI. Then what is the difference between UPI versus IMPS? Now, first one, when you want to do a IMPS transaction, you want to make a IMPS transaction, you have to give a lengthy data, meaning name of the person, bank account, IFSC code, etc. So this may cause inconvenience to the user, whereas in UPI, you have to just give the virtual payment address of the payee. What does it mean? VPA of the payee should be given. That's it, enough. Second difference, when you want to make a IMPS transaction, you need to have the particular app of the debiting account. Whereas in UPI, you can link multiple bank accounts. Link multiple accounts with the same app. So you need not have app of different banks. You can have one app to do different works. So that's the convenience of UPI. Third, even though IMPS and UPI both claim as instant money transfer, but in IMPS, what should be done? IMPS transaction is little lengthy. When you do a money transfer to a new person for the first time, you have to make new payee registration, and therefore there is a wait time of nearly 30 minutes. After that only you can make a transfer to the payee. Now with UPI, you can make a new payee payment without any wait time. So you have a wait time in IMPS, whereas in UPI you don't have any wait time. Next, money collection. In UPI, what can be done? You can request a money message. You can request money to the other party. Whereas IMPS, you can't request. You can't request money. Through IMPS, you can transfer money abroad. You can transfer money abroad. Whereas in UPI, you can't transfer money abroad. Next, Next difference with regard to IMPS. You should mandatorily have a bank account if you want to send or receive money. So this is IMPS is said to be bank to bank transfer. You use IFSC code and account number. However, in UPI, you can receive money. You can receive money even if you don't have bank account. You can receive money even if you do not have bank account. What should you do here? You have to just install the UPI app to receive the money. Now, next. In UPI, how does the payment authentication takes? It is in the form of a MPIN number. What is MPIN number? It's a 4 or 6 digit number. Whereas in IMPS, transaction happen with a one-time password, OTP. These are all some of the differences of UPI and IMPS. Now, we have what is called the components of payment and settlement system. We are going to see the components. Payment system transaction in India would comprise of transaction processed and settled through. First, paper clearing. Under paper clearing, you have MICR, non-MICR, check truncation system, express check clearing system. Next, another way of payment is electronic clearing service, ECS. It is bulk electronic transaction processing system. There are also variants like regional ECS, national ECS, etc. Then we have card payments, debit card, credit card, etc. Then large value payments through RTGS. That is real-time gross settlement. Then there is something for retail segment, that is NEFT, which is National Electronic Fund Transfer. Fast payments. Fast payments happen through IMPS, Immediate Payment Service, or UPI, Unified Payment Interface. Then we also have e-money. Under e-money, we have prepaid payment instrument cards and wallets. Now, except the first one, that is paper clearing, all the others are digital transactions. So, except the paper clearing, all the others are digital transactions. Now, in addition to the above, RBI has also established clearing and settlement system for government securities as well. So what about the digital revolution? Now the digital revolution in banking is taking the world by storm, and no other area has witnessed such a metamorphosis as seen in the payment, and this is resulting in a variety of payment options for the consumers. So what are the India's payment system as of Now we have the RTGS, very popular payment systems, RTGS, NEFT, NACH, IMPS, UPI, NETC, BBPS, RuPay, cards, PPAs. So these are all some of the popular payment systems in India as of now. We would be studying about each and every topic in the forthcoming videos. Now, we are going to see about IDRBT. What is IDRBT? IDRBT stands for Institute for Development and Research in Banking Technology. So, IDRBT was formed on June 10th, 1996 as a society under the Society Registration Act. Now, IDRBT was initially focusing on developing and managing technology infrastructure. IDRBT developed Infinite. What is Infinite? Indian Financial Network. Then SFMS, Structured Financial Messaging System. Then IBCC. What is IBCC? Indian Banking Community Cloud. And NFS, National Financial Switch. Now, next is IFTAS. What is IFTAS? IFTAS stands for Indian Financial Technology and Allied Services. See, RBI constituted a committee to review and evaluate the activities of IDRBT and to redefine the role. So the committee submitted the report and recommended for the formation of IFTAS, Indian Financial Technology and Allied Services. Now, this IFTAS is a wholly owned subsidiary of RBI. So this IFTAS took over Infinite, SFMS, IBCC services from IDRBT, and also started providing uninterrupted 24/7 high quality IT related services to Indian banking and financial sector. So let's recall Infinite. What's the purpose of Infinite? It's a communication backbone of the Indian banking and financial sector. Then SFMS. SFMS is a messaging platform used in the RBI operated payment system, that is in RTGS and NEFT. Then we have IBCC. IBCC is a specialized community cloud for the banking and financial sector. Then we have GIFT. What is GIFT? GIFT stands for Global Interchange for Financial Transaction. So it's an end-to-end thorough processing of payment messages between the source bank and destination through the central bank. Next, we are going to see about the next topic, which is CCIL. What is CCIL? CCIL stands for Clearing Corporation of India Limited. So what is it? It's a financial market infrastructure, FMI. Who is authorizing it? Authorized by RBA. For what purpose? To operate various payment systems. And CCL has been granted the certificate or granted the status of qualified central counterparty. When was CCIL constituted? In April 2001. To provide guaranteed clearing and settlement for transaction in money and government securities, forex and derivative market. So CCIL also provides non-guaranteed settlements as well. Example, CCL is authorized to operate securities, forex forward, etc. CCIL also acts as a trade repository, TR, for all the OTC transactions. OTC transactions happen mainly in forex, interest and credit derivative segments. Now, CCIL also acts as a trade repository for secondary market trades. We know that there are two types of market. One is a primary market, secondary market. Here, secondary market trades in particular with regard to certificates of deposit and commercial papers. Similarly, it is acting as a trade repository for repo, market repo or reverse repo transaction. CCL also acts as a reference point for important benchmarks used by the market. Now, next we are going to see about NPCI. What is NPCI? National Payments Corporation of India. So NPCI was set up with the guidance and support of RBA and Indian Banks Association. What is NPCI? It's an umbrella organization for all the retail payment system in India. It was incorporated in December 2008. So it was set up as a Section 25 company under Companies Act 1956. What does it mean? It's a not-for-profit company. What is the aim? To operate for benefit of all the member banks and their customers. To create infrastructure for increasing the pan-India systems with high availability and scalability. To process increasing volumes for retail electronic payments. Now, NPCI started with 10 core promoter banks as shareholders. Later on, it expanded to include more banks. Now, who are all the shareholders? Public sector banks, private sector banks, foreign banks, cooperative banks, regional rural banks, small finance bank, payment banks, PSOs, all are its shareholders. All are shareholders of NPCI. Now in 2013, NPCI was given the objective of operating CTS, that is check truncation system, on behalf of RBA. So the first task was CTS, check truncation system, was taken over on behalf of RBA. Next, it took some of the operations from IDRBT as well, that is managing NFS. So these two activities are the main revenue source for NPCI. Now, what is the progress made by NPCI in the retail digital payment space as of now? NPCI has rolled out variety of innovative retail payment products. Let's see it one by one. First is IMPS. Second, RuPay card scheme. third UPI, fourth Notch, fifth AEPS. What is AEPS? Aadhaar enabled payment system. Then ABPS. What is ABPS? Aadhaar payment bridge system. Then NETC. Star 99 hash, that is USSD based system. Then you also have BBPS. Further, NPCI also has alliance with international network partners like Japan Credit Bureau, China Union Pay, etc. So this is one of the method of international acceptance of rupee. Now, this retail payment system of NPCI has gained widespread acceptance across the country and it generated interest outside India as well. So there is a global outreach of NPCI systems. So a subsidiary for NPCI was created, that is called NPCI International Payments Limited, that is NIPL. It was established in April 2020. What is the objective of NIPL, NPCI International Payments Limited? It is tasked with the responsibility of exporting in consultation and coordination with the RBI. NPCI is indigenously developed offering to the foreign markets. So all these services, if whichever country likes, they can get it by collaborating with NIPL. So what is the prime focus of NIPL? Internationalization of RuPay and UPI. Now, next topic is CTS. What is CTS? Check truncation system. What does it mean? Long back, what happened was that clearing process in banks happened through physical movement. So there were physical movement of checks from one place to another in order to clear the checks. But it took lot of time and it was rather cumbersome. So government envisaged this process called CTS. So what happens in check truncation system, CTS? The image of the check is used for processing the check. So image of the check is used for processing the check. So there is no need of physical movement of check. So what happened is that the turnaround time for clearing the checks got reduced. And there is a reduction in the lost checks number. The number of lost checks got reduced. Outstation checks got cleared more easily. Now, what happened was that in the year 2010, CTS 2010 standards were framed to standardize the security feature on check. There were some mandatory features with regard to check truncation system were specified. What was that? Paper and watermark. Paper and watermark at the manufacturing stage. Walled pantograph and bank's logo with UV ink at the printing stage. Field placements of check, color and clutter-free backgrounds. Then prohibiting alterations or corrections on checks, pre-printed account number, etc. So because of this, the process became very easy. So in the year 2010, banks were advised to issue only CTS 2010 standard checks thereafter. So what happens in CTS? The presenting bank or the collecting bank captures the MICR data and scan the images of the check as per CTS specification. To facilitate CTS, Negotiable Instrument Act was also amended. As per Negotiable Instrument Act 1881, now electronic movement of check is legalized. Then, There were nearly 66 MICR centers operating across the countries. They were subsumed into grid-based CTS clearing, and MICR clearing was discontinued with effect from 2014. So what happened to the non-MICR clearing houses? Everything is now migrated to CTS. Now, we are going to see about Infinet. So Infinet stands for Indian Financial Network. So in order to upgrade the country's payment and settlement system, RBI took the initiative of providing communication in the form of satellite-based Infinet. So what is the technology being used here? VSAT technology to the banking and financial sectors. The designing and developing communication network was given to IDRBT. So they were only responsible for design and the communication. Then the CUG network uses VSAT technology and it's a TDM network. What does it mean? Time division multiplexing network or TDMA network. So what is the topology being used for this network? Star topology. For data and demand assigned multiple access single channel per carrier. Overlay with mesh topology for voice and video traffic. Now what is the objective of Infinet? To improve the efficiency and productivity and provide the improved customer services through innovative channels. Now, we have SFMS. SFMS. What does SFMS stand for? Structured Financial Messaging System. So, who developed SFMS? It was developed by IDRBT. Now, what is SFMS? It's a domestic messaging standard. It's a domestic messaging standard and it is used for financial messaging in India. Now, what does it use as a communication medium? It uses Infinet as the communication medium. So, who uses this SFMS? Various intra-bank applications use SFMS. The bank basic architecture is a four-tiered with hub connected to the bank gateways. So, these bank gateways are also connected to the bank servers. So, basic architecture of SFMS is four-tiered in nature. There is with hub connected to bank gateways are connected to bank servers. Bank servers are connected to offline branches. Offline branches. Now, this SFMS messages from bank branch to another branch will be delivered via gateways and the hub. However, what about the intra-bank branches and their messages? They are switched at the bank gateway level. They are not required to be routed to the hub level. Now, we have NACH. What is NACH? NACH stands for National Automated Clearing House. So what is NACH? NACH is a centralized ECS system. Who is operating this? This is operated, centralized ECS is operated by NPCI. Now, what is the main function of NACH? NACH was formed to consolidate multiple ECS systems. What is ECS? Electronic Clearing System. So, now what is main function of NACH? Its main function is to consolidate the multiple ECS system. So, how does NACH operate? It can operate as NACH debit and Notch credit payment system. Notch credit. It's like ECS credit. It's for making one-to-many credit transfer. Example, payment of dividend, payment of interest, payment of salary, payment of pension, distribution of subsidies, etc. Now, what about Notch debit? Notch debit also operates to collect transaction from many accounts to one destination account. Notch credit is one-to-many credit transfer. Notch debit is from many accounts to one destination account. Example, telephone payment, electricity, water, gas payment, etc. Now, this can also be used for periodic installment collection, like loans, investment in mutual funds, insurance premium, etc. Now, what about the destination banks? How is it identified? It's based on IFSC or MICR codes. So, what is the main background of Notch? How does it work? It works on the basis of mandate given by the customer. What is the mandate? What do the customers do? They allow debit to their account at specified frequency. So, mandate could be paper mandates or paperless mandates. Notch is a very popular mode of direct benefit transfer credit to the beneficiaries. Now, next is contactless cards. So this is one of the innovations in the card payment system. By using the contactless cards, the card holders can tap and go. So these cards are becoming very popular. So when using these cards, RBI has permitted a relaxation. What is this? Relaxation with regard to AFA. What is AFA? Additional factor of authentication. Remember, when you sign into your Google account, you are asked for a authentication. So that additional factor of authentication is relaxed by RBI with regard to cards present. CP transaction. What is CP transaction? Cards present transaction using near field communication enabled EVM chip. So first is AFA is relaxed for the transaction using NFC, that is near field communication enabled EVM chip, EMV chip. And moreover, for the transaction should be for small values. So with small values, they have relaxed AFA. So AFA is relaxed with regard to transactions using NFC communication enabled EMV chip and PIN cards for small values. Then beyond this small value was originally fixed at 2000 rupees. So until 2000, this OTP was relaxed. Then beyond 2000, what happened? If your transaction level crossed 2000, what happens? Can it be processed using contactless mode? Yes, still it is processed in contactless mode only, but there is AFA required. because it crosses the small value transaction limit. So this relaxation in AFA is not applicable for ATM transaction and card not present transaction, CNP transaction. Now this 2000 limit has been revised to 5000 from January 2021. So this is with regard to contactless cards. Now, we are going to study about NETC. NETC. What is NETC? National Electronic Toll Collection. So, to reduce the trend of large-scale cash-based toll collection, Government of India has mandated the use of FASTag. So, here or you can write it as FASTag. Okay. So, the use of FASTag-based toll payments. So, how this FASTag-based toll payments is made? It is made through NETC. It is facilitated through NETC. So what is NETC? NETC is nothing but an electronic interoperable system for toll collection. So NPCI is authorized to operate the NETC system. So NETC is an electronic interoperable system for toll collection, and who is authorizing this NETC system to operate? That is nothing but the NPCI. So FASTag, let's come to FASTag. So FASTag is issued by a bank or Indian Highways Management Company Limited, IHMCL. And this FASTag is affixed on the vehicle. And this is linked to the underlying payment instrument. It could be the bank account or non-bank PPI or cards, UPay, etc. So FASTag can be used for payment of toll at plazas acquired by the same or some other bank. And this FASTags can also be used for other payments like parking charges, fuel charges in an interoperable environment. Now, we are going to see about government payments. So, government payments play a critical role in the development of national payment system. So, government payments can facilitate economic growth. Now, what happens in India? There is something called Aadhaar Biometric Identity System. It was introduced in the year 2009. So it's a major facilitator in the electronification of government payments. Now, by linking welfare and other transfer to this unique 12-digit ID number tagged to biometric marker, that is Aadhaar, this has helped to reduce the leakage. For example, middlemen are highly avoided and also help in identifying fake beneficiaries. Now, we are going to see something called APBS. What is APBS? Aadhaar Payment Bridge System. So what is this? This is also a component of NACH. So this uses Aadhaar number for electronic crediting of government subsidies and benefits in Aadhaar linked bank account. This was implemented in the year 2012. There is something called Aadhaar Mapper. So it's a repository of Aadhaar numbers managed by NPCI. Aadhaar Mapper. So what is it? It's a collection of Aadhaar numbers. Who is managing? NPCI. What is it used for? Routing the APBS transaction to the destination banks on the unique IAIN. What is IAIN? Institution Identification Number of the destination bank. Now the bank will in turn credit the amount to the desired bank account number based on the Aadhaar number of beneficiary. So this system has led to electronification of large number of government payments, which were earlier either in cash or check. So benefits and subsidies are mostly under DBT schemes. It also serves the goal of financial inclusions. Now, we are going to see about TPAP. TPAP. What is TPAP? Third party application provider. So it refers to nothing but the APIs, which are either a standalone application or application that add functionality to an existing program. So what about in financial space? These third party apps are often connected to a banking application to provide variety of services. What does a third party app do? It sends a request to the linked banking application for permission to use the user's bank details. Now this is further relayed by the banking application to the customer to authenticate the request. So what is the speciality of these apps? They provide flexibility and freedom to consumers to select the solutions. Now this TPAP, it is one of the best example of public-private partnership. Now in the payment space, third-party service providers are primarily in the form of payment gateways, payment aggregators, and TPAPs in UPI. So this UPI ecosystem is designed for banks. Only a banking entity can directly interact with the UPI switch. However, non-banking entities can participate by partnering with the banking entity which is already on UPI platform and developing their own APIs. And these APIs are referred as third-party apps. So what is the role of these entities? It is more like a facilitator. The entire operational and financial liability of transaction originated through third-party app lies on the bank. There are a lot of TPAPs. Classic example of TPAPs are Google Pay, Phone Pay, WhatsApp Pay, etc. Now, MTSS. Next is MTSS. What is MTSS? Money Transfer Service Scheme. What does it mean? Inward remittances into India are received through various channels. What are the channels? Banking, postal, rupee drawing agreement, etc. Now, this MTSS is a quick and easy way of transferring personal remittances from abroad to India. This scheme allows remittance from abroad to Indian families and foreign tourists visiting India. What is the cap? It is 2,500 per transaction. And how many remittances can be done in a year? 30 remittances for an individual beneficiary. Now this MTSS involves tie-up between reputed money transfer companies abroad. They are known as the overseas principal. So this money transfer companies abroad are known as overseas principal. And there is agent. Agents are in India. They are known as Indian agents. Indian agents can further enter into sub-agent agreements for undertaking this money transfer business. DPSS authorities regulate the MTSS operators. As on date, authorization has been granted to 9 principals. Oversight of this principle is done mainly through analysis of the off-site return submitted by them. Agents and sub-agents are regulated by the RBI. Now, we are going to see about the business of RBI. Now, there is section 8 of RBI Act. Section 8 of RBI Act talks about the same. Business of RBI is vested with Central Board of Directors. So, what is it called? Central Board. Now, what does the Central Board comprises of? Point number 1, it consists of the governor. Point number 2, it consists of 4 deputy governors. Then 16 directors. How does this 16 come? Just like a central board, there is also local boards. From local boards, 4. Then nominated directly by central government, 10. And 2 government officials. Appointed as per RBI Act. Now, this is the breakup of the central board. Now, we'll first see about governor. What about governor? Governor holds office for a period of 5 years. Next, deputy governor. Deputy governor also holds office for 5 years. Next, there is independent director. Independent director's tenure is for 4 years. And government officials. For government officials, it is at the pleasure of government. Now, what about all the board officials? Are they eligible for reappointment? Yes. What about independent directors? Can they be reappointed? The independent director's appointment is restricted to 2 terms of 4 years each, meaning 8 years. It may be continuous or it may be intermittent. Can the deputy governor or government officials attend any meeting of the central board? Yes. Deputy governor and government officials nominated as directors also attend any meeting of the central board. Can they take part in deliberation? Yes. But what they cannot do, they cannot vote. Now, in the absence of governor, and if it is permitted by the governor, who may vote in the meetings? It is the deputy governor. It is a deputy governor. Now, we already talked of local boards. We also know that there are 4 local boards. Where are these 4 local boards constituted? They are constituted in 4 areas, 4 parts of the country: north, east, west, south. So one is in Delhi, the other is in Mumbai, the other in Kolkata, the other in Chennai. Now, what does this local board consist of? The local boards consist of 5 members each. 5 members each. Who appoints them? Central government. The RBI has also conferred power to disqualify the directors and members of local boards. They could be removed, they could be vacated from their office. Now, with regard to central board, what are they talking of? Who will convening the meeting of central board? It's the governor. Governor only convenes the meeting of central board. How many times should you conduct the meeting? The meeting will be conducted at least 6 times in a year. Now, per quarter, at least 1 per quarter. For the day-to-day conduct of bank's business, central board, in terms of the power vested in it, can make regulations as it may consider necessary. Now, next is BBPS. What is BBPS? Bharat Bill Pay System. So, to integrate the fragmented bill payment market in the country, BBPS was conceptualized. BBPS live operation commenced from October 17, 2017. It offers anytime, anywhere bill payment service to customers using online payment as well as through a network of physical agent locations. So what are the different types of categories? Electricity, water, gas, telecom, direct to home DTH services. You can make the bill payment through BBPS. Now, BBPS framework can be consisting of 2 types of entity carrying out distinct function. What are they? First is BBPCU, the other is BBPOU. What is BBPCU? Bharat Bill Payment Central Unit. What is BBPOU? Bharat Bill Payment Operating Unit. So as of now, with regard to Bharat Bill Payment Central Unit, there is only one entity, that is NPCA. So what is BBPCU? It's responsible for undertaking clearing and settlement activities. What is BBPOU? They are authorized operational entities for facilitating bill payment online as well as through network of agents. Now, let's see one important topic, that is advances. Okay, advances is the bread and butter of the banking sector. So lending is a major activity. The banks also do investment function, but lending is a very important major activity. What is the most important business of bank? Accepting deposits. Advances are generally the largest item on the asset side of the balance sheet, and it is a major source of income. So you can find it on the asset side, and it is constituting the major income of a bank. So what do advances comprises of? Okay, so advances usually comprise of funded amounts by way of. So we can see the different constituents of the advances. So what are they? First one, term loan. A loan given for a term. Then cash credit, we already know. CC, overdraft, OD account. Then demand loan. Next, bills discounted and purchased. Then balance in deposit account. Then participation on risk sharing basis. What is this? We'll see later on. Participation on risk sharing basis. Next, interest bearing staff loan. Okay. So what is the first one? Term loan. Cash credit, overdraft mostly to businessmen, demand loan. On demand, the loan has to be repaid. Bills to be discounted and purchased. Balances in the deposit account. Participation on risk sharing basis. To understand that, we have to understand about priority sector. Then interest bearing staff loan which carries interest. Okay. Now we are going to see something called priority sector. Okay, from the word itself we know what does it mean. Something which is given more importance. So what is priority sector? It is those sectors which the government of India and RBI consider as important for the development of basic needs of the country. So these are all very much important in nature, and with regard to these sectors, there must be more lending given to these sectors. Okay, and these sectors, these areas should be given priority over other sectors. That is why it is called priority sectors. So the banks are given asked to encourage the growth of the sectors with adequate credit. Now, what are the categories of priority sectors in India? First is agriculture. Agriculture is the backbone of the country. Therefore, agriculture is the first priority sector. Second is MSME. Okay, what is MSME? Micro, small and medium enterprise. So they are another examples of priority sectors. Then third, education. So third is education. Fourth, housing. Fifth, social infrastructure. Next, renewable energy. Others, miscellaneous category. Okay, so these are all the most important sectors in the country. Therefore, the bankers are asked to give more credit, to give more loans to these sectors, more lending to these sectors. So priority sector lending is important role. It is given by the RBI to the banks for providing a specified portion of the bank lending to the few specific sectors. It is meant for all-round development of the country as opposed to focus only on the financial sector. Now, who are all the ones who give more priority sector lending? So if you see priority sector lending, more nationalized banks give more loans to priority sector rather than the foreign banks. So the government came up with the concept of PSLC. What is PSLC? Priority sector lending certificate. What does it mean? It is a tool for promoting competitive advantage. It is similar to a certificate. Okay. Now, what is it happening? Bank with the advantage in lending to priority sector should earn priority sector lending certificate, while those falling short of the target would be required to buy the certificates. So, for example, the nationalized banks, they provide more lending to the priority sector, so they get more credit. So the banks with comparative advantage in lending to priority sector should earn should earn PSLC certificates. So the nationalized bank, they give more loans to the priority sector, therefore they earn more credits. Okay, credits are sufficient for this nationalized bank. What about the foreign banks? What about the private banks? They are falling short of the target. So what do these foreign banks do? The foreign banks or the private banks, they should buy the credit. Okay, so those banks which are falling short of the credit would be required to buy the priority sector lending certificate. This is similar to carbon credit. If you have heard of carbon credit also is tradable in the market. So one company can buy carbon credit from another company. Okay, and this is the concept of PSLC. It is a method for directing credit and could be used in Asia and other parts of the world as an alternative method for directing the credit. Now there is a forward market for priority sector lending certificate, then that will help to help a bank to focus and plan better in nature. So this is with regard to priority sector and priority sector lending certificate. So next is we get what is called IBPC. What is IBPC? Interbank Participation Certificate. Okay, IBPC. What is it? It is another short-term money market instrument. Okay, it is similar to your priority sector lending certificate. There is one bank selling to another. Here also, the bank can raise money or deploys the short-term surplus. There are two banks. One is the borrowing bank, the other is the lending bank. Okay, what happens here? The borrowing bank sells on the loans and the credit in its book. Now, to whom? To the lending bank, but for a temporary period. It is not permanently, it is for a temporary period. So what is this? The borrowing bank sells on the loans and credit for a temporary period to the lending bank. Now, next, there are two types of IBPCs. What are they? First is with risk sharing. With risk sharing. Other is without risk sharing. Okay, what are the features? Minimum period is 91 days, maximum is 180 days if it is on risk sharing basis. So minimum is 91, maximum is 180 days if it is on risk sharing basis. If it is non risk sharing basis, total period is limited only to 90 days. Okay. Then IBPCs are not transferable, they cannot be redeemed before due date. Now, legal requirements of disclosure in the balance sheet. How is this advances are disclosed in the balance sheet? First, okay, bills purchased and discounted. Okay, second, cash credit, overdraft, loans repayable on demand. Third, term loan. This is one way. Next, you have three categories. This is based on the coverage. Okay, secured by tangible assets. Then covered by bank guarantee. Then unsecured. Okay. Next, you have the next category, advances in India or advance outside India. This is another classification. Now, if it is advance in India, there are more sub-classifications. First, priority sector. How much advances for priority sector? What is priority sector? Agriculture, MSME, infrastructure, education loan for poor, housing loan for lower income category. So these are all priority sector. Second, public sector. Then banks, and others. Okay. This is advances in India. Now, advances outside India. First, we say due from banks. Then you have due from others. Due from others, three more categories. What are they? Bills purchased and discounted. Next, syndicated loans. Next, others. Now, what is the meaning of syndication of loans? Loan syndication. Okay. So what is loan syndication? Loan syndication is process of involving a group of lenders. Okay. There won't be a single lender, but there is a group of lenders in funding various portions of loan for single borrower. So what is loan syndication? Process involving a group of lenders in funding various portions of loan for a single borrower. Why is it being done? Why is it a group of lenders are lending? There may be two reasons. The loan value is too large, or risk exposure is high. Okay, so what happens? Let us say there is a government project, 10,000 crore project, loan is too large. So what the government would do, the government project would not be started with the help of one bank financing. There would be more than one bank involved in lending for that project. Okay, so what is the first reason? Loan is too large, or risk exposure is high. It's a high risk project, so one bank will not carry the complete risk. More than one bank will be involved in carrying the risk. Okay, this is the reason. Now, next is classification of advances. How do you classify the advances? Okay, so first is sector wise. Okay, when you go sector wise, how do you classify it? Okay, you classify first as whether it is priority sector or non-priority sector. Now, what is the second classification? Security wise. Second is security wise. If you go for security wise classification, what is the first? You call whether it is secured or whether it is unsecured. Okay. Now, third is on the basis of prudential norms. What is a classification? First, see it whether it is a standard loan or whether it is a NPA. Now, as per prudential norms, standard loan or NPA. So let us go something deep into that. Okay. So classification of advances as per prudential norms. What are the two categories? One is whether it is standard, the other is whether it is NPA. Okay, so standard loan, the next is NPA. Now, standard loan is of two types. Okay, one is called standard regular, the other is called SMA. What is SMA? SMA stands for special mention account. Okay, we learn about it. What is special mention account? Now, special mention account again of three types. Okay, 1, 2, 3. First one, SMA 0. What is SMA 0? Account showing stress signal. Next is SMA 1. What is SMA 1? Overdue between 31 to 60 days. Next is SMA 2. What is SMA 2? Between 61 to 90 days. Now come to the next category, NPA. Okay, so NPA classification, first classification is substandard. Next, doubtful. In doubtful itself, D1, D2, D3. Three things are there. Then third is loss asset. Okay, so prudential norms, standard and NPA. Standard, you have two things, standard regular, SMA. SMA is nothing but special mention. SMA 0, SMA 1, SMA 2. NPA, substandard, doubtful, loss asset. Now, we have already seen about a standard loan and their bifurcation. Let's see the further classification one by one. So remember, we had already seen something called a special mention account. What is it? Special mention account. What is special mention account? Special mention account is SMA account. Okay, what is SMA? Now, SMA is those assets or accounts that show symptoms of bad asset quality in the first 90 days itself. Okay, so in the first 90 days itself, it is showing some symptoms that it might be a NPA in the future. Okay, so why SMA is used? It is intended to identify NPAs early. Okay, you need not wait on the 91st day. The first 90 days itself, you have some symptoms and you have some identifications that the asset might turn out to be NPA in the future. So what is this? SMA is used to identify NPAs early. Okay, now the category is 3. Okay, based upon the signals of stress. Okay, SMA 0 or 1 or 2. So what does this 0, 1, 2 indicate? This is indicating the signals of stress. Now, what is SMA 0? Okay, SMA 0. What is SMA 0? SMA 0 is given if the principal or interest payment is not overdue for more than 30 days. Okay, but there are signs of stress. Delay of 90 days or more in submission of stock statement. Okay, stock statement is not promptly submitted, meaning something is wrong, or other control statements are not submitted properly. Then, delay of 90 days or more in credit monitoring or financial statements. Delay in financial statement submission. Or delay in non-renewal of facilities based on audited financials. What is this? Non-renewal of facilities. Now, next is SMA 1. What is SMA 1? Okay, if the principal or interest payment is overdue between 31 to 60 days, then you call it as SMA 1. Next is SMA 2. What is SMA 2? If the principal or interest payment overdue is between 61 to 90 days. Okay, this is called a special mention account. Now, next is called non-performing asset. Okay, so what is non-performing asset? We already saw SMA. Yes. So SMA are those accounts which indicate that it might be a NPA in the future. Now, what is non-performing asset? It is also called NPA. When do you call an asset as an NPA for a bank? When it stops to generate, when it ceases to generate income for the bank, then you call as NPA. And this is a general condition. General condition. Okay. So, NPA is a loan or an advance where interest or installment of principal remain overdue for a period of more than 90 days in respect of term loan. Okay. Now, the account remains out of order in respect of OD or cash credit. Okay, with regard to OD or cash credit, we call it as a NPA when it is remaining out of order. What is out of order? We'll learn it. Then, the bills remain overdue for a period of more than 90 days in case of bills purchased and discounted. So, this is the general definition for NPA. So, there are even specific conditions for each of the situations involved. So we'll see that in the forthcoming lectures as well. Now there are categories of NPA. We already saw the broad categories. Okay, so substandard, doubtful, lost asset, we have already seen it. Okay, so when it becomes an NPA, we make what is called provision. Okay, so whenever the non-performing asset is coming into picture, we have to think in mind that there is something called provision required. Okay, now first one is substandard asset. Okay, what is substandard asset? It's a category of NPA. Okay, which has remained NPA for a less than or equal to 12 months. So it is an asset which has remained NPA for what is a period? Less than or equal to 12 months. Less than or equal to 12 months. Then you call it as substandard asset. Now, what's the provisioning required for the same? 15%. Second, doubtful asset. Okay, doubtful asset is an asset which has remained in the substandard category for a period of 12 months. Okay, please note that substandard asset is the one which has remained NPA for a period of less than or equal to 12 months. But what is a doubtful asset? It's an asset which has remained in the substandard category for a period of 12 months. Now, there are subcategories as well. Okay, D1, D2 and D3. Okay, what is D1? What is D2? What is D3? Doubtful up to 1 year, we call it as D1. Doubtful up to 1 to 3 years, we would call it as D2. Doubtful more than 3 years, we would call it as D3. Okay, now if it is a doubtful asset, if it's a doubtful asset, we would go further. We would go further. Okay, what is a further thing? We have to see it. We have to segregate as how much is a secured and how much is an unsecured portion. Okay, when it is a doubtful asset, we have to see what is secured portion, what is secured unsecured portion. Why? The provisioning for secured and unsecured portions are different. Okay, common thing, whether the moment the asset becomes a doubtful asset, okay, with regard to unsecured portion, you have to make the 100% provisioning. So what is a catch over here? If it's a doubtful asset, then two things to be taken into account. What is it? Whether how much is the secured portion, how much is the unsecured portion. Unsecured portion with regard to doubtful asset is always how much provisioning is required? 100% provisioning is required. Now there is a secured portion. Yes. So secured portion, if it is D1, doubtful up to 1 year, what is the provisioning? 25%. If it's D2, then provisioning is 40%. If it's D3, provisioning is 100%. So let me summarize it. For D1, okay, how much is the provisioning? Secured plus unsecured is 25 plus 100%. So 25 with regard to secured, unsecured is 100. Now, what is it with regard to D2? Okay, so D2 40% with regard to secured portion. Unsecured portion is 100%. Now, what is it with regard to D3? D3, whether it is secured or unsecured, both are 100% provisioning. 100 plus 100%. Next is loss asset. Okay, what is a loss asset? Where loss has been identified by the bank. Okay, where a loss has been identified by the bank or its internal or external auditors have identified it as a loss asset, or RBI inspection. Okay, loss has been identified by bank or the internal or external auditors or the RBI inspection, but the amount has not been written off wholly. Then what happens? This is a loss asset. What is the provisioning required with regard to it? 100%. Here you don't make the bifurcation whether it is secured or unsecured. Okay, this is with regard to the provisioning required for NPA. Now, we suppose that a party was disbursed a loan on 1st January 2020. So what is it? It is 1st January 2020. Now, what is the due date of the loan? June 1, 2020. Okay, the party does not make the payment on the day. So what will happen? First, it will become a standard asset. So standard asset from January 1, 2020 till June 1, 2020 till the due date, it is a standard asset. First stage. Second stage, it would become a SMA account. What is it? Special mention account. From which date? From June 2 to August 29. That is till 90 days. Yes. After 90 days, it becomes a substandard asset. Okay. From August 30 to August 29, 2021, the next year. Okay, substandard. Thereafter, it becomes doubtful asset from August 30, 2021 till August 29, 2022. It becomes doubtful asset. How long it can be a doubtful asset? It can be a doubtful asset for a period of 3 years. Okay, then beginning from 12 months of being NPA. But however, once auditors identify it as a loss, so from that it will move to loss asset. It will be assigned as a loss asset. The period may be anything about 3 years. Now, gross NPA and net NPA, both are not same, both are two different concepts. Okay, gross NPA is the amount outstanding in the books, regardless of any interest recorded and debited. Net NPA is gross NPA minus interest debited to borrower account and not recovered or recognized as income. Next, NPA and SURFACE Act. SURFACE Act is Securitization, Reconstruction of Financial Assets and Enforcement of Security Interest Act. What does it mean? You give lot of assets to the banker as security, okay, but you however default on the loans. What the banker might do, can it keep the security with itself? No, it would give it for auction and take the proceeds from the auction. So what is this? The banker will take legal recourse to recover their dues from the security provider. What the banker would be doing? Auctioning the assets given as a security. Then, if bad loan remain NPA for at least 2 years, the bank can resale the same to ARC company. What is ARC company? Asset Reconstruction Company. For example, Reliance Asset Reconstruction Company, JM Financial Asset Reconstruction Companies. There are all some reputed asset reconstruction companies in India. What do the bank do? Bank identifies the NPA and they sell it to the ARC companies. Okay, so what would ARC companies do? ARC companies would be buying the NPAs from the bank. After that, ARC company would be following up with the borrowers personally. So whatever rights the bank had, now it would be entrusted with the ARC company. The asset reconstruction company would be following up for the recovery of the debts. Okay, the NPA would be identified. After that, it would be sold to ARC company. For example, if it is 1,000 crore NPA and banker knows that this amount cannot be recovered fully, these NPAs would be sold to ARC companies at a discount. Now, what would happen? Let us say if it is the banker would be selling it, let us say for 650 crore. Now it's a duty of ARC company to recover the dues from the borrowers. Now, accounting impact. Okay, accounting impact of NPA. Okay, so if an asset is classified as NPA for the first time, what would happen? What is it? The asset is being classified as NPA for the first time. Now, let us say the loan is rupees 100. Okay, and the interest is 30 rupees. And this interest of 30 rupees is not realized. Not realized. So what should you do as a banker? Reversal of income accrued but not realized. That is, reversal should be done. What should be done? Reversal of income accrued but not realized. Meaning full provision to be created. Full provision to be created for how many rupees? Rupees 30, which is the interest amount. Now, what happens? The customer will start repaying further. Yes, when he starts repaying further, it will be recognized only on cash basis and not on accrual basis. Okay, so what is it? The full provision to be created for the interest, and when he starts repaying, the further income will be recognized on cash basis, not on accrual basis. Then, second part. Percentage of provision on amount of assets based upon the classification. What is that? We already know that. What are they? Substandard, then doubtful, then loss. Now, what is interest? Now we are going to see about interest. Interest is a payment. Payment from whom? Payment from a borrower. Borrower. or it can be a deposit taking financial institution. Two, payment is made to whom? Lender or depositor of an amount above the repayment of principal sum at a particular rate. Now, is this the same as dividend? No. Dividend and interest are not one and the same. Now, what is dividend? Dividend is paid by a company. To whom? To the shareholders. From the profit of the company or the reserves of the company. It is not at a particular rate decided beforehand, rather on a pro rata basis as a share. Why dividend is given? As a reward gained by risk-taking entrepreneurs. Now let's come to interest. So a customer would usually pay interest to borrow from a bank. Why? So that they pay the bank an amount which is more than the amount borrowed. Or the customer may earn interest on the savings so that they may withdraw more than whatever they deposited. So with regard to savings, customer is a lender and bank plays the role of the borrower. Is interest the same as profit? No. Interest is also different from profit. So what is profit? Profit is received by owner of an asset or owner of an investment or enterprise. Now, how do you calculate the rate of interest? Rate of interest is equal to the interest paid or received over a particular period of time divided by principal sum borrowed or lent. So usually rate of interest is expressed as a percentage. Now, we'll see the concept of interest with regard to economics. What does economics say? The rate of interest is the price of the credit. Now, so this is playing the role of cost of capital. So cost of capital makes sense in economics. So in a free market economy, the interest rates are subjected to law of supply and demand of the money supply. Interest income is always considered as a main pillar of any banking institution. So whenever a customer takes loan from a bank, the bank charges him certain interest at a predefined rate. The actual meaning of interest is the rate at which the return is paid by the borrower. The payment of the same is usually at some intervals or at the end of loan period. The said interest is calculated based on the terms of agreement between borrower and bank. Based upon the borrower's needs and type of loan, the type of interest is ascertained. Now, we are going to see something called interest rate. What is interest rate? It is the amount of interest due per period. It is a proportion of the amount lent. So it is amount of interest due per period. It is proportion. It is a proportion of the amount lent. Now, the total interest on an amount lent or borrowed depends upon the principal sum, the interest rate, the frequency compounding, and the length of time over which it is lent, deposited, or borrowed. Now, interest rate is defined as a proportion of an amount loaned which a lender charges as an interest. Normally, interest rate is given as a percentage, annual percentage. So, it is a rate a bank or other lender charges to borrow the money, or the rate a bank pays to the savers. Now, what is annual interest rate? Next is annual interest rate. What is annual interest rate? It is a rate over a period of 1 year. Other interest rate apply over different periods. It could be month or it could be day, but they are usually annualized. Now, interest rates may vary. Now, interest rate may vary according to government's directives to the central bank. So, RBI might decide central bank to accomplish the government's goal. Then interest rate may vary according to the currency of the principal. Then it may vary according to term, to maturity of the investment. Then it may vary according to perceived default probability of the borrower. Then it may also vary according to supply and demand in the market. Next, reasons for interest rate change. First, maybe because for political short-term gain. Then deferred consumption. Or it may be because of inflationary expectation. Or alternative investment. Let's see it one by one. What is political short-term gain? See, lowering the interest rate is very good for the economy because it gives a boost to the economy. So, cutting interest rate will give a short-term gain in the economic activity. What will happen? That will be offset by inflation. This quick boost can usually be helpful at the time of election. So, during election time, this tactics may be followed. Then deferred consumption. What does this mean? When the money is loaned, the lender delays spending the money. Since according to time preference theory, people prefer goods now to goods later, there will be a positive interest rate. Then inflationary expectation. So most of the developing economies generally exhibit inflation, meaning a given amount of money buys only fewer goods in the future than it will now. So the borrower need to compensate the lender for this. Alternative investment, the lender has a choice between using this money in different investment. If he chooses one, he is foregoing the return from the others. So different investments effectively compete for funds. Next, risk of investment. Risk of investment. So there is always a risk that the borrower will go bankrupt. So which means that the lender will generally charge a risk premium. Next, liquidity preference. People prefer to have their resources available in a form that can immediately be exchanged rather than a form that takes time to realize. Then taxes. So some of the gains may be subject to tax. The lender may insist on a higher rate to make up for this loss. Then banks. Banks can tend to change the interest rate to either slow down the economic growth or speed up the economic growth. Then lastly, economy. Interest rate can fluctuate according to the status of the economy. If the economy is weak, the interest rates will be low. If the economy is strong, then the interest rate will be high. Now, we are going to see types of interest. There are two types of interest. First is called the simple interest. The next is called compound interest. What is simple interest? SI. Simple interest is a type of interest. It's a type of interest. It is applied to the amount borrowed for the entire duration of the loan without considering any other factors such as past interest paid or any other financial aspect. So, this simple interest is generally applied to short-term loans. Usually, it might be 1 year or less than that. It is also called as flat rate. Why? The amount charged for each year is at a fixed percentage for the amount borrowed. Now, what is the simple interest formula? P into R into T divided by 100. Now, what does P stands for? Principal. What does R stands for? Rate of interest. Now, what does T stands for? T stands for the time of duration or the loan in years. Now, calculation of compound interest. So here we are going to learn about compound interest. What is compound interest? In simple interest, we knew that the interest would be charged only once. However, in contrary to this, if the interest is charged more than once, the interest has to be reinvested. So here, point number 1. With regard to compound interest, the interest is reinvested. Point number 2. It is the addition of interest to the principal amount, or in other words, it is interest on interest. So compound interest is nothing but interest on interest. Now, what is this as a result of? It is a result of reinvesting interest rather than paying out. You don't pay it out, but instead reinvest the interest as well. So that interest in the next period is then earned on the principal sum plus previously accumulated interest. So in the first time, it is on the principal you get the interest. Second time, you are earning interest on the principal plus the previous interest. This is compound interest. Now we have to know what is the difference between simple interest and compound interest. Point number 1. In simple interest, it is calculated on total principal for the total tenure. Compound interest, it is calculated on the principal amount periodically. Meaning, it can be calculated monthly, it can be calculated quarterly, it can be calculated half yearly, or it can be calculated annually. Point number 2. Accumulated interest is not added. So, interest is not added to the principal. Now here, the interest you accumulate is periodically added to the calculation of interest. So here, interest is added to the principal for the subsequent calculation. Third, interest earned will not increase even if the calculation is done periodically. Now here, interest earned or paid will increase if the frequency of interest generation or payment is more. Next point, with regard to simple interest, accumulation of interest is slow. Whereas here the accumulation of interest is fast. Why? You get the interest on the growing interest as well. Now we are going to see the benefits of simple interest and compound interest. Now, two aspects. What will happen with regard to savings? Simple interest will not earn you enough. For what? Savings and investment. But if you take a loan, it will give you a benefit. Now, compound interest with regard to savings, it will give you more earnings. But if it is with regard to loan, it is costlier and not benefit to you. Why? Interest on interest. Next point. Simple interest is good for wealth creation. It is not good for wealth creation. Not good for wealth creation. Whereas compound interest is good for wealth creation. Next, simple interest is beneficial to the borrower, but not to the lender. So, if you take a loan on simple interest, you will be paying less. Now, compound interest is beneficial to the lender, not to the borrower. You will be paying more on a loan with regard to compound interest. Next, simple interest is easy to calculate, whereas compound interest is complicated to calculate. Now, let's analyze the formula for compound interest. So, formula for compound interest is CI equal to, that is compound interest. CI means compound interest. Now, the formula is only for amount. A equal to P into 1 plus R the whole power n. Now, what does A stands for? It is the amount. amount received by the person after n year, including the interest. Now, what does P stands for? It's a principal amount. What does R stands for? Rate of interest. Now, what does N stands for? Number of years. The financial institutions vary in terms of the compounding rates. So, compounding can be done. Compounding can be done daily or monthly, or it could be yearly, quarterly, etc. Now, let us say a person has 1000 as a principal. If 10% is the interest compounded annually, what is the balance at the end of first year? It would be 1100. Now, by the second year, this again 10% would be levied not on 1000 but on 1100. So, this would amount to 1210, and this will continue till the end of the tenure. The formula for annual compound interest, including principal sum, is A equal to P into 1 plus R divided by N into NT. So, this is the formula you would be using most of the times when the questions involve the interest rate which is compounded quarterly, half-yearly, etc. So, divide the rate by the period and multiply the term by the period. So, R divided by N, the whole power N into T. So, here what does A stands for? It is a future value of investment. Including the interest. What does P stands for? It is a principal. What does R stands for? Interest rate. What does N stands for? The number of times interest is compounded per year. What does T stands for? T stands for the number of years. This formula will give you the future value of investment or loan, which is compound interest plus the principal. Now, what is the total compound interest? It has to be derived indirectly. So, compound interest formula is P into 1 plus R divided by N, the whole power NT, minus P. We know that the first part is amount. So, amount minus principal gives the compound interest. So, P into 1 plus R divided by N, the whole power NT, which is nothing but the amount minus the principal, would give you the compound interest. Now, let us go to question number 1. Question number 1. Mr. A has borrowed 10,000 from ABC Bank at 15% rate for 1 year. So, let's see the numbers over here. Amount borrowed, which is P, equal to 10,000. Rate of interest R equal to 15%, and time equal to 1 year. Which means simple interest formula equal to P into R into T. That is principal into rate into time divided by 100. Which means it is 10,000 into 15 by 100 into 1. Which is 1500. That is what being given here. Interest equal to P into R into T by 100, which is 1500. So let's see it once again here. It is 1500. Now, question number 2. Question number 2. A sum of rupees 30,000 becomes 33,000 at the end of 2 years when calculated at simple interest. The rate of interest would be. So, what is the principal amount? It is 30,000. What is the principal becoming after 2 years? 33,000. Which means the simple interest is the difference of the two, that is 3,000. Now apply the formula once again. SI equal to P into R into T by 100. So this 3,000 equal to what is the principal amount? We know it is 30,000 into what is the rate? The rate of interest is to be calculated. What is the time? The time is 2 years. So what is the rate of interest? R equal to 10 divided by 2, which is 5. Next question. Next question. At what rate percent per annum simple interest will a sum of money double itself in 6 years? So here the number is 6 alone. We do not know the other details. However, we can arrive at the answer by assuming the unknown value to be x. Now they have told the money is doubling. So if the principal invested is x, the amount is double. The amount has doubled, which means 2x. Which means obviously the simple interest is a minus b, which is 2x minus x, which is x. Now apply the formula. SI, x equal to P. The principal amount is x. What is the rate? That is to be calculated into T. T is the time, which is 6 years. So R equal to 100 divided by 6. So rate equal to 16.67%. Next question. A sum amounted to rupees 2,520 at a sum amounted to 2,520 at 10% per annum for the period of 4 years. Find the sum. Meaning they have invested a principal which is unknown. Let us assume it as x. Finally, it amounted to 2,520. Now, what is the time period? Time is given as 4 years. We know the simple interest formula. Simple interest equal to P into R by 100 into T. P is X. What is R? 10% given. Into time is 4 years. So simple interest equal to 2x by 5. What is the principal? Principal is x. What is the amount? Amount is 2,520. So amount is nothing but the principal plus simple interest. So x plus 2x by 5 already derived is 2520, which means 7x by 5 equal to 2520. Obviously x equal to 1,800. So x means the amount invested. 1,800 when invested for 4 years at 10% per annum would give you 2,520. Now, next question. Next question is, Mr. Darshan want invest rupees 20,000 into a fixed deposit, paying 10% annual interest. The accumulation of interest is quarterly. How much money will he get after 10 years? Now, what is the principal amount? Principal amount is 20,000. Interest is 10% annual interest. Now, this is not simple interest. This is compound interest. What is compound interest? It is interest on interest. Interest levied over interest is called compound interest. So amount invested is 20,000. Interest is 10%. It is compounded quarterly. How much money will he get after 10 years? So amount invested 20,000 is a principal. Rate of interest is 10%. Years is 10 years compounded quarterly. Meaning the 10 percentage, what should you do? 10 percentage divided by 4. Also 10 years multiplied by 4. Why you divide 10 percentage by 4? It is interest is quarterly. Therefore compounding quarterly. 10 years you are given in years, you have to convert it into months. So that also you are converting it 10 into 4. So interest 10 percentage divided by 4, years 10 multiplied by 4. Now information 20,000, rate is 10 percentage, n equal to 4, t is equal to 10. Compounded quarterly. A equal to P into 1 plus R the whole power n. 20,000 into, so because 10 percentage divided by 4 would give you 0.025. Similarly 10 into 4 equal to 40. So 0.1 divided by 4, then 1 plus 0.1 divided by 4 give you 1.025. 1 plus 0.1 divided by 4 whole power 40 gives you 2.6850,384. Now you have principal rupees 20,000. 20,000 into the amount set would give you the A. So 0.1 divided by 4 you get one part. After that add 1 to it. 1 plus 0.1 divided by 4. Thereafter you have 1 plus 0.1 divided by 4 whole power 40. That amount you have to multiply it by 20,000 to get A. So A equal to 53,701.27. So money he will get after 10 years equal to 53,701. Now, next, Mr. Sudhakar wants to have rupees 25,000 after 4 years. How much money he would need to deposit today at 8% interest compounded monthly? Let's read this once again. If Mr. Sudhakar wants to have 25,000 after 4 years, let's be very clear, this 25,000 is the amount. It's not the principal. So A is equal to 25,000. What's the time period? 4 years. Time period is 4 years. Now, what else is being told? How much money he would need to deposit today? And what is the interest rate? 8%. 8%. Now, the interest is compounded monthly. So this is the catchword. Interest is compounded monthly. So this is not simple interest. This is compound interest. The definition for compound interest and simple interest is different, and the formula is also different. What is the formula for compound interest? A equal to P into 1 plus R the whole power n. A is the amount, P is the principal, R is the rate, n is the time period. Now we have to very carefully see it, what kind of compounding. The compounding can be half yearly, the compounding can be quarterly, the compounding can be monthly, the compounding can be every day as well. So here it is compounded monthly, which means you cannot take this 8% as such for calculation. Instead, for calculation purpose, the amount, the rate should be 8% divided by 12, which means 0.08, that is the 8% divided by 12. Why divided by 12? It is compounded. It is compounded monthly. So 0.08 divided by 12. So what is 0.08 divided by 12? So if you see 0.08 divided by 12, it comes around to 0.0066667. So this is one part. So rate of interest 8% should be divided by 12. Next, what else adjustment should you make? Now we are given the time period as 4 years. Here also we have to make an adjustment. 4 years cannot be taken as 4. It should be converted into months. So 4. So the answer is 4 into 12. Please keep it in mind. The rate should be divided by 12, whereas the n should be multiplied by 12. So for rate, you have to divide the rate of interest by 12, and the n, which is 4, should be multiplied by 12. So 12 is the same. In one case you divide it, the other case you multiply it. So you get 48. So 4 into 12, 48. So for calculation, do not use 4, use 48. Now, we do not know P. However, we know A, which is 25,000. R is 0.08. You divide it by 12 for calculation purpose. Similarly, the compounding is 12 months monthly. Time period is 4 years. So A equal to P into 1 plus R the whole power n, which means 25,000 equal to P into 1 plus 0.08 divided by 12 the whole power 48. 48 already we have arrived. Now from this we will have to arrive at the answer. 0.08 divided by 12, we knew it. 1 plus 0.08 divided by 12, we have to find what is inside the parenthesis first. Then 1 plus 0.08 divided by 12, the whole power 48 gives you 1.375661. Now, this is the one part of the answer. Now, what is P? P is nothing but 25,000 divided by this number. So if you want to find P, 25,000 divided by 1 plus 0.08 divided by 12, the whole power 12 into 4. So this is the 1 plus 0.08 divided by 12 raised to 48. So if you want to find out P, you have to divide 25,000 by this number. Now 25,000 divided by this number would give you 18,173, which is the principal. So the answer is 18,173.01. Now, next question. The same question with a little twist in the numbers. Loan amount is 10 lakh. Interest percentage is 11% compounded monthly. Now, you have to arrive at EMI. This is the question. Now, if you see the previous one, this is based on A equal to P into 1 plus R the whole power n compounded interest. It is not the same over here. This is with regard to EMI. The EMI calculation is a bit difficult. It's a bit different, and we'll be knowing about the same as well. Now, next topic is EMI. What is EMI? What is EMI? It is equated monthly installment. EMI stands for equated monthly installments. Now, what is it? First point, it's a fixed payment. Who makes to whom? It is made by a borrower to the lender. So this is made on a specified date every month. Next, EMI is used to pay off both interest plus principal amount. So when you say that you pay EMI, it means that some portion of interest is being paid and also principal is paid each month. So that over a period of years, the loan is fully paid off. So it consists of both payment towards interest and payments towards principal. So EMI is derived based on the amount borrowed, interest rate, and the time for which loan is taken. So typically you take EMI for what? Home loan. Home loan you pay off the EMI. Car loan you pay the EMI, and other personal loan also you pay the EMI every month. So what is the formula to calculate EMI? EMI equal to P into R into 1 plus R the whole power n divided by 1 plus R the whole power n minus 1. Now what does the P stands for? P stands for the loan amount or the principal. R is the interest rate per month. Please note it, it is interest rate per month. Why? Why it is interest rate per month? Because you pay the installment every month. For example, if the interest rate per annum is 9%, then for calculation, you have to write it as 9% divided by 12. And N stands for number of installments. Now, let us see this problem. Loan amount is rupees 10 lakh. Interest rate is 11%. You are supposed to calculate the EMI. Now, loan period is 15 years. So, loan amount rupees 10 lakh, interest rate 11%, loan period is 15 years. Now, let us understand that this is EMI, equated monthly installment, which means you have to make monthly payment. So, the interest rate 11% is per annum. However, you have to calculate it per month. So, obviously, you have to divide it by 12. So, for calculation, you have to divide it by 12. So, 11% divided by 12. First step. So, you get 0.0091. Next, loan period is 15 years, which means you have to convert it into months. So 15 into 12 gives you 180 months. Now EMI equal to P, the principal, into rate, into 1 plus rate, the whole power n, divided by 1 plus R, the whole power n minus 1. So we have to know some of the parameters before proceeding further. We know the rate is 0.091667, already found out. Now, you have to also know 1 plus R. So, 1 plus R is 1 plus the above number. You get 1 plus 1.0091. Then 1 plus R, the whole power n, is the previous number raised to 180, which is 5.16798. Now, EMI is P, 10 lakh into R, which is the rate 0.0091 into 1 plus R the whole power n, that is 1 plus 0.0091 the whole power 180, divided by 1 plus R, 1 plus 0.0091 the whole power 180 minus 1. Now, we also know some of these answers well in advance. 10 lakh into 0.0091 into, we have already found this number also, 5.167 divided by 5.167 minus 1. We get 11,365. So the EMI per month is 11,365. Now, loan of 2 lakh is taken at 10% interest for 18 months. So let us recall once again, we are going to calculate EMI. So we need to calculate the rate of interest per month. So 10% should be divided by 12. Similarly, we have to get the number of years converted into months. Already the question is given in months, so no need of conversion. Now, so 10% divided by 12 would amount to 0.00833. Loan period is 18 months. EMI equal to P into R into 1 plus R the whole power n divided by 1 plus R the whole power n minus 1. 0.1 divided by 12 is 0.008333. 1 plus 0.1 divided by 12 gives you 1.00833. 1 plus 0.1 divided by 12, the whole power 18 gives you 1.16111233. Now, let's apply the EMI formula here. Principal 2 lakh into R. The rate per month is 0.00833 into 1 plus R the whole power n, which is nothing but 1.16111233. That's a numerator. Denominator is 1 plus R the whole power n minus 1, which means 1.16111233 minus 1. When you divide both, you get 12,011.42. So this is the EMI. So EMI means every month the fixed payment is 12,011.42. So the EMI portion comprises of both interest and principal. So if you want to know how the schedule would look, we have to prepare a tabular column. Okay, so we have to take the relevant parameters and we would find how long this EMI would have to pay and what is the schedule and what is the amount to be paid every month. So let's assume that the EMI starts from 1/1/2021. We have already calculated the EMI, that is 12,011.42. This is a fixed amount which does not change. Now, the interest is calculated at 10%. We already know that it is being given. This is 10% per annum. Now, the next column would be net amount after interest adjusted towards principal. Meaning what? The EMI comprises of both interest and principal. From 12,011.42, you have to split the interest and principal portion every month. And the last column is principal outstanding after adjusting the principal repayment amount every month. Let's start with a particular year, 1/1/2021. Let us assume that the EMI commences from 1/1/2021. This is just a assumption. Whichever is a date on which you pay, you can take that date. For practical purposes, we would assume that the EMI starts on 1/1/2021. And 12,011.42, which is already the fixed number, which we have already calculated. So the EMI column remains fixed. The next is the interest column calculated at 10%. Now, being the very first man, how is interest calculated? We know that the principal amount is 2 lakh. On 2 lakh, you have to apply the interest. 2 lakh into 10%, but this 10% is for 1 year. So you have to calculate it for a month. So 2 lakh into 10% divided by 12 would give you the interest at 10%. So first month interest is 1,667. Now, we have already known the EMI. We also know the interest calculator. We can derive the principal amount out of the EMI. This column, C column minus D column, would give you the EMI. So that is 10,344.75. Now, what is the amount, loan amount we have taken? Loan amount is 2 lakh. From 2 lakh, 10,344 is getting adjusted as towards a principal. So, from 2 lakh, subtract the principal adjustment amount, that is 10,344.75. So, you get the principal outstanding at 189,655. Now, next month, first 1/2/2021, you pay the next EMI. What is the EMI amount? It remains fixed 12,011.42. But here the interest calculation changes. We know that the interest next month would be calculated on the principal outstanding for the previous month. What is the principal outstanding for the previous month? 189,655.25, and it is not 2 lakh. That has to be kept in mind. So on that, apply 10% into 1/10. So we get 1580.46. So again, the formula remains the same. From EMI, subtract 1580.46. Then what is the principal outstanding? Principal outstanding is 189,655.25 minus 1043.2430.96, which gives you 179,224.30. So this continues on and on. And finally, on 1/6/2022, the EMI remains the same, 12,011.42, but the interest is dwindling. The interest comes down to 99.27, and you are also repaying the principal at 11,912.15, and you are left with 0 outstanding, which means the loan comes to an end. So you have to just keep on repeating this exercise until the principal outstanding comes to 0. Now, let's see the next topic, fixed interest rate. So it is fixed interest rate. What does this mean? This is an unchanging rate. So what is fixed interest rate? It is an unchanging rate. Point number 1, it's unchanging in nature. Point number 2, it is charged on liability. Means it could be charged on a loan or it could be charged on a mortgage. Now, when can it apply? It can apply on the entire term of the loan, or it could apply on just part of the term. But it remains the same throughout a set period. So mortgages, they can have multiple interest rate options, including that one with a fixed rate for some portion and adjustable rate for balance. They are referred as hybrids. So what is a hybrid? So the mortgages that can have multiple rate option, including that combines a fixed rate for a small portion, fixed rate for one portion and adjustable rate for the balance. That is called hybrid. What are the points regarding fixed interest rate? First, fixed interest rate avoid the risk. What is the risk? See, the mortgage or loan payment can significantly increase over a period of time. So if you are opting for a fixed rate, it does not increase. Point number 2. However, fixed rate can be higher than variable rate. There are chances. Now, let us assume that it is a low interest rate period. Then the borrowers will more likely to opt for fixed rate loan. Then, what are the advantages and disadvantages of fixed interest rate? Point number 1. Fixed rates are typically higher than adjustable rate. So fixed rates are higher than adjustable rate. So there are loans with adjustable or variable rates. Loans with adjustable rate or variable rate. They usually offer lower introductory rate. So in the beginning of the loan, the rate will be lower in nature, lower introductory rate. Therefore, these kind of loans are more appealing than fixed rate loans when the interests are high. So what happened to such kind of loans with variable rate? Because their offer is rate is lower than the fixed rate loan, they are more appealing. Point number 3. So during lower interest rates, borrowers are more likely to opt for fixed rate during period of low interest. So borrowers are more likely to opt for fixed rate during period of low interest. When locking in the rate is particularly beneficial. When locking that particular rate forever for that particular loan is beneficial. The opportunity cost is still much less than during periods of high interest rate if interest rate go lower. Now, we are going to see floating interest rates. So first we saw fixed interest rate. Now we are going to see floating interest rate. So point number 1, the rate is not fixed. The rate is not fixed. So it may change depending upon market condition. So which is a decider? Market. The rate of interest which is tied to a benchmark rate. So if the benchmark rate is undergoing a change, the rate of interest also will change. So this is called as variable rate. It's not fixed. So there is a benchmark rate. It should be made known by the banker to the depositor. So there is a concept of benchmark rate. So when the benchmark rate changes, this floating rate also changes. So the banker should inform the depositor or borrower about this benchmark rate. What are the examples of benchmark rate? So what are the rates which could be benchmark rates? First, it could be the repo rate, or it could be the MCLR, marginal cost of lending rate. If the floating rate quoted by bankers, repo rate plus 100 basis point, then how do we go about? So here 100 basis point means it could be 1%. Now let us assume the repo rates for the following quarters. First quarter, the repo rate is 5.5. Second quarter, repo rate is 5.75. Third quarter, repo rate is 5.40. Fourth quarter, repo rate is 5.90. Now, correspondingly, let us understand the points. So, we know that the floating rate equal to repo rate plus 100 basis point, that is repo rate plus 1%. So, first quarter 5.5, so the floating rate is 5.5 plus 1, 6.5. Second case 5.75 plus 1%, 6.75. 5.40 plus 1%, 6.40. 5.901 plus 1%, 6.90. So the floating rates can either increase or decrease depending upon the movement of benchmark rate. So can it be advantageous to customer? Yes. Can it be disadvantageous to the customer? Yes. It depends upon the benchmark rate movement. Now this banks offer floating rate based deposit. The banks offer floating rate based loans like housing loans, personal loans, etc. Under the floating rate loan, if the loan is being repaid by an EMI, repayment tenure will be changed without disturbing the amount of EMI. Now, annuity. What is an annuity? Annuity is a financial product. So point number one, it's a financial product. Point number two, it provides certain cash flows at equal time intervals. Equal time interval. Who creates annuity? Annuities are created by financial institutions. Primarily life insurance companies to provide regular income to the client. So, an annuity is a reasonable alternative to some other investment as a source of income since it provides guaranteed income. Guaranteed income to the individual. But what is the drawback? Annuities are less liquid in nature. Annuities are less liquid in nature because the initially deposited lump sum cannot be withdrawn without penalties. So what happens in an annuity? The individual pays lump sum to the issuer. What does he pay? Lump sum. To whom? To the issuer of the annuity. What does it mean? Financial institution. What does the issuer do? Issuer holds the amount for certain period. What is it called? Accumulation period. Accumulation period. What happens after the accumulation period? After the accumulation period, the issuer makes fixed payments. Fixed payments to whom? To the individual according to the predetermined time interval. So annuities are typically bought by the individuals who want to receive stable retirement income. Now, next is what are the types of annuities? The annuities are of different types according to the frequency and types of payments. The cash flow can be paid at different time intervals. The payments could be weekly, bi-weekly, monthly, etc. So what are the typical primary types of annuities? Point number one, fixed annuity. Point number two, variable annuity. Point number three, life annuity. Point number four, perpetuity. Now, what is a fixed annuity? Fixed annuity is an annuity which provides fixed payments. What is the specialty about this annuity? The payments are guaranteed. What about the rate of return? Rate of return is minimal in nature. Next, variable annuity. What is variable annuity? Annuities that allow an individual to choose selection of investment that will pay in income based on performance of the selected investment. Variable annuities do not guarantee amount of income, but rate of return is generally higher relative to fixed annuities. Next, life annuity. What is life annuity? Point number one, they provide fixed payments to their holders until the death. Next, perpetuity. What is perpetuity? An annuity that provides perpetual cash flow. What is perpetual cash flow? Continuous cash flow. Is there any end date? No end date. So examples of the financial instrument that give perpetual cash flow is very rare in nature. Now, the banks are required to present and prepare the financial statements. So financial statements here, it means balance sheet and the P&L. It is as per the format under Schedule 3. Now balance sheet, it's typically Form A. So it's Form A. Now, so the balance sheet of a bank. No, balance sheet as on the particular date. So when you write about balance sheet as on a date. Now, how does a format look like? First is particulars. Then you have schedule. Then you have current year figures. And then you have previous year figures. So you have two things in balance sheet. The first is liability. Then you have the asset. So liability is presented first, after that the asset. Now what are the components of liabilities? So the first is the capital. So capital of a bank is its liability number 1. Second, because our operations are being conducted, typically reserves and surplus are being earned, that is also coming under liabilities. Third, deposits of the bank. Deposits is very important component. They form the next liability. Then it is borrowings. Borrowings of the bank. Then you have other liabilities and provisions. Other liabilities and provisions. So typically this is the liability part. So after that you have the second part, which is the asset part. Now under asset, what comes first? It's a cash and the balances with RBA. Cash and the balance with the RBA is the first component. Then you have the balance with the banks. Then you have money at call and short notice. Then you have investments. Then you have loans and advances. Then it is fixed asset, and finally other assets. So this is typically a schedule with regard to the balance sheet. So you have liabilities followed by the assets. Then you also, banker has also should present the contingent liabilities. What is contingent liability? It is not an actual liability as on the date, but it might crystallize as a liability in the future. Now let's go deep into each of the components of the balance sheet further to understand it in a better manner. Now, let's see about the capital. So capital. Now the capital, first let us talk about nationalized banks. Now nationalized banks are owned by central government. So the capital is fully owned by central government here. So fully owned by central government. Point number 2. What if the bank is outside India? Banks incorporated outside India. Here we have to show it in two manners. The normal capital, that is the amount brought in by the banks by way of startup capital, Then second one, amount of deposit kept with RBI under the Specified Banking Regulation Act. Now, third point, for other banks, you have to show various disclosures. What is the first disclosure? What is the authorized capital of the bank? So this is the maximum capital the bank can raise, that is authorized capital. You have to tell number of shares of dash each. So what is the value of the share and number of share? So below authorized capital, next is issued. So what is the authorized capital? The maximum capital which the bank can raise. So issued capital should not exceed authorized capital. So issued capital in the same manner, how many shares and the value of the each share. Then subscribe. Of the capital which is issued, how much is being subscribed? In the same manner, number of shares and the value of each share. Next, so you have authorized, issued, subscribed, then you have called up capital. Called up capital in the same manner, number of shares, face value of the share. Now remember, whether the called up capital will be fully paid up? No. No. The shareholders might not have paid fully, so you have to deduct what is called calls unpaid. Unpaid call should be deducted. Then, if the calls are unpaid for a longer period of time, then the bank may forfeit the shares, cancel those shares. So if the shares are forfeited, you have to add back the forfeited shares. Remember, to the extent of calls unpaid, you have to deduct it and the forfeited shares have to be added up. So less calls unpaid, you have to deduct the calls unpaid, whereas you have to add up the forfeited shares. Second schedule is this with regard to reserves and surplus. Reserves and surplus. Now, there are typically some reserves which we are going to study. Statutory reserve. Second, capital reserve. Third, share premium. Fourth, revenue and other reserves. Then you have balance in P&L account. So there is a typical format you have to follow here with regard to reserves and surplus. What is this? You have opening balance of the reserves. Yes. Now to that opening balance, what you have to do? You have to make additions. Add the additions during the year. Additions to the reserves. Additions should be once again added to the reserves, opening balance. Then you have deductions. The deductions should be subtracted and that would give you the net balance. So for each of these reserves, what should be done? Opening balance, add the additions, subtract the deductions. You would get the net amount. Then next is deposit. Next is deposits. First, we are going to see about demand deposit. Demand deposits. This two categories from banks and then from others. Next, you have what is called savings bank deposit. Savings bank deposit. Then you have what is called term deposit. Term deposit further classified as from banks and from others. You get the total. Similarly, you have deposit of branches in India. Deposit of branches outside India. And you get the total of the same. Next, you have borrowings. So, borrowings in India. Borrowings in India. Three things: RBI, other banks, other institutional agencies. Now, second point, borrowings outside India. Then you have the total. Next is other liabilities and provisions. So what are the other liabilities and provisions? First is bills payable, inter-office adjustment, which is a net figure. Third, interest accrued. Fourth, others, including provisions. So you get the total of all the same. Now let's go to the asset side. First, we have what is called cash and balances with RBI. So here the first is cash in hand, including the foreign currency notes. Then second, balance with RBI. In balance with RBI, we have two things. One is in current account, then the other is other accounts. You get the total of the same. You have the next one is balance with banks and money at call and short notice. So two classification in India, outside India. What about in India? You have again two more classification. First is balance with the bank. Balance with the bank, two classifications once again, in current account. Then you have in other deposit account. Second is money at call and short notice. First is with bank, then with other institution. So you get the total of the same. Next you have outside India. Outside India, you have three classifications. Furthermore, current accounts, other deposit account. Third is money at call and short notice. So you get the total. And also you have the grand total. Grand total of in India and outside India. Next, investment. So investment is of two types: investment in India, outside India. In India, what are the investment? First, in government securities, then other approved securities, third, shares, fourth, debentures and bonds, fifth, subsidiaries and joint ventures, then others to be specified. Next, you have investment outside India. So here there are three categories. First, in government securities, then subsidiaries or joint ventures, then other investments to be specified. So you get the grand total of all. Next, you have advances. First, bills purchased and discounted. Second, cash credit, overdraft, loans repayable on demand. Third, term loan. Then second subpoint, based on security. Secured by tangible assets. Then covered by bank guarantee. Then unsecured. Third, advances in India and advances outside India. Now in advances in India, 4 classification. How much is it in priority sector? How much in public sector? How much in banks? And how much in others? Advances outside India. Here, due from banks, due from others. Due from others, 3 categories: bills purchased and discounted, syndicated loans, others. And you get the grand total of the same. Next, fixed assets. In fixed asset, 2 classifications. First is premises, second is other assets. So in premises, you have to see the opening costs, then additions during the year. Opening cost, additions during the year, less deductions. Deductions have to be subtracted. Then depreciation to date, that is also subtracted. Second is other fixed assets. Other fixed asset, opening costs, additions during the year, deductions during the year, depreciation to date. Total. You have other asset, next classification. In other asset, inter-office adjustment, net. Second is interest accrued. Third, TDS, tax deducted at source or advance tax. Fourth, stationery and stamps. Fifth, non-banking asset acquired. Sixth, others. You have the total once again. Now, so this is with regard to asset. Now, let's remember that there is one more classification, contingent liability. So, contingent liability is shown separately. So, under contingent liability, first, claim against the bank, which is not acknowledged as debt. Second, liability for partly paid investment. Third, liability on account of forward exchange contract. Then, guarantee given on behalf of customers. Guarantee given. In India, outside India. Then, acceptance, endorsement and other obligations. Then, last point is other items for which bank is liable. So, you get the total of the same. Now, financial markets are divided into two, capital markets and money markets. Financial markets are divided into two, capital markets and money markets. Capital market, it is further divided into equity and debt. Okay, you can raise capital by equity or you can raise capital by debt. So, capital market is further divided into equity market and debt market. Now, money market is further divided into primary segment and secondary segment. Now, come to the capital market. Under that equity, it is further divided into primary, secondary and derivative markets. Primary market is further bifurcated into domestic and international market. What about secondary market? Secondary market, we do not talk much about the same. Derivative market comprises of futures and options and further divided as index and stock. Debt market further divided into primary segment and secondary segment. Now, first point, we are going to study about money market. So, financial system of any country depends on three important aspects. What are they? Money, capital, and forex. Okay, the role of money market is as much as the market act as an equilibrating mechanism. So, money market, what does it mean? It is a market. It is a market for short-term funds. Short-term funds market. And generally it ranges from overnight to a year. So, maximum it is 1 year. What does it help? It helps in meeting short-term and very short-term requirements of banks, financial institutions, firms, companies, etc. So, money market is providing a mechanism for evening out short-term liquidity imbalance within an economy. So, what is very important for a country? Very vibrant and an active money market. Now, here in this particular money market video, we are going to learn about what is money market, who are all the participants, the instruments which are being used, what is call money, what is repos, what is the linkage between money market and foreign exchange market, what is money market mutual funds and the different types of modern instruments. So this is what we are going to learn here. We are going to see the distinct features of money market. So point number one, the features. First feature, money market is not a single market but collection of markets. So money market is not a single market but it's a collection of market. So what are the collections? What are the various other markets which come under this? First, call money, yes. Notice money, repos, term money, treasury bills, commercial bills, certificate of deposits, commercial papers, interbank participation certificate, IBPC, intercorporate deposit, swap futures, options, etc. All the submarkets are closely interrelated and there is free movement of funds from one submarket to another. This has to be kept in mind. They do not work in isolation, all are interlinked. So another important feature is that there has to be a network of large number of participants. Then only there will be a greater depth to the market. Now, where are these activities concentrated? Typically, the world's largest financial centers are typically the largest money markets. So activities tend to concentrate only in few centers, which are typically known for their financial activities. So what are they? You can see a lot of these activities in London, New York, etc. Now in India, Mumbai is emerging as a money market place. Now, third, there should be a very healthy competition with inside the money market. That has to be kept in mind. So the relationship that characterizes the money market should be impersonal so that the competition is relatively very pure. And there should be innovation to introduce new instrument in the market. There should be flexibility with regard to the market and there should be greater flexibility with regard to the regulatory framework. So constantly new instruments and new innovative dealing techniques should evolve and constantly new instruments should be evolving in the market. And it's a wholesale market and the volume of funds or financial assets traded are very large. So typically you see large trading in these kinds of markets. These are all the features. Now, we are going to see the distinction between capital market versus the money market. So certainly there are some striking differences between the both. Let's see what are they. First, let us talk about capital markets. So first is capital market. What is the feature and how is it different from money market? Okay. So first is options. The operations in money market is for a duration up to 1 year. So here the first point is the duration is maximum up to 1 year. And they mostly deal with short-term financial asset. So the financial assets are typically short-term. In capital market, what happens to the operations? The operations are for a longer period. And they deal in medium and long-term financial assets. Medium and long-term financial assets. Now, next point. Money market, it is not a well-defined place like the capital market. So here money market, the dealings are not done in a well-defined place. Not in a well-defined place. We know very well where the capital market transaction happens. Capital market transactions happen typically through the well-defined place called stock exchange. Now, next, there are sub-classifications for capital market, that is primary and secondary. In money market also slowly a secondary market is coming into picture. So capital market deal with long-term requirement, money market deals with supply fund for short-term requirement. Now what about the volume of business? The volume of business in capital market is less than that of money market. The volume of, if the volume of business of capital market is considered, it will lag behind the total value of transaction in money market. So if the total volume of business of capital market, both primary and secondary markets are considered, it will lag behind the total value of transaction in the money market. Now, next, what are the typical instruments dealt in the money market? We know that the typical instruments in money market are interbank call money, next notice money, short-term deposits, then the treasury bill having different dates. Then you also have the commercial papers. So here the typical most important instrument in capital market are shares and debentures. Next, who are all the players in the capital market? Capital market players are typically the general investors, brokers, merchant bankers, registrar to issue, underwriter, corporate investor, FII, bankers. In money market, the typical participants are bankers, central bank of the country, and the government. So more players in the capital market, but less players in the money market. Now, who is deciding the rate of interest in the money market? Rate of interest is controlled by the central bank. But whereas in capital market, the interest dividend rate depends upon the demand and supply of securities. So here there is no regulatory authority. Here what happens? This is depending upon the demand and supply. Market forces. There is a regulator who oversees only the regulatory aspect. However, demand and supply is the main force. Now, what about the risk? Risk in money market is small. Risk in capital market is great. Great risk. So why is the risk less in a money market? So because a maturity period is 1 year or less, you have a little time, therefore the risk is minimized. Whereas in case of capital market, the risk variation is different. It varies both in degree as well as nature. Okay. What about money market? Money market is very closely and directly linked with the central bank of the country. So central bank has direct influence over the money market. What about capital market? Capital market feels the pressure only indirectly. So indirectly it feels the pressure. But whereas in the case of money market, it feels the pressure directly. So let us summarize it once again, the few important features. So first is maturity. We have to see how much is the maturity for money market, the other one for capital markets. We know that money market instruments are short term. So here it is 1 year or less. What about capital market? More than 1 year. Second is risk. Here money market, the risk is less. Here it is more and varied. Instruments. T-bills, treasury bills, certificate of deposit, etc. Here it is shares, debentures, bonds, etc. Then finance, because it is 1 year or less, it is short-term finance. Capital market, it is long-term. Relation with central bank. Money market, there is a direct relationship, whereas capital market, it is more indirect in nature.